we want to welcome you all back to another video, another Zoom presentation with the folks at the Merriman Financial Education Foundation, who are working hard to share more about how investing works. And if you weren't here before, let me introduce to my left, no, that would be my right, would be Chris Pedersen, who is our Director of Research. And below me on my screen is Daryl Valls, who is the Director of Analytics. And these two guys, they do all the heavy lifting on the research that we do, all the tables that we produce. And the questions we're going to answer today have come from one of two presentations we made online. One was a Choose FI National Facebook Live streaming program that we did. It lasted 3.5 hours, including answering questions, but we didn't get to all of them, so it took more. And then another Choose FI presentation in the Seattle area some weeks later. So we have a bunch of those questions we have to respond to that we were not able to get to. So, and I'll just comment for those of you who did not see or hear the previous piece that we did, that Margie, who helps us put these together so they get up on the internet, has gone through and selected the times that each question is responded to, so that if you want to go right to that spot on the video or that spot on the podcast, you can do that. So with that, I've got a long list of questions for you guys. I've been told since we went an hour and a half doing this last time that I'm not allowed to talk as much as I did before, and I'm already behind. So here we go. First question, give you an easy one. During retirement, should you draw from the target date fund or the more risky small cap value fund? And Chris, I know this one is for you because this has to do with the two funds for life that that you presented both of those days for Choose FI. And what do you say to the person who's asking about that decision at the point of when you're in retirement?
Basically, it's a rebalancing opportunity, right? So in the same way that when you were contributing in your earlier years, you would have contributed to the fund that was underrepresented compared to your desired allocation, you would do the opposite. In retirement, if you're taking money out, you would take money out of the fund that is overrepresented. So the one that's grown, right? If it's been a good period of time for small cap value and it's grown to be a higher percentage of your portfolio than you're supposed to have at that point in time, this is your opportunity to sell high, right? So I would take out of the target or the small cap value. If on the other hand, small and value have been out of favor and the target date fund has held its position or grown to be higher than it's supposed to be in your portfolio, I'd take out of that. So it's basically a rebalancing opportunity, and you know, just try to nudge things back towards your desired allocation.
Now, if I just add one very quick thing, if they're following the two funds for life strategy and they're multiplying their age, let's say it's 60, then they have very little small cap value at that point. I think at age 60, 1.5 would be 90, and be 90% in the target date fund and 10% in small cap value. But by the time you're 66, there is no small cap value unless you put some in there yourself. I mean, that would be another answer to that question.
Sure. Yeah. I mean, if you're down to one fund, then it's pretty easy to know what to take from.
Great. All right. My wife wants to know, and I think this one's for you here, Daryl, why you don't recommend mid-cap funds.
Well, I think that mid-cap funds are kind of, well, let's back up a second and talk about why we recommend small. Small versus large gets you on the two ends of the seesaw, right? And so if small is performing well, you better returns. If large is performing well, you'll have better returns. Mid cap is kind of in the middle, so it's kind of a middle of the road solution. I don't particularly have any specific allocation to mid caps. I don't know what Paul or Chris does, but I would I just believe that working out on the edges, if you're going to adopt a diversification strategy like that, working on the edges may provide you a better chance to outperform than sticking in the middle. Chris?
I don't know if you're going to be able to see this. I'm going to guess it's difficult, but it comes out of a book entitled, oh yes, Live It Up Without Outliving Your Money. I wrote it. You'd think I'd remember the title. But one of my favorite parts of this book are a series of tables or graphs that show the returns for 10 different size companies, from the very smallest to the very largest deciles. And what is so fascinating about these tables over many periods of time is how, boy, when small is out of favor compared to large, it's a huge difference. And then in the next period of time, small is great and large is El Stinko. And unfortunately, this is what happens quite often. And in that rebalancing, you would understand the advantage of being able to take from the rich and give to the poor, because the differences can be absolutely huge and give you the leverage that you're looking for from working on the edges. So,
Hey, Paul, if I can just chime in, there is a mid-cap value fund we recommend. It's part of our best-in-class ETFs, and it's not because our portfolio design finds that the most, the most desirable. But when we combined it with all of the other funds that are in the best-in-class ETF set, it populated the Morningstar style boxes more closely to the way DFA populates them. And that's partly due to the fact that we couldn't find an ETF that was large value that was as discounted. It wasn't as far over into the value column, right? So people might look at that and say, well, wait a minute, you just said you don't recommend a mid-cap fund, and that is by design. That's true. We like to be on the endpoints because it gives you a better rebalancing opportunity, and it's a more diversified portfolio. But in that particular case, when we played it with the rest of the set, it made sense. So so that is an exception, and it's a little bit large, as mid caps would go. So it's kind of on the line between mid and large, which let us nudge it in there. But in general, if I could have found a large value fund instead that had the same discount, I would have done that for the reasons we just described. Yeah.
that's great. Okay. How do I invest RMDs, required minimum distributions, if I don't need the money to live on? I always thought this was a fun one when I was working with clients, because it's nice to know they don't need it. But yeah, Daryl, you might have actually run into this in your own portfolio, if I guess right.
Yeah, if you have to take an RMD and you don't need the RMD or don't need all of the RMD to fund your living expenses, I just invest the remainder, whatever's left over or I don't need, into your taxable portfolio. And I would put it in the asset classes that are underweight in that taxable portfolio. Use it as a balance sheet, or use it as an opportunity to rebalance or to back towards your desired asset allocation. I think it's, to a certain extent, I think it's that simple.
So I'm curious, in your particular situation, with that money that is taxable, is it mostly in equities? Because that would be the more tax efficient place to have them.
That's where we have two different taxable accounts right now, and both of them are 100% equity. Our fixed income assets are held in an IRA. So
And
that's,
Chris, yeah, would you do the same thing in terms of what you would house in the taxable part? Would you put your equities in the taxable portion?
that's what we do. Yeah.
Yeah, I don't know if Chris did the same.
Oh, Chris.
I don't know if Chris heard me or not.
Oh, yeah, you cut out briefly, but you know, we just by accident we ended up tax diversified in our retirement savings, so that we have, and it ended up being a really helpful thing. We have some of our retirement savings in taxable accounts and some of it in tax deferred accounts. And that was useful when I ended up retiring earlier than I expected, because there were no penalties for withdrawing from the taxable accounts. Where if I had, now if I'd had a big Roth account, that would have been fine too. But I didn't, unfortunately. So so we have equities in both the tax deferred and the taxable accounts. Yeah.
Okay. What is the best strategy for investing for my 4 children, ages 17, 5, 5, and 3? I have their investments in Uniform Trust to Minor Act accounts. Either one of you want to take that one?
I'll let Chris do that.
Okay. You have young people that are not 5 and 5, but what's your youngest?
Yeah. I have grandchildren that are
right, of course,
down in those ages, and we've encouraged the parents to invest in with a heavy tilt towards small in value. Now they have to be comfortable with it, right? But we've encouraged them to invest the kids' money as if it was going to be there in the same investment for a very long period of time, and it could patiently wait out times when that asset class does poorly, in hopes of getting a premium return, and with an expectation that the worst case is probably that they suffer more volatility along the way for a return that's not that different from the broader stock market. So yeah, we've encouraged them to take those very long funds and invest them in small cap value, and we've at least talked about the possibility of diversifying that with, some in US, some international, and some in emerging markets. So rather than having it all in the US small cap value, they could build a small aggressive portfolio for the long term that's a combination of those three.
And of course, if this money is going to end up being for education, then that would be a whole different decision-making process. And so
yeah, because that's like a 20-year horizon instead of a 50-year or 60-year horizon.
Right.
Yeah. So you might want more confidence in short-term returns. Yep.
Is VWEAX, which by the way is the Vanguard High Yield Admiral shares, is it still a good retirement fund choice? I'll take this one if you guys don't mind. And the reason is because we do have that fund in our, what we call our monthly income portfolio at Vanguard. And that portfolio is a combination of some high yield, 25%, 25% in a Ginnie Mae, 25% intermediate corporate, 25% short-term corporate. That combination right now pays about on average 3%, and certainly a much higher return than you would get with government-based bond funds. The high yield bond fund at Vanguard, I've been a fan of because it's the highest quality bond fund that I know of. It hasn't had the kind of downside risk in the worst of times. 2008, it was down about 20%, but there were lots of bond funds that were down 30 and 40%. I'm talking high yield junk bond funds. And then when the market turned around the next year and got well, I think it was up about 30 or 35%. It was a big move. But so it's going to obviously be a more risky, more volatile, because high yield bonds kind of look like stocks during the bad times. And so you would expect the volatility, but you would also expect to get a higher rate of return. Right now, I believe it's paying about 5.6%, which is a good return on bonds. Anybody want to add anything to that?
Well, I think it's seen some volatility this year as well, right? It's already
it's down.
Yeah.
I think it's down about 3%.
Yeah, but it had a bigger dip and has come back, right?
Exactly.
Yeah. I think it was off 15 to 20%, something like that. But like before, you said it snapped back, and so that short-term risk may be worth the yield. Yeah.
And the yield is what you're after. If you're looking for income, if you're looking for stability, not the best place to find stability. Here's one. The media reports the stock market remains overvalued in spite of the recent crash. For what reasons would I want to buy now if the market is expected to drop even more? This, of course, is the biggest test of all, I think, for investors who think about investing and try to make sense of it. Any advice, Daryl, to people who are trying to time the market?
Well, I don't try to time the market. I find an asset allocation that works for me, and I pretty much stick with it and let it ride it out. I look at it every once in a while to see if I've broken any of my rebalancing bands, but because that's the approach I use to rebalance. But I try to tune out the noise from the media with respect to market, what you should or shouldn't do in the market, and why the market does whatever it does. I think Paul used to have an interesting article, I think it was, or talk about how there are 10 reasons why you should sell now and 10 reasons why you should buy now. So, you can find whichever side you happen to think you want to be on and find confirmation of that particular point of view. So
when you were
anybody knows,
when you were an accumulator, you just every month putting money in, and now you're taking distributions, you're in retirement. Have you had to change the timing of things in any way?
No, I'm not quite sure I understand what you mean by timing.
Take a certain amount of money at a certain time, regardless of whether the market's up or down. It's just the opposite of being an automatic investor, but now you're taking it out instead of putting it in.
Well, actually, the way we actually do it is we take it when we need it. We sort of, the way we manage it is we have our checking account, if you will. We pay our daily expenses from, our living expenses from, and as it goes down and breaks below a threshold where we feel comfortable, we'll take some out of our investments, wherever it happens to be needed to be taken from, and refill the checking account.
And is that an actual checking account, or is it a?
Yeah, well, it turns out it is, yeah, but it's the one that we use to pay all our bills. We don't use too many real checks anymore, but yeah, it's a checking account.
Anything to add there, Chris?
No, I think you covered it well. Oh, well, actually, I do have one thing to add, and that's that I know that the research says the less you look at your accounts, the better you'll do as an investor. I don't do as good a job of not looking as I would like, but when the market is full of fear, I look less. So I honestly couldn't tell you how much our accounts were off during the worst part of the year, because I knew that our investing policy statement says we're not going to panic sell. I wasn't going to do anything about it, and it wasn't going to bring me any comfort to look. So when the markets were most fearful early in the year, I probably went weeks, if not a month plus, where I never even looked at our accounts, and that's part of how I manage the discipline of being a buy and hold investor. Is I try to ignore the fear part, and look away, much like Daryl said, ignore the noise. I know I can't time the market. I can't get in at just the right time and get out at just the right time. So why even think about it? Yeah.
And I think it ties into the rebalancing process too. In fact, in some ways, rebalancing is more difficult because it means you're going to take something that's been making you feel good, and you're going to put it in something that's been making other people, maybe even you, feel bad, and that's what rebalancing is about. And so it's again another one of those emotional challenges that keep people from being the best they might be. So,
yep.
Okay. Is there, and I think this question has to do with the four fund strategy, is there a reason REITs would not be part of the strategy? Real estate is an asset class to help add diversification. So it's an interesting decision. Daryl, you want to talk about the pros and cons of adding REITs to the four fund strategy?
I haven't really thought about adding REITs to the four fund a lot. I sort of like the simplicity of the four funds. I understand the diversification point of view. I like the simplicity of it the way it is now. If you start adding REITs for diversification, then you have to ask yourself, well, why don't you add international, and why don't you add emerging markets? And I think I like the four funds. Seems to be, to me, it's kind of a qualitative thing, not quantitative, but it seems to be something that I think the average investor can manage fairly well. It's not a logical argument. It's not backed up by
Daryl,
science.
Isn't there a pragmatic argument too? Isn't part of the reason that the four fund solution is the funds that it is just the available history we have?
Well, that's how it started out. We went back. Yeah. We were able to go back 92 years with the four U.S. asset classes, and we can't do that with. He says, I don't think we can do that.
I started to say that if you look at the ultimate buy and hold strategy at the returns, that when you add REITs on top of the other four asset classes that are in the four fund strategy, the difference in return is very, very small. And so my sense is that it may be some good diversification, but not likely. Because remember, the minute you put those REITs in there, you take out of the small cap value, you take out of the large cap value, and that may actually set you behind a bit. Okay. When do you think you'll be updating the best-in-class ETFs for the ultimate buy and hold? And Chris, obviously this is yours. I know you've answered it before, but we get this so often. I guess when you answer this, will you tell people why you're not doing it every year or every month or whatever short period they would like to see us do?
So the short answer is 2021, early 2021, if not late 2020, we will do an update. The longer answer is, if I saw some information that said it needed to be updated sooner, I would. But I don't want to do it too often, because I don't want people to be trading unnecessarily. I don't want people to be taking short-term gains just to switch funds. And when you look at how these funds have done, if you look at the old best in class versus the current best in class, the differences are very small. It's not a, you're talking about tenths of a percent kind of change, because we're not changing asset classes fundamentally. We're just changing the fund choices. Our goal is to get you that extra tenth of a percent, right? To get you that extra 0.2%. That's why we put so much work into it. But if you were sitting on some cash and saying, gee, I'm waiting for the 2020 best-in-class ETFs to come out before I invest, I'd say you're making a mistake. You should invest in the best answer you have today, and then we'll make it better when we can. Another reason, the final reason I'll give for waiting, is that the analysis really hinges, at least in part, on the historical performance of the funds. Do they do what they say they're going to do? And the only way for me to know that for sure is to run a regression, and I need a lot of history to do that, because I want to look and see, when small was doing well, did the fund that says it's small do well, right? When value was doing well, did the fund that says it's value do well? And that's how I can figure out whether or not they're second guessing the asset class and doing weird things under the hood, or are they actually being true to their mandate? And so it takes time for that information to accumulate. I think by the end of this year, we'll have enough information to do a good analysis, and also to take a look at the new Avantis funds, which there's a lot of interest in those, but they haven't been around a year. So I don't have much history on them, but we'll give them a fair evaluation and consideration, and they'll be part of our decision process for the next go around.
Great. Is the 4-fund strategy appropriate for a 60-year-old investor? Daryl, what do you think?
Yeah, I'd say sure. If it's a strategy that you find intriguing, or something you understand and you think you can stick with, I'd say sure, go ahead. The one thing I would remember is that the 4-fund strategy is for the equity part of your portfolio. You still need to have a fixed income part of your portfolio to provide your downside risk, if you will, part of your portfolio, your asset allocation. So if you have a 50-50 stocks, 50% fixed income, the 50% that's stocks would be allocated across the four funds equally. So you'd have 12.5% in each of the 4 equity asset classes in the 4-fund portfolio. And then that's what you would manage your rebalancing to.
So when you're getting to be 60 or 70, and you start to be thinking that you're not as long-term an investor as you once were, and a lot of people will look at our tables and they'll say, I don't have 50 years to live, or I don't have 40 years to live. We know, as we look backwards over the last 90 years, that the 4-fund strategy was in essence less risky 1 decade at a time, in terms of the return. The S&P fell out of bed several times when the 4-fund strategy did fine. So if we conclude that over a 10-year period that the 4-fund strategy was likely to make more money than the S&P 500, as an example, and in a sense be less volatile when we look at the 10-year return, would the decision we'd have to make be, this part of my investment is for the long term, as opposed to this is my money that I'm using to get my income today? Would you differentiate, if you were going to decide to add the 4 funds, to whether it was part of the portfolio that was longer term versus part of the portfolio that was shorter term? Would that make any difference?
I think it depends on how you think about your portfolio. If you manage your portfolio and you treat your portfolio on a total return basis, I don't think it makes a difference.
Mhm.
If you tend to think of it in terms of buckets, helps you with your mental accounting of how you see your portfolio, then sure. If you could think about it in some respects, it's a little bit like Bill Bernstein's liability managed portfolio, where you have fixed income assets, let's say, or safer assets that you use to provide your day-to-day expenses, and then you have a risk portfolio. Yeah. where you don't need it to live on to provide your day-to-day living expenses, so you can do more risky things, if you want to think of it that way. With that,
it's great.
We use a total return perspective. So if I were to choose to do that, that's what I would do. If I wanted to use a bucket or type of a strategy, and not the way Christine Benz talks about buckets, but if I wanted to bucket it in terms of safe versus risky, then I would take the risk part of that portfolio and use it that way.
And Chris, would you add anything to that?
Just that, I agree with Daryl that you need to figure out what your ratio of equity to bonds is. And in my mind, there's two ways to do it. One way is, what can you sleep with at night in terms of the drawdown you're willing to tolerate? And that's where the fine tuning tables do a great job of setting expectations. And then the other way is the bucket strategy, along the lines of what Daryl mentioned with Christine Benz's perspective of, what do you need for your next 5 to 7 years? That money should be invested more safely than the money you need beyond that, right? And so for people who've oversaved by a lot, sometimes that's a useful alternative perspective in terms of thinking about how they might decide how much to have in fixed income or equity. But both approaches are valid, and they'll have different appeals to different people, right? There's people who've oversaved a lot who really could not sleep with the idea of their balance declining by more than 25%. For them, the bucket strategy is not appropriate. For them, the fine tuning tables are perfect, right? So you got to figure out how you're motivated, what makes you tick, and which of those two approaches is going to let you sleep at night.
Great. Thank you. If target funds are funds of funds, does that mean they have two sets of fees? And Chris, I think you had done a little work on this to see what the story is.
We did a little pre-work, and you guys helped out. So let's see if I can share this, and we'll try and make it so the people who are on the podcast don't miss out. Can you guys see this?
Yep.
All right, cool. So what I did is I went out and I looked at one of the target date funds at Vanguard, the Vanguard 2030 Target Retirement Fund. And it has a mutual fund expense ratio of 0.14%. If you read on their website, they'll tell you that is better than 60 to 80% of the funds out there, right? That they're among the leaders in terms of being the lowest cost. And then if you look farther down the page, it'll tell you that that fund is actually made up of 4 funds. It's made up of the Vanguard Total Stock Market Index, the Vanguard Total International Stock Index, the Vanguard Total Bond Market, and the Vanguard Total International Bond Index. And there are varying percentages. It's 41% in the Total Stock Market Index, 27% in the Total International Stock, 22% in the Total Bond Market, and 9.6% in the Total International Bond Market. So if we go and we look at the expense ratios of each of those mutual funds and then do a weighted sum of that's over here, this column it's basically the percentage times, or the percentage of the fund times the expense ratio. That gives you this total over here that I add up, and you add all of those up. What you find out is that the weighted investor mutual fund expenses, those are the funds they say they use, is practically the same. It's 0.136%, which rounded to the 2 decimals they use for the fund is 0.14%. So at that point, it looks like this fund of funds is the same price as the underlying funds. And, I stopped there last night and said, we're done, that's it. And then I woke up this morning and I thought, wait a minute, what about ETFs? What about Admiral shares? Could you do this cheaper? And the answer is yes. So I went and I collected the ETF share weighted out average expenses, and that comes out to, instead of 0.14%, it's 0.05%, 0.0496, but round it to 0.05%. So 0.05% versus 0.14%, it's 0.9% difference. It's almost 10 basis points. And if you do the same thing for the Admiral shares, it's 0.068%. So it looks like, and people had asked this question before, it looks like you could do a DIY version of the Vanguard Target Retirement Fund for less money with ETFs or Admiral shares. But keep in mind, now you're going to have to do the rebalancing. You're going to have to do the purchases. If you're working with the ETFs, unless you're at some place that supports fractional shares, you're going to have to deal with the individual share purchases. So it's kind of up to you whether it would be worth the difference. But there is a difference, and I was surprised to see that.
All right, and I see here the next question is one that I think you're going to take on because you did a little research, and that is, when you say Vanguard is investor owned, what does that mean?
Yeah, if you go and Google Vanguard mutualized, or what does it mean that Vanguard is a mutualized fund, you'll find a pretty simple answer, but it's very telling. And if you compare it to other companies in the space, you'll quickly find an important difference, right? So Vanguard is literally owned by the people that own their shares, right? So the shareholders in the company Vanguard are the people that own Vanguard Target Retirement shares, or Vanguard Mutual Fund shares, or Vanguard ETF shares. Those are the owners of the company. Where if you went to Invesco, for example, they're owned by shareholders. That company has shareholders looking over their shoulder expecting a profit, right? So you can imagine that the management of these two different companies have very different conversations. In the case of a privately owned or public company that is in the business of creating these shares, they have to deliver a profit, right? So they're trying to figure out how to serve their customers, but they're weighing that against the need to also deliver a profit to their shareholders. Vanguard, in contrast, doesn't have this third party. They don't have another group of people they have to pay. So their entire motivation is to give their shareholders and customers, which are one and the same, the best return possible. There's no conflict of interest. There's no third party, and it's part of the genius of Jack Bogle that he figured out that was the right way to create an investing company. And we should all be very grateful to him for having set that up, because it has driven competition in the space that we never would have seen, right? It's made all of the public companies have to behave a little bit better and deliver a higher value for the same price to compete. So Vanguard's mutualized structure is wonderful. Yeah.
And it shows up, according to reports, in his final estate, because he was supposedly worth $80 to $90 million. If you look at the competition who worked for a profit for themselves, that might be the Fidelity family, the Johnson family. Mm-hmm. And they're worth billions and billions of dollars. And which meant basically that money ended up in the pockets of the Vanguard shareholders instead of people like John Bogle. So by the way, he did not struggle. $80 million to $90 million is pretty sizable size estate. So, but it certainly helps shareholders. Okay. Here's one. Is the comeback portfolio the same as the 4-fund combo? I'll do this one. It's so easy. Yes, it is the same. And the reason it got tagged with the title, the comeback portfolio, is because I was looking at putting together an article that talked about how do you invest to take advantage of what happens after a typical bear market. And it turns out that value historically has had a huge run from the bottom of the market. All value is a hard thing for people to do. But if you did the simple comeback or 4-fund portfolio, you can see that at least historically, it had a very strong recovery after a big bear market. Now, Daryl, I saw that look of surprise. Did you have
I'd never
another
heard of the comeback portfolio.
Oh, I see. Okay.
So I'm glad you took this one.
Anyway, that's the comeback portfolio. And we will see how it comes back as this market recovers. Could you use a target date fund plus 4-fund combo as a strategy? How would that strategy likely perform compared, let's say, to the 2-fund portfolio, that 2 funds for life, where you're using the small cap value? What would the expectation be approximately in terms of the difference in return? Anybody want to hammer on that one?
I'll take that one. The difference is going to be less tilt towards small, less tilt towards value, right? So that means you're going to have less of an expected premium, but you're still going to get the market risk factor. You're going to have more, you're going to get more tilt towards equity. So the fact, like for an earlier investor in a target date fund, if they're in their young years and they're trying to offset that 10% fixed income burden that tends to be in the target date fund, anything you add in equities is going to help offset the fixed income with a little bit of added risk and added expected return. So, how much of a difference is it going to make? Instead of being all small cap value, you're now only 25% small cap value, you're 50% value. So it might reduce those premiums by a half to, a little bit more. So you're going to give up 1% or 2% during those years. So, without running the numbers, I can't give a precise answer, but even if I gave you a precise answer after running the numbers, I'd have to caveat it by saying, they're not guaranteed and there's a wide range. So I'd say it's on the order of 1% or 2%, probably. I don't know, Gerald, do you have an instinct or a feel for that would be better?
Yeah, when I looked at this, I thought, well, okay, so you're going from a 1-fund portfolio to a 4 or 5-fund portfolio. So you've made your life a little more complex to manage it and follow the glide path. But on the other hand, one of the things that if I was thinking about doing this, adding the 4-fund to a target date fund, I think I would not include the US large cap blend part of the 4-fund because it's already in the target date fund. A pretty good chunk of the allocation is to the total US stock market in most target date funds. And so I would change it to, I would just include the large cap value, small cap blend, and small cap value and split that allocation 1/3, 1/3, 1/3. Because the large cap blend is in the target date.
Got it.
And we did model in the article, if you go back and look at some of the presentations and articles we've done, we've modeled, for example, doing all value, doing the large value and the small value. So you can probably get a feel for, and we also modeled, I think, in the Choose FI slide deck, doing S&P 500. So if you go and look at the article and the slides that we did for Choose FI, and you can probably start to triangulate and figure out, where the numbers say it would land. Again, no guarantees the future will be like the past, but it helps set expectations.
Here's an easy one. Is the target date fund based on retirement age or your life expectancy? I thought that was an interesting way to think about a target date fund. But there may be people who don't know how those target date funds work. Chris, you're the target
The
date
number
fund
on the target, yeah, the number on the target date fund is supposed to correlate with the year in which you retire. Part of the reason there may be a question here is that when you go to Vanguard, on the page where they have the target retirement funds, they give you a choice either to use age or the year in which you would retire. And the age links sometimes take you to something other than a target retirement fund. Because if you were born in the 1940s and you're on their target retirement fund page, they may feel like they have a better solution for you, right? But yeah, the target retirement fund date, if it says target retirement 2040, that's the year in which you're supposed to retire. That's the theory. Some people game it. Some people, I have a friend who does something I find fascinating. He wants maximum diversification, and he doesn't know when he's going to retire, so he buys a whole bunch of different target retirement funds in his retirement account, right? Which is, he thinks it's giving him diversification and it's hedging his bet because he doesn't know the year in which he's going to retire. The truth is, you average those things together and he's getting the retirement fund that's in the middle, right? It really isn't, it's just complexity, but people do that. So it's kind of an interesting thing. Yeah.
The other thing is that if you buy a target retirement or target date fund, most of them, and you base it on your retirement age, most of them, when they get to that point or shortly thereafter, they sort of level out on a not some sort of a nominal asset allocation, kind of maintain it afterwards. So that ends up being the life expectancy part of that. They manage it at a reasonably constant, most of them reasonably constant asset allocation after your retirement date. So you can sort of play those games. If you want to not reach a constant allocation until age 70, then pretend you're retired at 70 rather than 60 and pick your target date fund that way. So you can game it that way also, as Chris says.
And it makes a difference what target date fund you use. At BlackRock, at my age, I believe it's 40% equity. At Vanguard, it's 30% equity, and I'm 50% equity. So there are a lot of legitimate choices. Given that small caps may struggle for the foreseeable future due to the recent pandemic, digging deep to explain all these things here, should one focus more on large caps? Or is this the time to rebalance more heavily towards small caps as it is selling at a larger discount? So this begs a question, one, of market timing, but two, when do you rebalance? So I suspect you both have slightly different answers. Chris, what would you do in terms of the rebalance decision?
I'm very hesitant to ever think I know anything about the future. So I really like the idea of hedging my bet by spreading it out. So I like dollar cost averaging, and I like sticking to my policy statement, which is an allocation, right? Mm-hmm. So, anytime I catch myself thinking, oh, now is the time to do X, Y, Z, I remember a few different things. And one of them is that you don't have to, A, how confident are you in that decision? And it's usually pretty low, and B, how much of that decision do I have to make today, right? And the answer is none, but I could do a little bit, right? So if I ever catch myself thinking about a market timing like that, I usually look and see if it's consistent with my rebalancing needs, right? So let's say small cap value has been hammered. Well, odds are that small cap value or small in this case, you know, I think that's the question, is small, is going to be a smaller part of my portfolio, right? Because it's probably down. And so from a strict rebalancing standpoint, it's going to make sense to sell something that's more appreciated and move it into that asset class. So that's fine. Now, is today the day to do it? Well, if I find that's a market timing question, right? So rather than doing it all today, I might just say, well, it looks like I got to move, you know, let's say it's 5% to rebalance this. That would be big, but let's say it's 5%. Well, I could move 1% today, and then I could move 1% next week. And then I could look and see if it still makes sense and move 1% the following week. And that gives me the ability to avoid the regret of having done it at, you know, the wrong time, right? Because one of those times is going to be good. One of those times is going to be bad. A couple of them are going to be in the middle. And at the end of the day, I'm going to say I was prudent, right? And that's really what I want for my personal finances. I want to be prudent. And so spreading it out, making it consistent with my investing policy statement and trying to rebalance, that's what I would do. And all of those things really don't have to do with the status of the market at the moment. I mean, they kind of do, because the rebalance is going to depend on where things are, but I'm not making a crystal ball judgment about, is today the day? You know, is today the day when I should really move everything into this other asset class? So that's how I do it. I keep the moves small and try and keep it consistent with my investing policy statement. How about you, Daryl?
I rebalance based on rebalancing bands. I don't look at any financial media to help me make a decision. I do look at my portfolio every week, but lived through several bear and survived them all. It doesn't bother me anymore to watch it go up and down like that. And so I look at it every week. If it looks like it's moved quite a bit, I'll go to have where I can go check and see what the asset allocation is and whether I need to rebalance, and if so, how I do that. But I use rebalancing bands, not time-based rebalancing. So I do need to check it every once in a while, but you'd be surprised how far the market has to move to break a 5% rebalancing band when your asset allocation is 50-50. It's a long ways. And so I hardly ever have to end up doing that. But if I did, I would look at which asset classes are underrepresented and move money into those. If it's small cap, it's small cap.
Terrific. So those are two very different answers. My answer is somebody does it for me. That's about as automated as I know how, but they work with bands. And they may be very similar to the bands that you personally have chosen, Daryl, but I don't want to be any part of that process, but I do want it to be done mechanically. And I would struggle. If I were doing it, I would do it probably once a year. And because it does take a lot to things to get 50-50 as we are too. It does take a lot to get that out of balance, but I would have used once a year to get the emotion out of it. But I notice, particularly with tax loss harvesting and whatnot, that an advisor will move in and take advantage of those opportunities, but I probably personally would not. Oh, if any of these scenarios in retirement, are you withdrawing cash to cover all? This is referring to where we talked about taking money out of the portfolio. Are you withdrawing cash to cover 2 to 3 years, or expenses, or simply drawing cash for the current year? In other words, when you take cash out, are you taking it for just the current year, or are you looking at a longer period of time so you don't have to be concerned about having access to cash while the market is in decline? I assume is what that question is about. So, Daryl, why don't you pick up one?
Well, so there are several different ways to look at this, right? There's what do I do, or what do we do, my wife and I. And I already talked about that earlier, where we just take it when we need it on a total return basis. The other thing is what are the distribution tables that we publish show? What are they based on? And I can tell you that those are based on yearly distributions at the first of the year, to sort of go through and provide a framework for how we build those distribution tables. I forgot what the other question was, Paul. What was the other part of that?
Well, it's basically the question: do you just take care of a year? Do you take care of multiple years? So,
well, the distribution tables are depending on the methodology set up behind them. They take that whole annual amount once a year at the beginning of the year. In my own personal portfolio, I'm not quite as rigorous because I don't take a distribution until our account that we pay our expenses out of reaches some minimum lower level below which we would start to feel uncomfortable. I refill it up to a level where I won't feel uncomfortable, probably for another 6 months to a year, probably. So that's,
yeah. Chris?
But it's a ballpark estimate because you really don't know what your expense, I mean, we don't anyway, really know exactly how much our expenses are going to be over the next 6 months, for example.
I think the phrase you said in there is that stuck with me is what you'll be comfortable with. When we have the conversation here in the, with my wife and I, and we're trying to figure it out, that drives the amount. I know intellectually that the longer I leave it in the market, on average, the higher return I'm going to have, right? So the less cash burden we can live with, the better we'll do. But I also know that it makes us collectively nervous if we don't know where that next, we couldn't live month to month. It would make us crazy. Having to sell something every month, or having to, count on the dividends, covering the expenses every month. So you have to figure out what's going to work for you. I think, Paul, you do once a year. We kind of run at about a year buffer probably, but it's not set at a regular time. It's kind of on an as needed basis. When we start to feel like, yeah, we got a lot of expenses coming in, and we should boost the buffer, build it up a little bit more. So we're kind of between the two. Daryl, you said it was as needed, and Paul, you're once a year. We're kind of between the two.
When I was an advisor, it was not unusual to have people who were very conservative. And what we would decide to do is to have 1 year of cash, money market, and another year of short-term bond fund. And that when they got down to where the cash was all gone, then they would replenish the cash for a year. That short-term bond fund was there for the emergency, that they might run into a really bad market and not want to dip into the equities in the portfolio that they had. So that was just another way of, it's like the people who take out 3% a year when they could afford to take out 4% a year, or even 5% a year. But what they do to be conservative is just take out 3s. Now, I think we all do these kinds of mental accounting things to make us comfortable with what we have and what we have to worry about.
Well, that's one of the key things is when you're in retirement, I think you have to be able to be a little bit flexible about what you're doing. You have to look at what your needs are, what the situation is, and where your portfolio is when you're trying to figure out how much to take from where. Flexibility is a virtue.
Here's a last question of the day. Something on your mind. I'm intrigued by your 4-fund portfolio. However, my respectful criticism of that portfolio is that it does not have any international exposure. there is a contributor on the Bogleheads forum who has supposedly done a series of back testing and shown that the following combo has an identical long-term return to the ultimate buy and hold portfolio. And what they do is they find a U.S. large cap blend, U.S. small cap value, internet value, and international small cap blend. So they are half international and half U.S., and they are half blend and half value. We are. So I think, Chris, you dug into this, or Daryl, did you? Who dug into this?
We've both dug into it. I'm going to restate, because you were cutting in and out, the portfolio allocation just so that everybody can hear it. So and I think Trev H was the contributor on Bogleheads,
Yes.
and it's a great portfolio. It's 25% U.S. large cap blend, 25% U.S. small cap value, 25% international large cap value, and 25% international small cap value. So if you think
small
of the
cap
four
blend, small cap
or I'm
blend.
sorry, small cap blend, yes. So so if you think about a Morningstar style box, where you got small and value, going on the different dimensions, it's four corners, but the diagonals are U.S. in one direction and international in the other direction. And our back test, I would hesitate to agree with the statement that it does exactly the same as the ultimate buy and hold, but I would say that the ultimate buy and hold, the four fund solution, and the Trev H portfolio are all pretty close when you look at the back test results. And it almost comes down to, first of all, I'm not sure we have enough history to tell you how different they would be, because they're close enough. And then second of all, the real difference is in how diversified they are. And some of that's going to be an emotional thing for an individual investor, right? The Trev H portfolio is half international. So, are you comfortable being half international? The academics say you should be, right? But are you? Right? You have to kind of figure that out for yourself. The four fund is all U.S., which is not as diversified. It's got a higher concentrated risk in U.S. economy. And the ultimate buy and hold is both diversified, it's diversified in even more ways, right? It's got a little bit of emerging markets and REITs. And so it's, I have nothing against the Trev H portfolio. I think it's really good. We have struggled to test it because we have missing asset classes going back to 1970. But Daryl and I are working on that. And Daryl, maybe you want to talk a little bit about what we could do there. I think we would like to do an apples to apples test and be able to come back with some numbers, right?
Yeah, I think it's possible. We can do a test using the same methodology that we use for the ultimate buy and hold. We can go back and look at the four fund combo and the Trev H portfolio, and compare them that way using the same methodology, the same algorithms, the same funds that we use in all the different ones, and we can compare them and see how that turns out. That would be a really interesting comparison. Yeah, it's just a matter of I think of how much diversification of which types you want. The ultimate buy and hold is U.S. international, and within each one of those it's large and small, and within each one of those it's blend and value. Okay, well, Trev H takes the same major asset classes, but he splits them like Chris mentioned along the diagonal, and then the four fund is basically is just U.S. asset classes. So a lot of it has to do with what your internal decisions or biases are in terms of how much diversification of which kind you want, and take a look at it. But it's something we can do to look back the last 50 years and take a look at it and see how they would perform. It'll be an interesting test. I look forward to doing that here in the next little bit, just to see how it turns out.
Well, I appreciate all your time as always. You guys have done a marvelous job helping our readers and listeners uh, do better, I hope, or invest with more confidence. That's part of the process that I think helps make you a successful investor. I hope that if you get a chance to go to YouTube when we get this up, that you will suggest some of your friends take a look and leave comments at the after the presentation. Whether they're good or bad, leave comments. And no, only if they're good, I guess, would be a better deal. But tell people how you felt about that information that you got, whether it was helpful, and share it with family members. I hope you will find ways to tell others about the work that we're doing. So, gentlemen, thank you very much, and we'll hopefully do this again soon. Okay?
Sounds good.
Thanks.
Can you guys still hear me?
I can hear you.
Aha.
Yeah, we can definitely hear you.
I can't believe with as many things
on a
as
plane.
you're doing right now, Daryl, that I've ever been able to get mine to work. I don't understand. Hi, I'm Paul Merriman, and welcome to something new for the Merriman Financial Education Foundation. We have decided, after some recent Zoom broadcasts, that it would be great fun, and we hope will be helpful to you, to do some Zoom Q&A sessions. And who better to do that with than the two guys who were there the day that we recorded, I think it was May 9th, if I'm not mistaken, for Choose FI, and Chris Pedersen, our Director of Research, who is famous now for developing the two funds for life, and Daryl Balls, who is our Director of Analytics. And if you want to know how hard he works, go to Best Advice and start opening up all of those links to table after table after table to try to help you make better investment decisions. So what we've got to work with today is a list of questions that came from those folks that we were so happy to have with us. I think at one point we had over 400 people with us on the Choose FI, and by the way, it would be totally unfair if we didn't mention that joining us there that day was Jennifer Ma, who works with Choose FI, and she did a great job of leading the pack. And for those of you who didn't see it, we will have a link in the notes to this discussion, to that, I think, about 3 hour or almost 3.5 hour Zoom presentation. And by the way, also, a lot of people are not going to be seeing this on a Zoom format, but rather we'll be listening to a podcast. So today we're not going to use a lot of tables that you have to look at. We might use one now and then, but mostly I think people listening will be able to get the value out of this get together as those that are watching us. So what I have in my hand right here is about 25 questions, and I've been tasked by Aisha Griffin, our Director of Marketing, to try to do this in an hour, because she claims that you all get bored if we do this for too long. So we're going to try to get through these in an hour, and we've got a similar get together to respond to the questions that came from the AAII presentation. That, by the way, was on the same day as the Choose FI, and and we'll have a series of these. We want to hear back from you whether you find this helpful. So let me get to work, and I'm going to, by the way, we didn't arrange these questions in any priority. This is kind of as they came from the people who were watching. So let me start with John, who asks, when investing in Vanguard mutual funds, what are the 2 funds for life you recommend? And obviously, the genius behind the 2 funds for life is gonna take us there. Chris, what are the 2 funds?
Well, the 2 funds for life, it starts with a target retirement fund or a target date fund, and then it adds a fund of your choice. And we've modeled several different ones. The classic one is probably a small cap value fund. So if I was working with Vanguard and I was going to go for a target retirement fund, I would go to their website. I'm actually going to just take a quick peek over there, and I would look up, say, the Vanguard Target Retirement Fund for 2050. If I was planning on retiring in 2050, that fund is VF like Frank, IF like Frank, X. And there's different retirement, there's different tickers for the different age windows, right? So you'd pick that fund, and then you would add a small cap value fund like VBR. If you're going to stick with VBR, is actually an ETF, but you could find a mutual fund at Vanguard that would be a small cap value fund as well. Our best in class recommendations are actually ETFs, and they are they're not always Vanguard. So we recommend IJR as small cap blend, or IJS or SLYV as small cap value, for example. So it's really up to you to choose which second fund you're going to add to your target retirement fund. But yeah, that's it. It'd just be a target retirement fund, and then a small cap value or large value, or you pick how much tilt you want, if you will, or how much risk you're willing to take. And we've modeled a lot of that on our website.
Why would they pick small cap value versus small cap blend?
Okay. Well, so small cap value is going to give you historically, more of a tilt towards 2 factors that deliver a premium. And so you've got, if the future looks like the past, you have 2 things. You have a better chance at a higher return, and you also have more diversification in terms of the kind of factors that are working for you, which history says gives you more frequent good performance, and kind of it's a form of diversification, so it's going to reduce some of the volatility. So small value, that's why we start there usually in terms of recommendations. But I encourage people to look at the work that we've done on the website under 2 funds for life, because it comes with some risk, right? Any added return is going to come with a little more risk. So large value isn't going to have as deep a drawdowns typically as small value, and large blend is going to have even less, right? So take a look and see what makes sense for you.
Good. That's great. And here's a question from Bill. How do you see, and he makes reference to a U.S. total market index and a global market index. How do you see their performance going forward? Now, we could easily just say something simple like, we have no idea what the future will bring, or the past is no guarantee of the future. But if you guys had to pick a number for future performance of what is basically, whether it's U.S. or U.S. and international, large cap growth, that's going to be the heavy hitter in those 2 big indexes. How would you see the likely future? Daryl, where would you fall?
I really would have no idea where it would go. I would say that you're so broadly diversified, though, that you're going to capture most of what the world does, the U.S. and the world does in the future that way. And if the world does fine, you'll do fine. if the world doesn't do so fine, it almost doesn't matter what you have. I mean, it's all going to be a little bit rough. So
it is an unknown, but we do know that both of those funds have very little small cap and
right.
and not a whole lot of value. So I would say that while I can't tell you what they will bring in terms of returns, that they will still produce lower rates of return than we would if you up the ante in small and you up the ante in value. But I think if you want to do okay and be comfortable with the fact that you got a bunch of really big companies that you'll probably do well. But it's about a 50, I think 55% of the global is US and about
Right.
45 is international. Well, obviously we don't know the future, right? Here's I find this next question from Rocky very interesting, because this group of people that we were speaking to, those are folks who want to retire early. They want to retire in their 40s or their early 50s. They don't want to wait till they're 60 or 65 to retire. And so Rocky says, for people taking early retirement, how does the current situation affect the sequence of risk returns? And Daryl, tell us about the sequence of risk returns, and what do you think about somebody walking into this market that could easily go down a considerable amount. And then today, by the way, as we're recording this, the market's up about 800 points. So maybe at the end of the day, nobody will care about the downside. But what is this sequence of returns?
Well, sequence of returns risk is with us all the time, whether you see it or not. In the last month or two here, the risk has shown up. And so now is the time when whatever you have done in the past to set up your portfolio, your asset allocation, your glide path, now is when it pays off. So proper asset allocation, fixed income asset allocation, can help you in a time like this and protect you against a downside market. If you're coming into retirement or early in retirement or coming up on retirement, there are several things you can do to help yourself. One of the things you can do is take a look at something that Michael Kitces, who's a financial advisor, has talked about over the last few years, and that's called a bond tent. What he means by that is you actually over allocate to bonds during what he calls the red retirement zone. And that's the 10 years before retirement and the 15 years after. And what you do in that time is you overbalance to bonds. Because the problem is, if you just retired and you go through something like we have now, it takes a big chunk out of your portfolio, and it can have a everlasting impact on your ability to withdraw from that portfolio into the future. Another thing you can do is oversave before you retire. And Paul has mentioned this many times. In effect, what oversaving does is it lowers your withdrawal rate, initial withdrawal rate. And so that's one way to help mitigate the effect of a downturn in the market. You can do other things like delay Social Security if possible. That will make your Social Security fixed income stream larger. You could put together a liability matching portfolio, as Bill Bernstein says, and have your fixed income portfolio to take care of whatever you think you're going to have in the next 5 or 10 years, and put your risk portfolio put your rest of your money in a risk portfolio where you won't necessarily need it. If you really are concerned about it, you could get a short-term single premium immediate annuity, I suppose, to carry you through this period right here. But one of the things is that when things like this happen, is people think, well, this time it's different, so I need to do something different. Well, it's almost never true that it's different. And I don't think it's really different this time either. So if you think about it, to kind of put things in perspective, tough times have happened before. In the in the early part of the last century, boy, that sounds odd to say that way, but in the early part of the last century, in early 1929, if you would have retired, that would have been great. You'd have been in Fat City right then. But what you didn't know was that coming right up on you quick was a huge depression. There were bear markets in the late 30s and late 40s, and a little thing called World War II in the early 40s. So all of those things went through. Your portfolio went through. And even so, with all those things that were there, you could have started taking out 5% inflation adjusted from your portfolio, and for the next 30 years, and you would have had enough money to get you through those 30 years. Similar kind of thing happened in 1966. If you retired in 66, you had market stagnation in the early 70s. You had really debilitating inflation in the late 70s and early 80s. I was there. I lived through it. We used to get 10% raises every 6 months. That doesn't happen anymore, but it was bad. And then you had there were crashes, and there was a big crash in 87 where I think the Dow lost 25% of its value in a day or something like that, Paul. Mm-hmm. You might remember that more than I would.
22.
Yeah, it was interesting at work that day. But even so, the 30 years after that, you could have taken 4% adjusted for inflation for the next 30 years, and you would have survived. Those two examples are examples of things that set rules, withdrawal rules, quote unquote, like the 4% rule of thumb. Were the really bad times are what set those things. Any other year in the 90 years since 1930 or so, you could have taken out more than 4%, much more than 4%, and been fine. Nobody knew that though at the time. But you got a question, Paul?
Yeah, I can just hear these young people in their 40s. I think they're very young, saying, "Yeah, Daryl, I heard you say 30 years, but I may have 50 or I may have 60 years that I need to worry about." Would you have any piece of advice for them?
Well, if you have a longer term retirement, you can lower your withdrawal rate a little bit to begin with, but you don't have to lower it a lot to get to what's called a perpetual withdrawal rate. And that's where at the perpetual withdrawal rate is a withdrawal rate that if you take it out at the end of your time, if you take out 5% or whatever it is, inflation adjusted every year, at the end of your time horizon, whatever it is, if it's 50 years, you have exactly the same number of dollars as you started with. It may not be worth the same because of inflation, but the inflation or the perpetual withdrawal rates, once you get out into time horizons beyond 30 years, 30, 40, 50, even 60 years, are really just a few tenths of a percent less than what they are for the 30-year portfolio. So you could knock 0.5% off and to those 4% rule of thumb, and do 3.5 or 3.3 or something like that if you wanted to be more conservative. On the other hand, if you've oversaved to where you can take that lower rate like that to begin with, then you're in a good situation.
You know, the other thing about oversaving that comes to mind is it gives you the ability to economize when the market's down, right? So if you've oversaved, you might have an ideal withdrawal rate that lets you live the lifestyle you like, but you choose to cut it back in the years when the market's down because you don't want to sell low, so to speak, right? And that flexibility brings a lot of comfort. I know people who've just retired and they're going through this in the market that we're in, and they're basically calm because they're able to live off much less than they plan to live off, and it makes them feel okay about getting through this time. Yeah.
Right. So Chris, could I pin you down on your best guess? How much more do you think somebody should oversave and qualify for this ability to have more peace of mind? I mean, 10%, 20, 50, 100?
Well, if somebody has oversaved by 33%, then that means that they're effectively doing a 3% withdrawal rate, which is really conservative, right? So you've got an extra bucket of money that you can use for the future. So I think, you've said double in the past, and clearly double would be even nicer. But I
Mhm.
think even at 1.5 to 1.25 times what you really need in retirement, that's a huge difference over just having enough. Because if you have just
Right.
enough and the market goes down 20%, now you have 80% of enough, right?
That's right.
Where if you've got 33%, the vast majority of drawdowns aren't going to take you below where you have enough. So I think 33% is kind of a lower bound for me. Yeah.
That's great. Daryl,
The one,
do you want to add anything else?
yeah, I would. Just one thing, as Chris mentioned, I think being able to reduce spending is good, and that's one way to approach it. But I think when people are thinking about retiring and getting into the point to where they're going to have to withdraw uh, funds, make distributions from the retirement portfolio, just like you should have an investment policy statement about how you're going to invest, I believe you should have a withdrawal policy statement about how
Mm-hmm.
you're going to take money out and what you're going to do if things go bad during the time you're trying to do that. Uh, Identify things like what elements of your discretionary spending, as Chris mentioned, economize on living expenses. Maybe you can defer some big expenses. Maybe instead of getting a new car, you decide to fix the one you've got. And if you document those things and put them in writing, then when bad stuff happens, you can go back and read that and say, yeah, I remember when I said that, and yeah, I think that's what I need to do. And one of the key things to remember is that bear markets have almost always been followed by strong strong recoveries in some cases. So being patient and flexible and staying the course will really, really serve you well when it comes time to go through a market like we're going through now.
If you had the right course in the first place.
Right.
And the people I worry about are the people who think they've got it right, but they've got more risk in that portfolio. Well, let me move along. Great work, guys. Here's a question from Dylan. Have your various allocations, referring to the 10 fund and the 4 fund and the 2 funds, are they set up as pies at M1 Finance? And what is the easy way for people to get started at M1? Chris, why don't you take this one, since you put those
Sure.
pies together?
Yeah. So if you go to Paul's website and you look up at the top, there's a little pull down that says M1 and Motif. And if you click on M1 Finance, it will take you to the page that has our pies. And you have to kind of scroll down to the bottom, but down there you'll find a whole bunch of ultimate buy and hold pies, all value, all small cap value. See what else we got in there. We even have some target retirement funds. So we don't have everything, but we have quite a few, and they're good shortcuts to get you started. What M1 does, it's super simple, is once you set up your account, you have the ability to set up an allocation, and you can have lots of these different allocations. That's why they call them pies. Nobody should just have one pie, right? I'd like to have lots of pies in my fridge. So, yeah. But you set up your pie, and once you've set that up, you can set up a rule to have an automatic contribution going in. It could be as little as $10, could be $100, could be monthly, quarterly. And whenever that money comes in, as soon as it's over $10, it will automatically trigger a purchase, and the purchase will go towards the pieces of your pie that are most underrepresented until they're back to the desired allocation. So it's constantly trying to rebalance, if you will, and get you back to your desired allocation. And it's automatic. It's in the background. You literally set this thing up. It's on autopilot and walk away. Now, if you want to, you can go in every year and click a little button to say rebalance and reset everything, and that'll trigger a purchase for the following day. It's free. There's no commissions. So it's really designed for a buy and hold investor who wants to choose the appropriate investing strategy for them and stick with it and be disciplined about ignoring the market ups and downs and just let the money flow in. So it's pretty cool. Yeah, I really like it, and I've pointed a lot of young people at it, and I think one of my nephews is using it, and I have accounts there as well that I use for testing and for setting up our pies, and it's been great. It's super easy to use. Yeah.
And would you just take a second and talk about the partial share purchase and sale?
Oh yeah, it's a really good point. If some of you may have been tripping over the fact that with only $10, I can make a purchase of Paul's ultimate buy and hold portfolio, right? It's got 10 slices and they're all ETFs, and normally you have to buy ETFs a share at a time. But the way M1 does it, they do fractional shares. So if you need a tenth of a share of one, and 1400ths of a share of another, and a third of a share of another, they'll do that for you, which is just super slick, right? So that, because you're not waiting for those chunks of a whole fund, it means that you can achieve your desired allocation much sooner, right? You can achieve your desired allocation with $100 investment or a $200 investment. You don't have to have thousands of dollars.
That's great. All right. Oh, did you want to add anything to that, Daryl?
I think Chris covered it.
Okay, good. Okay, from Nikki, what information on your website should I consult to determine what my distribution between equities and bonds should be? Is there a rule of thumb for specific ages? Well, Daryl, since you put all of these tables, the fine-tuning tables, the distribution tables together, et cetera, what would your guidance be to Nikki about that combination of equities and fixed income?
Well, I think, excuse me, I think the fine tuning tables are a perfect place to start. They're on the website under Best Advice on the homepage at paulmerriman.com. And when you go there, you can see that they have fine tuning tables set up for many, many different portfolios. The S&P 500, the ultimate buy and hold worldwide, the 4-fund combo portfolio. So depending on what kind of portfolio you have, you can look at the fine tuning tables and see what they show. And what they'll show you is that as your asset allocation between fixed income and stocks varies, you can see how your returns vary, how the standard deviation varies, or volatility, how much up and down you'll see in your portfolio over time, what the worst drawdowns were, how much, as Paul likes to say, how much can he guarantee you're going to lose at some point? And all that information is at the bottom of those tables. And so you can get a chance to get a feel for how those things vary, and how much your reward versus risk is for each different type of allocation or portfolio. As far as how should that change as a function of your age, I'm not the expert in that, but to first order, I would think that you kind of following what the splits between a target date fund might be in terms of their fixed income and equity. You can look at what Chris has in the 2 funds for life and sort of see how that changes over time between fixed income and equities. Chris, would you want to expand on that a little bit?
Yeah, I think there's 2 ways for people to figure out their fixed income equity allocation. The first one is the one that you recommended, Daryl, and I think for a lot of people, that's the right place to start. What amount of a drawdown are you willing to tolerate and still be able to sleep at night and not be fretting about your investments, right? That's a hard question to answer, but it's a really important one for investors to answer. And the more experience we have with investing, the easier it is to answer because we've lived through certain
Yep.
things and we know what we can tolerate, right? I think the other way to look at it, and this will tie back to your comment about retirees, is the bucket approach, right? When you invest in equities, you have the chance that in a short period of time, they're going to lose a lot of value. And hopefully in a long period of time, they'll gain it back and more, right? Well, if you have short-term financial commitments, if you're going to buy a house, buy a car, pay for an education, then you'd like to have some money in an emergency fund at the very least, and possibly in a bucket that is more conservatively invested in fixed income because it's less likely to lose its value in the short term, right? So that bucket strategy, as you approach retirement, helps explain why the fixed income allocation goes up. Because up until you retire, your short-term financial needs have largely been met by a paycheck, right? You've had money coming in regularly, but the day you retire, you're on the hook, not just for, the next month, but for the next year, the next 2 years, right? And so right at that point in time, it's really good for people to be thinking, well, how much money do I need in the year or the 2 years or the 3 years? And like Paul, I think you go to a short-term fixed income fund with the money that you're going to use for the entire next year, right? Every year. And you have another fixed income bucket that's quite large that would probably meet your needs for 7 to 10 years, right?
Right.
And then you have your equities, which are longer term. So I think either strategy works, but especially for oversavers, that bucket strategy can help rationalize things once they're nearing retirement, because they at that point in time, they should have a pretty good handle on what their behavioral capabilities are for tolerating a downturn. And so they could look at it that way. But then if they've oversaved, they may have money that's for next generation and they want to put that more at risk and invest it, that may be a larger percentage than traditionally would go into fixed income because they're oversavers. So I think both strategies are helpful, both the kind of the psychological strategy of looking at the drawdowns and the fine tuning tables and the bucket strategy.
And I think for a lot of people, our work is basically about helping do-it-yourself investors.
Mm-hmm.
On the other hand, even do-it-yourself investors on this topic might want to sit with a professional for an hour or two, not just to find the answer for one part of the couple, but to find the right answer for both people, because very often they have different levels of ideas of how much we should spend and how much we should save and how much risk we're willing to take. John has
Hey, Paul, before you go on to John, can we go back up to Jack? We had that question from Jack up there that I was really interested in answering.
Oh, yes. Thank you. No, it was such a short question. I missed it. Yeah, absolutely. I love this question. Jack asks, what would have been the difference in returns for the 2-fund portfolio versus the 10-fund portfolio? And you might want to just take a second and talk about how those two are constructed.
Yeah. So let's see. I'm going to assume that the 2-fund portfolio he's talking about here is 2 funds for life, because I get that question all the time.
Yep.
So 2 funds for life is where we combine a target date fund with a second fund, traditionally small cap value, that is scaled with age so that it effectively goes to 0 around when you retire. But it's much, much higher when you're young. And the algorithm we usually start with, or the equation is 1.5 times your age goes into the target date fund and the rest goes into small cap value. So at the age of 20, 1.5 times your age would be 30% going into the target date fund and 70% going into small cap value. And so it's kind of, that one's hard to back test because you have to try a whole bunch of different times and retirement ages in combination. And you can read on the website how we do it. But I've recently been working on an apples to apples comparison where I back test the 10 funds, the ultimate buy and hold, which is 10 equal slices of large cap blend, large cap value, small cap blend, small cap value, REITs, emerging markets, large cap, and then international, all the same ones as the US, right? And I think if I do a quick share here, let's see if I can pull this off. Gotta come back over here. I can give you a sneak peek at that analysis. Let's see if this works.
Got my attention.
All right, share. So are you seeing this?
Yep.
All right, cool.
Oh,
so this is preliminary work. It's kind of, like I said, it's a sneak peek. But the way I came at the question was to say, what amount of fixed income or bonds would I need to have in the ultimate buy and hold portfolio to deliver about the same expected outcome as you would get out of a 2-fund for life strategy? And for those of you watching the video, this is kind of a complex picture, so I'll jump to the answer first, and then I'll come back and talk about what you can see in the picture. So if you invested $10,000 per year on a monthly basis, so that's about $833 a month, and you increased it with inflation, and you did that for 40 years, starting at age 25, retiring at 65, using that 2-fund for life strategy, the median end balance is about $2.5 million in that's real. That's a real end balance. So it's what you'd have in spending power, not an inflated number. And if I do the same thing, but I do it with the ultimate buy and hold with 70-30, 70% in stocks and 30% in bonds, it comes out right at about the same amount, $2.4 million. We'll just call it close enough, $2.4 million. So basically what that says is, not surprisingly, because the target date fund has fixed income in it, and that's going up with time, it wouldn't deliver as much return over the long haul as an all equity ultimate buy and hold would, or at least it wouldn't historically. But if you have this 70% equity, 30% fixed income, they end up at about the same place. But there are some differences, right? So the ultimate buy and hold doesn't change the allocation over time, which means you go up to about a 40 to 43% drawdown, worst case drawdown, that you might experience at any point in time. And that goes all the way through to retirement, where instead, if you look at the 2-fund for life strategy, it goes to a higher peak drawdown amount of about 52%. But by the time you're at retirement, it's down to about 33%. So that's the advantage of a target retirement fund or any 2-fund for life strategy, is that it's risk managed, right? You have this risk declining with age. There's some other interesting things on this chart, like the percentage of time that you spend hitting new highs versus time in drawdown. And the target date approach with the 2 funds for life is hitting new highs about 30% of the total experience. And the ultimate buy and hold is actually hitting new highs about 44% of the time. So that's a little bit better, And if you don't care about the fact that you're going to have a higher risk entering retirement, maybe that's an okay approach for you, right? So for those of you watching the video, this is a sneak peek at stuff to come. I'm not going to explain the rest of the chart because it's all preliminary, but there'll be more of this. If you have any comments for me about what you like or don't like about it, I'd love to hear, because I'm still working on it. So does that answer the question, Paul?
That's great, Chris. I think that I have lots of questions, but that's to do in private. I mean, this is really exciting stuff, I think. And there are a lot of people who use the 10-fund strategy. The question is there a way to attach a glide path fixed income along with that 10-fund strategy that would be similar to attaching?
Well, we did that, right? We effectively did that in the Merriman aggressive target retirement,
Yes,
the target
exactly.
date fund, right?
Exactly.
So if somebody wants to be ultimate, 100% DIY on their target retirement fund, and they want to tilt more towards small in value in the early years, and maybe they want a different US versus international allocation, they even want to control that. We have on our website the calculators that'll let you set that all up.
Yes.
So if somebody wants the ultimate target retirement fund or target date fund, we have the article and the calculator for it.
That's great. Okay, back here to how much of your portfolio in international stocks. This is the one I thought would only take a second. I will tell you that the academics would probably vote as a group for something close to 50-50.
Yep.
I think that's uncomfortable for a lot of people who are U.S. investors. And so we have shown results in all of the tables that that Daryl has put together. I'm talking about both at the fine-tuning level as well as at the distribution level, with the variety of combinations of fixed income and these equities. Those are all done both 50-50 and 70-30, 70 US, 30 fixed, 30 international. And so you can at least see, by the way, not too much difference in the return, a little more money if you're 50-50, but it also comes in some ways with another level of risk, and that's your risk of having the ability to stay the course over those times that internationals are lagging the US. Okay, here is one from, and if anybody wanted to weigh in there, now's your chance. Well, what are you, Chris? What's your combination in your own portfolio, if you don't mind me putting you on the spot? What is the equity allocation? How much US, how much international?
We have in our policy statement a goal of being between 20 and 30% international.
Mm-hmm.
And that was driven by a balance of me explaining the academic recommendations to my wife and her explaining her US centric biases to me.
Yep, that's great.
You have to compromise. You have to reach a point that you both can be comfortable with it, right?
Yes.
So yeah, we're between 20 and 30%, and that's in our policy statement. And when we rebalance every year, it's actually closer to every year or two. A lot of times I'm too busy with you to rebalance, which is okay.
Okay, that's great. And Daryl, what about you? What's the real life portfolio that you use?
We're about 60 US, 40 international.
Yeah.
The one thing that if you're going to choose to not invest in international or not invest or invest predominantly in US, I think the one thing to be considerate of or to consider is how much of why you're doing that is a home country bias or a confirmation bias of what your preconceived notions might be. Not to say anything about your wife, Chris, but
well, actually, she brought up two things. She brought up home country bias, which is definitely true, but she also brought up currency concerns.
Exactly. Yes, that's true. I was just going to get there. You're right. That is a concern. Yeah. But the home country bias is an example of what some people might think of as a behavioral finance error. Because even New Zealanders think that they're going to do better than the rest of the world. Okay, and so they invest much more in their own country than they do in the rest of the world.
Well, and the counter argument I brought to the table was I think the most powerful one is this idea that you want to avoid single points of failure, right, in any design. Right. You and I are both engineers, so that's a little geek speak. But if you tilt very heavily towards the United States, as good as our history has been, you can look at other countries where everything went south in one country for a period of time, and 90% plus of the equity, sometimes even 100% was lost, right? And so by diversifying internationally, at least you guard against that, right? You guard against that.
Yeah, the
that
classic
single
one,
point failure.
classic example of that recently is Japan.
Yeah.
Right.
Yep.
So.
Okay. We are 50-50. And by the way, I don't know whether I properly included my wife in that decision. So I've got to go back and review the notes. But you inspire me. Okay, from Terry. What are your thoughts on small cap value going forward? Terry adds, I fear total stock market index is too growth cap weighted, looking at a 20-year horizon. And in terms of risk and volatility, I think when you discuss, and Chris, I'm going to throw this one to you. What your feelings about small cap value for the future, and not just the next year or two, but the next 20 years?
Well, the academics would say, and the history that they rely on says that small cap value is likely to outperform if you can invest with discipline and endure some periods of underperformance.
Mm-hmm.
And I haven't seen anything to say that that's not the case. I think it's important, though, that you also believe in the rationale for any investment strategy. And for me, the way I like to think about small cap value is in terms of a forest, right? So if I was a forester and I was growing lumber, and I walked into a forest and somebody said, you can have a part of this forest, you can own part of it. Would you like to own these, a few big trees that are here in the middle for the next 50 years? Or would you like to own a bunch of these little trees that are around the edge that this other guy just got tired of, and didn't want to hold? It's easy for me to see that the little trees are going to grow faster, right?
Mm-hmm.
It's easy for me to see that the things that are recently out of favor have a chance of coming back into favor. But I think that's, it's important that you figure out a way to believe in a philosophy. And I believe in that philosophy. I think if I buy things that are cheaply priced today, I'm going to do better than buying the ones that are high priced. And I think if I buy things that are small and not spending too much, right, which is the small cap growth is spending too much, right, but companies that are really giving it a good shot and are small, that I'm going to do better in the future. They got a better chance to get big than something that's already big. So I believe in the philosophy, and that's going to give me the ability to stick with it when times are hard.
Yeah.
So I feel good about its long-term prospects, but I also don't fool myself to think that it's going to be easy. I feel like I'm going to have to earn the return that comes from that tilt by tolerating periods of underperformance.
So if you thought about your kids, you'd be more comfortable with them having more in small cap value than you do?
For the first investments of all of my children, I put them 100% in small cap value, and then sat them down and had a long conversation about why this might be hard, but why it would be worthwhile.
Terrific.
And some of my nephews also invested in small cap value. And I still remember getting the phone call about a year and a half later of, hey, wait a minute, I would have done better in the S&P 500. I'm thinking about trading out of small cap value, and having to have a follow-up conversation about, well, if you want the returns of large cap blend, if you want the returns of the S&P 500, you should invest in the S&P 500. And I think at least one of my nephews has diversified as a result of that. And that's okay. That's okay, right? It'll be what he can live with.
If they're good savers, that at that age is the big deal. And then get them in equities.
Yeah.
Daryl, would you add anything on that one?
The only thing I would add is that if someone is considering small cap value, that they realize that they may have to wait for it, like Chris said. But a good way to see how you have been rewarded in the past for being patient is to go take a look on Paul's site under 90 years of performance. It's under the best advice tab or drop down on the homepage, and take a look at the tables 4 and 6, I think they are, for the 15 and 20-year periods, and see how small cap value did compared to the other 4 major asset classes, and also compared to the 4-fund combo for that matter. But you know, you need to be careful, because like Larry Swedroe is fond of saying, you know, you should never take more risk than you have the ability, the willingness, or the need to take. So if you have the ability and the willingness and don't need the outperformance to live in retirement, you don't need it to show up necessarily, then go for it.
Yeah, terrific. Jessica says, you mentioned the impact of setting aside $1 a day for a child early on. Where is the best place to be doing this? And then a question mark after 529s, Uniform Trust to Minors Act, or the Bank of Mom. I like that. Well, I'll take this one briefly, because this is something I have had so much fun sharing with parents and grandparents and motivating many of them to take this step. What I have recommended, if I had to recommend one thing, if the money is for the long term, I mean, that if it's you're putting money away for a newborn child, for example, and the idea is to have it not only accumulate and be worth something when they're going to college, but you're thinking beyond college. You're thinking about, what about the possibility of something to where maybe they want to buy a house? But what if you want to go beyond the house? What if you want to go to retirement? Because I think about what young people today are going to have to do to have enough money to retire on, given what little we know about the past and the impact, for example, of inflation. So the strategy that I would recommend is the money goes into an account, could be $1 a day, but I would do it with a check every year for 365. And then what I would do is I'd put that money into an asset class that is likely over the next, well, let's say in essence, all the years of getting to the point of retirement, but I would start with small cap value. And every year you would do that, put that 365 away into a small cap value fund in your name, not in that child's name, because I want you to maintain control of that money. Yes, you may have to pay a few bucks in taxes along the way to do it this way, but I think it's absolutely worth the few extra bucks. When that child has started to earn some money, and I want you to get that advice from somebody who gives tax advice. I don't, but I know a lot of people start putting money into a Roth IRA for a child that in fact the money is made working. It can be mowing lawns, it could be babysitting, it could be doing things that even could be for the family. Again, ask an accountant how you do that properly. And you keep putting money into that Roth IRA account until the money that you've been putting in is gone. So you have the early years. Let's say you did this for 21 years. You'd have the 365 going in every year into an account in your name. And then the child starts earning some money, and now you start taking the money out. Well, who knows what return you're going to get on that investment. And up until the point you start taking it out, hopefully a good return. Then eventually that money is, in fact, it is spent. And it is spent by investing the money, okay? So the impact of this is a huge amount of money for a child by about age 21, that if by the time they're 30 is moved over into the Roth IRA, you have potentially a multi-million-dollar portfolio. And if you read the article, How to Turn $3,000 into $50 million, it's real simple. One, you assume you put it into an equity asset class that compounds at 12%. Where can we find 12%, you're asking? Well, I might ask, where can you find 10%? And you might answer, well, in an S&P 500 fund. And I'd say, right, that is a possibility, as that has been approximately the return of the last 92 years. I would say where the 12% might come from would be from small cap value. Now, it has paid a premium over the last 92 years that's more like 5%, but I'm thinking if we could get 2%, that money will grow. And then when they get into retirement, they take money out. It could be as much as $20 million when you look at the study. And when they die at 95 and pass along more to the family, it could be as much as $30 million, all because somebody helped plant those small trees, as Chris was talking about, when the child was young. But do it in your name. Move it directly from there into the Roth IRA. Do everything you know to keep that kid from cashing that out. That's the biggest risk of the future of that investment, is the child, not the stock market. All right. Let me see what else. I should give Daryl and Chris a chance to add to that if you wish to.
Well, yeah, I was just going to say, if it's in your name and it's not a trust account that you're setting up, M1 would be a simple place to do it, because
okay.
you could literally have, a monthly transfer of $10, $20. It doesn't, you can set that up as an automatic transfer into the account, and
Wow.
it'll automatically allocate it, and do the purchases, and and it'll automatically reinvest the dividends along the way. So I think since it is in your name and it's not a trust account, that's an interesting option. Yeah.
Yeah, that's great. And I do hope our viewers and listeners will take the time to read your articles that are under the ETF link on our website, because it will not only discuss the strategies, but how you built them. There's some great information there. Thanks to you, Chris. Okay, here is from Mike. Is values fall from grace related to the increase in the influence of mutual funds and ETFs? If so, should we focus more on market dynamics and average returns, since mutual funds and ETFs gain their influence? I was a little bit confused by the question, but you read it. Did you have a direction you would go from what you read, Chris?
I think value has historically come and gone in terms of its performance. So, and I'm not sure anybody really knows why. Things come and they fall in and out of favor at different points in time. Explaining it is like explaining the ups and downs of the stock market. People will write it up every day. They'll tell a story, but nobody really knows. If they did, they would have figured it out a day ahead and become really rich, right?
Yes.
So,
yes.
so I'm hesitant to stick my oar in the water on trying to explain it either. I think that mutual funds and ETFs have made it easier for people to invest in what used to be somewhat esoteric ways. And so in a sense, that does make the market more competitive. And if we look at the history of the market, there are some really long-term trends that are visible as a result of things being more competitive and more global. International is more correlated with US, for example, US equities.
Mm-hmm.
And I think the return premiums are a little bit less than they used to be, right? That doesn't mean they're not there, but it does mean that maybe it'll take a little bit more patience going forward, or maybe we're just in a period of time where, it's been a long dip for value and we're about to experience the up. One of the things that I noticed when I look back at these discontinuities and this is true of market downturns, it's true of premiums for factors, it's true of US versus international. the corrections don't tend to happen smoothly over long periods of time. You know, the U.S. international differences in returns, if you look back, they happen at discrete points in time. They'll track each other for a really long time, and then boom, you know, it's like if you weren't in the market for that month, you missed the return, right? And I think the same thing is true of these premiums for factors. You know, if you're patient and you're willing to stay the course, you'll be there when it arrives. But if you're fickle and you happen to be out at the wrong time, you may miss the whole return.
Well, and what Daryl said about that article that's under best advice on the homepage at paulmerriman.com, the 9-decade study, you can actually see the ups and the downs of large cap and small cap and blend and value and stocks and bonds. And so it's not like this is a new situation. Here is what confuses me. I'm constantly getting this question about value, that value has underperformed the S&P 500 recently. If we look at the last 20 years, the S&P 500 has compounded at less than a 6% rate of return. What are we supposed to do with that? Stop investing in the S&P 500? The people who made it through that 10-year terrible return of an annual loss of about 1% from 2000 through 2009, they eventually got rewarded in the last 10 years. But it is a difficult part of investing. Why do we trust some things to be okay for the long term and not others? So that's the challenge.
Well, there's a behavioral finance bias we all have, that, you know, recency bias.
Yep.
And I think that's the one that's coming to play here, right? Is that we remember how great the S&P 500 was for the last few years. We don't remember how bad it was back in the early 2000s.
Yeah.
It's just not human nature, right? It's not the way we're wired.
And Daryl, are you wired to answer anything here on that question? Performance?
I think a lot of the disappointment in small cap value comes from recency bias, as you guys are mentioning. And so the fact that people don't remember or tend to minimize the decade between 2000 and 2009 or 10 is just it's what people do. They don't remember the bad times, and that I think is where you have to have a little bit longer term view. Even if you're young, that sometimes that long term view goes back beyond where you were even aware of what was going on. And that's a difficult thing to do sometimes, since you didn't experience it.
Right. By the way, I just looked at my watch. Have we been recording for more than an hour?
We're coming up on about an hour, I think.
Are we? Okay. Okay. I just lost control there. John says, if you're already retired, what target date fund do you choose? Do you choose the target date fund of the year you retired, or what? What do you do, Chris?
Yeah, the year that's as close to when you retired as possible. And if you retired a long time ago, that's probably going to be a 2020 fund or a 2015 fund or 2010 or something, because they haven't been around that long, right?
Yeah.
But yeah, you would choose, if you're going to try and implement 2 funds for life in retirement, you would choose the fund closest to the year you retired, and also look for one where the allocation is changing and managed through retirement, just not just to retirement, right? So typically they will continue to decrease risk a little bit into the first years of retirement, and you can tell that way.
Okay, that's great. And by the way, if people will just watch that on that Choose FI date that we recorded back in what, on the 9th, was it, or 9th or
Yep.
11th?
Yeah, I think it was the ninth.
9th, okay. You do a discussion about not just to retirement, but what people can be doing after retirement in choosing funds. And I thought you did a terrific job of
Oh,
giving
thanks.
people choices depending on risk and reward kinds of needs. Let's see. This is your asset allocations are used by many people to create the path to the retirement they've envisioned. Do you suggest adjusting these allocations as you near retirement age, much like you would with a target date fund? Or do you select one portfolio based on your risk tolerance and write it out the entire way? Why don't you start that one, Chris, and then Daryl can weigh in.
You could do it either way. I think that for most people, they're probably going to underestimate the discomfort they feel right at retirement.
Mm-hmm.
At least I did. It's a big change, and so that's why we sought some financial planning help at that point in time. We reduced our risk in terms of our portfolio a little bit at that point in time. And then as we've been retired for a period of time, we've gotten more confident and more comfortable, and things have moved on. So I think for a lot of people, it's going to make sense that they do some kind of an adjustment around then. And as you recommended, Paul, talking to a financial planner is a really good way to add some confidence and also some prudence, right? Because it helps you avoid making mistakes or being blindsided by something you missed. And so we found it's hard for me to imagine a more valuable time in life to talk to a financial planner than when you're going from living on the income that comes in every month to living off your savings. It's just such a big change. It seems like a great time to do it.
Yeah, good for you. And Daryl, you've been through it.
Well, I had a different experience than Chris. I worked for a company that provided me with a pretty good pension, so I had zero worries when I retired, when I walked out that day. But for others who may not be in that situation, be fortunate enough to be in that situation, it can be a stressful time. And so, like we mentioned earlier, you can adjust your allocations as you approach retirement and then beyond to help mitigate some of these things like we're going through now. We talked about that earlier with the bond tent or using a liability matching profile or various other things. We have the custom TDF calculator that Chris built and put on the site under best advice target date funds, and you can play with that to look at what your allocations should be, how you might want to design your own glide path. We basically stuck pretty much with the same asset allocation we had, and we've gone through some ups and downs in the last few years, not because of anything the market's done, but because we've repositioned things to take into consideration what we want to do with some of those funds in the future. So there are all kinds of considerations when you adjust your allocations as you get near retirement age. And we have on the website a lot of things that can help you gain insight into what those decisions might do for you.
I'm curious, Daryl. You've done a lot of work in the last couple of years preparing for your money to do a lot of good for others. Was that on the agenda when you retired, or where in that process did you start to turn more and more to thinking about what you do for others after you're gone?
It was in the back of my mind for many years, several years before I retired. I was unsure even back before I knew when I was going to retire or how much I thought I would have to retire. And then once I'd reached that fork in the road, then after I'd been retired for a year or two, I finally decided that, I've thought about doing this. I might as well sit down and and go ahead and do it. And so to work through that process was interesting. And so but the other thing it did, in order to accomplish what I wanted to do, it forced me to think about long-term allocation and placement of different funds, different asset classes in my different accounts, in tax deferred and tax free, and taxable. So it can be a focusing event or focusing process.
You know, that's one of the questions that down here somewhere somebody asked about, for example, small cap value. Where would you put that in a portfolio? Where would you put your bonds? As long as you open that gate, why don't you go ahead and comment on that placement, asset class placement?
I'm not sure. I really don't have a lot of experience in that because I had a lot of different things locked in place when I retired. But in general, I would want to put the assets that have the higher expected return in the place that has the least tax liability. So I would put those kinds of things like small cap value, for example, in a Roth, where you will never pay taxes on what should be eventually an overperformance or an outperformance gain. Bonds throw off taxable income. So I would tend to put those in a tax deferred place, or even, depends, even a taxable account if it's the right kind of bonds. But
like a tax exempt bond, for
right.
example.
Yes, right. Exactly. Sorry. We used to have bonds in our taxable account. And then when we went through this redistribution process, thought about how things were working, now they are all in my tax deferred accounts. So that's
Chris, what about you on that topic? Placement.
I think I agree with Daryl, only he's thought about it more than me.
I doubt that.
Well, here's one for you, Chris. Momentum and quality are additional factors that historically produced outsized returns. Did you consider adding index funds that track these factors to the ultimate portfolio?
So I've looked a lot at momentum and quality as factors, and I use them as part of my selection criteria for the funds that we put into the best-in-class ETFs for the ultimate buy and hold. So if there, for example, is a small cap value fund that has higher quality and one that has lower quality exposure as a factor in the past, I'm going to pick the one that has higher quality. And
define quality, if you would, just so.
So quality is, it's usually defined as some kind of financial metrics like level of investment, right? Companies that spend a lot of the money that comes in versus companies that are more prudent, or companies that have a higher gross margin on the things that they sell would be higher quality. There's different ways to measure it, just like there are different ways to measure value. But I use Portfolio Visualizer, and it gives me the ability to look at the history of the exposure to the quality factor as defined. I use the AQR data set usually as a reference. So I couldn't really tell you I have a strong preference for one definition of quality over another. I like the AQR data set because it goes back a long time and because it seems to be academically well-grounded. So that's the one that I use. What I've found when I look for funds that are specifically tuned around quality or around momentum is that there's not as much historical proof of performance. In particular, momentum has a lot of trading that has to go on to stay with the funds that have been winning recently. And so if I look at the fund histories for funds that are specifically just about momentum, what you find is that they underperform what they would have been expected to deliver based on what academic research says by 2, 3, 4 percentage points per year. It's substantial. So the promise of a high return is very high, but the realized return premium seems quite a bit lower. And so because of that, I don't look specifically for momentum funds, but because momentum is negatively correlated with value, I look for momentum in, for example, the large cap blend fund or the small cap blend fund or the international large cap blend fund. And I try to pick funds that have a little bit of exposure to momentum so that overall in the portfolio, we get that momentum factor working for us a little bit, but we don't pay too much to get it. Right. And we do the same thing on quality. We try and get the quality factor working for us where it can, but we don't pay too much to get it. And, you know, I'm sure I'll revisit this as there's more time in history, but so far there's not as much evidence that those factors on their own are as efficient to invest in as the small factor, the value factor. Yeah.
And ever so quickly, the 3 factors that you think are the drivers of the premium that you're looking for.
Well, I'll give you 4. I think in the funds that we use, the primary 4 factors are first the market risk, right? So the market is the engine for almost all of the portfolios. In fact, I would say all of the portfolios we recommend. The market is what over the long haul is going to deliver you the greatest return. The second one is going to be, fixed income factors, which are, let's see, what is it? It's term and it's effectively
Quality.
Default risk. Quality, right? It's default risk, right?
Mm-hmm.
And so the fixed income part that you put with the market factor, those two in combination with rebalancing, give you the ability to have, some risk with great diversification, because those two things are relatively uncorrelated. And then the 2 other factors are the small factor and the value factor. Mm-hmm. And so you have those 4 factors working in maybe 5 if you count the 2 fixed income factors in almost every portfolio we recommend.
Good. Thank you. Catherine says, I would like to do market timing. I would like to also do market timing with half of my investments. How do I find someone to do that for me? And the reason they said also is because our portfolio, the one that my wife and I agree on, is half buy and hold and half market timing. And the buy and hold portion is half stocks and half bonds. And the stock portion of the buy and hold is half US and half international. And the stock portion is half large and half small. And basically a little more than half value and the balance in growth. So the only other level of diversification that a person could probably use would be, in terms of investments and liquid investments, is to have some market timing. So I have half using trend following market timing systems. There's nothing sexy about them. They are the most the lowest risk timing strategies that I know. I have them done by somebody else. It happens to be the old firm that I started, and that was what we did for clients, was put portfolios together with buy and hold and with timing. But the minimums are relatively high. If you wanted timing and you don't want to put a lot of money into timing, or even if you do want to put a lot of money into timing, check out Meb Faber, F-A-B-E-R. He has a series of funds, Cambria funds, and they, some of them are buy and hold and timing, some are more timing, but he does that kind of work, and I think he does a pretty doggone good job. He's very smart. I know, Chris, you've followed his work for years, I think, haven't you?
Yeah, yeah. And you and I met him when we were down in AAII in
Yeah.
Florida. It
Yeah.
was very nice to meet him. He's a nice guy, and I think you're right that if you're looking for a low cost, low minimum way to do timing, some of his ETFs would be a really interesting choice. And if you listen to his podcast or read some of his work, he's written some great articles. One of the big advantages he points out, and I know you've seen this in your own investing, is the again relatively uncorrelated nature of timing to value investing. And so the combination for you, I'm sure, has smoothed the ride over years, right? It's not that timing always outperforms or that value always outperforms, but when you take the two together, the odds of underperforming go down, because when one's up, the other one tends to be down, and vice versa, right? So it's not a bad strategy. It's a good strategy for diversification. It's just less available to most people.
Yes. And by the way, the problem with recommending timers is that if you said, could you recommend several people who would do index funds, manage index funds? I would say, sure, there's BlackRock, there's Fidelity, there's Vanguard. And I would know that those people who produce those indexes are going to be pretty doggone close. There's not going to be any meaningful difference between the S&P 500 at BlackRock or Fidelity or at Vanguard. When you start talking about timing, everyone has a different approach. And so you can't just say, oh, well, here are 6 timers who I think are doing the same thing. They're not doing the same thing. And so it's much harder to judge timers than it is to buy and hold.
And I think market timing for a lot of people means emotional market timing. It means discretionary market timing. It means active mutual funds. And that's not at all what you're talking about when you're talking about market timing. And it's also not what Meb is talking about. Both you and Meb, if somebody asks you, well, how do you know when to be in the market and when to be out of the market, would answer it the same way. You'd say, I don't. The algorithm knows, and the algorithm doesn't really know. A lot of times it gets it wrong, but on the average, over the long haul, having an automated, systematic way to do that timing has historically shown that it clips off, some significant percentages of the drawdowns and gives you a chance at still having a market rate return. So it reduces risk while it doesn't really compromise your return that much, right? But there are times when it dramatically underperforms, right? Just like value.
Yes, absolutely. And it's frustrating. Daryl, do you want to add anything to that? Because what is happening right now as we have this important meeting, somebody has decided to wash our windows. so I think,
and I think somebody who wanted to get a hold of me.
Yeah. So I'm giving you a shot here, Daryl. You're not a market timer.
No, but I do think that a lot of people have a misconception about what market timing is for, and that they think market timing will help them catch the upswings. And I don't think that's why you should use market timing. I think it's more to avoid the downswings, the drawdowns.
Totally.
So,
as a matter of fact, trend following market timing is guaranteed not to get in at the bottom. If it gets in at the bottom, it is not trend following, nor does it get out at the top.
Right.
You can't, because the trend hasn't changed yet.
Right.
And you can't make at a one-day trend change. You have to try to minimize the number of trades during the year. So a lot of the things that people would love for market timing to do don't happen, but they think
really,
it will. So,
yeah.
Well, I can't thank you two enough. I have no idea what kind of feedback we're going to get from our viewers and our listeners, but I'd like to think that this is something that we can do from time to time, just as you two were kind enough to go to bat Choose FI and do the AAII and do those Zoom and Facebook presentations. And those 2 and 3 hour presentations are on our website. This will be on our website, and hopefully many more of these. Give us some feedback, friends. I know that many of you are outspoken about what we should be doing. This is a great time to be outspoken, and again, a great time for me to say thank you to Daryl, thank you to Chris, and we'll be back soon with more of the same, but I promise it'll be different.
It was
All
fun.
right?
Good to see you, Paul.
Nice to see
you guys.
All right, guys.
Take care.
Have a good day.
If you're thinking about trying a second screen, my experience so far says bad idea.
Bad idea. Never mind.
Yeah, but I'm going to keep trying here for at least a minute or two.
If we only get 10 questions, because the 3 of us have things to talk about.
Because we just talk too much.
No, I'm the guilty culprit on that. I know who is.
You can edit out the stuff you don't like.
No, we're not going to do that. No.
You're not going to edit out the ums and ahs and ers?
Nope. Nope.
Makes it real, right?
I agree with Paul.
Okay.
If we do that,
we're one-take wonders.
Yeah, well,
That's right.
That'll work. I can do that.
Hi, I'm Paul Merriman, and I am joined today by Chris Pedersen, the Director of Marketing.
I'll take whatever you want, Paul. Just keep rolling.
We aren't going to be that informal.
God, I need a haircut.
That's all right. I need hair transplants.
I'll be sure to mention that we're all intending to get a haircut soon. Okay.
I got to figure out how to stop this recording. and pray
without
pray
killing
that it
everything
actually
else.
Recorded.
Yeah.
Let's see. It says
we'll just have to do it again tomorrow.
Corner. Let's see if oh, look, I can pause or I can stop. Let's try stop.
And now, with sound investing, here's Paul Merriman.
Well, let's celebrate the new year by pretending we're starting over. And in the process of starting over, I think it's only right that I take a couple of minutes. And for those of you who are first-time students of the 3 of us, I'd like to introduce you to the folks that are really working hard to try to help you as best we can. Remembering that our focus here is really about helping people be more effective do-it-yourself investors. And I couldn't ask for 2 better partners to do that than Chris Pedersen. Chris is our Director of Research. He has a history in the engineering as an engineer and as a marketing guy and a photographic guy. And I mean, all sorts of interesting experiences. And I find him to be a very common sense person on top of everything else. But what he has done for us and for you is he is the one who has developed the best in class recommendations. I'm talking best in class ETFs. And I know a lot of you are following his work. And we'll talk a little bit about that, of course, today. And he also is the one who, in an inspirational way, developed a very clever way to replicate the work that we have traditionally done with many, many different funds, but came up with a way with 2 funds for a lifetime. 2 funds for life is the strategy. He developed that. He's written a book about it. And I think it is probably one of the most clever strategies that I've seen in my almost 60 years of being an investor. And Daryl Balls, who I've known since the 90s, Daryl, also with an engineering background, systems analyst, and responsible. His title tells it all. Although I wasn't quite sure what it meant when I first heard it, and that is Director of Analytics. And I'll tell you what Daryl has been doing for years here on our site, and that is creating tables of numbers, tables that give us the information, whether it's the fine-tuning tables or the distribution tables or the accumulation tables. All of these different tables are built so that you can better understand how this process works, so you can fine-tune your investment strategy for your lifetime. And so it is really, for me, I told my wife this morning, I said, I am so excited. It is going to be so much fun to be working with Daryl and Chris. And I really mean that. And I hope you guys even have a little fun here yourselves. But I want to pose a question to you. This is all about Q&A today. And I want to ask what I think is one of the most interesting questions. My wife really brought this up. We're on vacation down in Santa Barbara for a little while, and so we're feeling more relaxed. And we started to talk about what happens when I'm no longer able to do the work that I'm doing for the foundation. And then also what happens when I'm no longer in a position to take the overall responsibility of the investments that we have in our portfolio. And I got to thinking that in a sense, this is the final step in building that lifetime glide path, the glide path that starts with saving and then small investments and then bigger investments and more equity. And then you start adding fixed income and you start taking money out. All these things are happening over a lifetime. And you get down to kind of that, I don't mean the final days so much, but the day when it isn't right for you to try to do what you're trying to do, managing the money for the family. I thought I would ask, Chris, let's start with you. I am curious, what is your glide path in terms of what happens, because you're a do-it-yourself, totally do-it-yourself investor. What happens when you can no longer do it yourself?
Well, yeah, we don't like thinking about that, do we? Yeah, it's you don't like thinking about not being able to be self-sufficient and take care of things on your own. I have in my mind this idea that I continue to simplify as I get older, and I think I've succeeded in that in my own accounts and in our accounts, the accounts that my wife and I have. We have gotten simpler over time. We've evolved in the direction of what our foundation advocates, what your foundation advocates, to use low-cost index funds, to invest in a small number of asset classes that have a history of good performance, that keep costs low but give you good exposure to small in value. I don't know that I need to change that very much through my life, but I think I have an interesting insight about how this has played out for us in terms of our, other people who've met end of life. My parents and my grandmother, who left us some legacy accounts. And what's interesting is that my dad was a dividend investor, and even though I'm not a high dividend stock investor, I don't feel confident enough, or didn't when we got that account, to change it. I didn't feel confident enough so it's still there. It's still invested as dividend stocks, and it's done well. It's spun up some meaningful income that has been very helpful to the family, and it has continued to grow, and it's very well diversified. It's not the way I would invest, but it actually is the way I'm investing that account, right? And my grandmother was a growth stock investor, And we have an account that has some stocks that we got from her, and I haven't touched it. I've just left it alone. So
what was the best growth stock that she had in her portfolio?
I'd have to go back and look at it piece by piece. She had some she had some biotech companies and pharmaceuticals that did really, really well in the last few years because of COVID. She had some Intel that, although in recent years hasn't done great, over the lifetime has done fantastic. She did really, really well with Intel. So I guess the point in bringing that up is that I think it is a very important thing to consider, because it's quite likely that when you leave whatever it is you leave to the next generation or to your spouse, that they're going to either lack the confidence to change it, or they're going to be somehow sentimentally attached to it, or not want to contravene your intentions. And so it's good to think about your decisions as lasting beyond you. Yeah. Yeah, for us, I think we're pretty well set up. I am going to change a couple of my accounts to be 2 fund for life accounts, which further moves us in the direction of simplicity. Just trying to make it easy for that next generation to understand.
And without getting too personal regarding Susanna, does she have much interest in knowing the details of how you think about it?
No. I think that's true for a lot of people. We have over the years of a very happy long marriage, we've specialized. There are things that I do that she has no interest in and vice versa. So our credit rating is entirely down to her. She she pays the bills on time, and she manages our kind of cash flow in an ongoing short-term basis in a way that has earned us a very good credit rating that I can take no credit for. I probably wouldn't pay on time.
That's wonderful. Well, Thanks for sharing that, Chris. I really appreciate that. But that does suggest that move towards the 2 funds for life, the combination of a target date fund, I assume you're talking about, and a small cap value.
Yep.
That with that happening, you've got the fixed income that would be appropriate if you predeceased Susanna. So that's really a good plan. And Daryl, I happen to know that you're kind of a hybrid of do it yourself and have somebody else work on part of the portfolio. What's your glide path in the end days?
Well, we've sort of followed a path that's a little similar to what Chris has done. The first few years after I retired, I spent simplifying as much as I felt I could, because we had too many little things here and there and everywhere. And so now it's down to just a few different accounts. I've chosen, based in part on legacy, but in part on as a practical reality, to have part of our portfolio, a relatively small part of our portfolio, with an investment advisory firm. And that's primarily because, like Susanna, Randy has no interest in doing this. And that part of the portfolio is a legacy from when I first knew you, Paul. It has a relatively large number of funds in it. They're all index funds, and they're all, for the most part, single asset class funds. But there are quite a number of funds in there. And since Randy has no interest in managing anything like that, I've chosen to leave part of that account, or part of our portfolio, with the advisor. The rest of it is do it yourself. And the rest of it really, though, is there's a small taxable account, and then there's an IRA account, and that's it. The rest of it, other IRAs and other taxable account, is with the advisor. And I've told her, and we've talked about it, and I've told her that if I go first, then when she gets around to thinking about finances, all she needs to do is pick up the phone and call Jeff.
Yeah.
And we've met and talked with Jeff, and he knows that's the plan. I also have a nephew who will be our guardian's not the right word, but because that has a legal connotation to it. But he's in the dictionary definition of a guardian, and one who takes care of things. He has that role, and he's aware of how we're invested, and he also invests the same way. And so if Randy needs help, she can go to him. And after the last of us dies, then he is also responsible for taking care of distributing or doing whatever needs to be done with those accounts at that time. Fortunately, he's a smart kid. So very smart kid. So I say kid, he's 30, mid-30s. So
That's a kid.
Yeah, for us. Yeah. But he's a very, very smart young man, and I trust him implicitly to do what needs to be done. So that's kind of the way we have it set up. Part of it is managed, and part of it is do it yourself. And truth be told, the part that's managed is a little bit do it yourself too, because Jeff and I will talk every once in a while, and there are things they don't do in our account that they do in other accounts that they carry, because I don't want them to do that. And he's very good at that. He understands my rationale and why I want to do it that way, and they do it that way. So they're just super about doing that. So it's kind of it's a managed investment account by an advisor, but I'm the one doing a lot of the advising to the advisor. So, and when I die, if I die first, that will change, and that's entirely fine, because I'm entirely okay with the way they do things. So,
I appreciate that. Go ahead, Chris.
Yeah, I just wanted to add one thing, and that's that even though Susanna doesn't have the passion and interest I have for this space, and this may be true for Daryl as well, I do have an investor policy statement that I went over very carefully with Susanna to describe the level of risk that we're taking with our investments, the ways we're going to trade, when we're going to trade, why we're going to trade, how we're going to fund retirement, what our withdrawal rates are, whether we're going to do different things when the market does different things. And that is something I think everybody involved needs to, even if they're not interested, they need to sit down for it. And I think done the right way, almost everybody would be interested, because you're describing how much risk you're taking and what you expect to have as a lifestyle. And then every time I make a trade, I would use Susanna as kind of my QA check. It's like, hey, am I messing up here? Can you come take a look at this? And so even though she doesn't have a passion or an interest for it, it gives her some exposure to the process and how things happen. And I think that's, probably useful in every relationship, just to be as open and communicative and share as much information as you can, so that you get some osmosis going on, if nothing else.
That's great. And at the other end of the spectrum, I do not have one penny invested that I'm personally watching, either daily or weekly or even annually. On top of that, I don't have a penny invested that's invested for fun. I have never found the process of investing to be fun. I find it actually emotionally kind of stressful. Mm-hmm. And I know that about myself. And so there are people that when their emotions have such a strong reaction to what's going on with the value of their portfolio, they are better off to have somebody else who is not have that same emotional attachment to the money to take care of it. Now, obviously, you want to have somebody who knows more than you do, and also, and this is a bias that I have, and I think Daryl would agree with this, because we're both know that we both work with the same company with that portion that somebody's helping, and that is, there's nothing wrong with a sole practitioner. There are lots of really good investment advisors who are sole practitioners, but I must say, when I think about wanting to have the continuity, and it isn't just for my wife, it's for other members of the family as well, I want them to be with a firm that has the depth of being able to outlive that advisor that we might have today. I work with a great advisor. He could retire in the next 5 years, and I expect to be around for longer than 5 years. So I like the idea that there is a real firm with people in research and people in the back office folks and the compliance people that keep the company on track legally. There's a lot of advantages of working with a firm that has some depth. So we're all three of us have a different approach, and we all hopefully have peace of mind. I don't even worry about the account. I have complete peace of mind. Either one of you worry about the day-to-day stuff? No. Week to week. Well, that's great. I appreciate your feedback, and I was a little sensitive, thinking maybe I was getting too personal, but I really do appreciate that feedback. Now, I want to get to the Q&As that people sent to us, and one is, I'm going to use it as a case for a lot of people who write to us, and they ask a question about, are we taking inflation into consideration? Are we taking the political situation into consideration? Have we taken the PE ratios of whatever into consideration? What advice do you have for people who write to us and ask us how we are allowing all those really important pieces of information to be part of our decision-making process? Or is your position, or do you say, look, that's none of our business, it's not our concern? Chris, how do you deal with that? Because I know you get some of those emails.
Well, it's one more data point, when you get, for example, the latest information about inflation or the Fed moving, they're adjusting rates or things like that. But it's one more data point at the end of 600 data points, or, it's just a really, really long series. We're trying to create advice for people that's evergreen and that lets them do a manageable buy and hold strategy. And a buy and hold strategy means that you're not going to vacillate with the winds of the day. You're not going to change your investments based on the headlines of the moment. And so it's not that we ignore the new information coming in, but it's a very, very small percentage of the total picture that we have. And so if people don't see us changing our strategy dramatically because there's dramatic headlines, that's why. And we think that that's going to serve our investors best, because we don't want investors to have to change their strategies with every latest data point. And I think most of the academic literature says that there are very, very few investors, professional or otherwise, who can benefit from following the headlines of the day and trying to change their investment strategy dynamically. So it's prudent. It's not just easy, but it's also a prudent approach that's probably, if you can get comfortable with it, going to let you sleep better at night.
What about you, Daryl? Have you any patience for those kind of people?
Well, people are people, and they're gonna be who they are. But with respect to the portfolio, I always go back or fall back on the well, why did you pick the portfolio you have now? And were those kinds of things the consideration when you picked the asset classes you have in the portfolio and your asset allocation? And if so, I'm not sure that's really the kind of a, and Chris may correct me on this, but I'm not sure that's really the kind of a buy and hold investment approach that the foundation adheres to or espouses. And so I have to ask myself, if you didn't incorporate those kinds of things into the beginning setup of your portfolio, buy and hold portfolio, in terms of asset classes and allocations, why would you change it now based on those? And so that's kind of the way I look at it. I have not in the last, since I started investing seriously, which is probably longer ago than I want to think about, I don't think I've ever changed anything based on any headline I read anywhere. What I did was based on, or what I thought I did, or what I did was based on what I thought were more fundamental reasons in terms of what I thought my risk tolerance was, what I wanted my diversification to be, those kinds of things.
Well, we had I think a young fellow who sent me some information about his holding in a small cap fund because of our recommendations, and I told him, he interpreted it as me saying that it's about to lose half of its value, and it wasn't what I said at all. I mean, it's not what I meant to say. It's what he heard. But what I meant to say is, when you were in small cap value, or when you are in the S&P 500 and you are young, even at my age, it's possible that you are going to lose half of the value, because that is what the market does. And both Warren Buffett and Peter Lynch, two of the greatest investors supposedly, have said, if you're not willing to lose half of your money, you shouldn't be in the stock market. And for people who are investing in individual companies, if we could also say, if you're not willing to lose all of your money, if it's all in one company, then you shouldn't be in the stock market. But I do think that there is this tendency for investors to look at the upside without being realistic about the downside. And obviously, your ability to stay the course, Daryl, and yours too, Chris, is that you are able to just ignore those declines when they happen. And so, okay, well, that's great. I appreciate it. Okay, I've got an email here from Nathan. Nathan asks a question about, would we provide to him the funds that we used to backtest the ultimate buy and hold strategy? That's the 10 fund strategy. He can find information going back to 1990 and what he's concerned about. And this is the important part of the question to me. He is concerned that from 2014 to 2022, the S&P 500 did better than the ultimate buy and hold. In fact, it did better than most things did. And he'd like to see more information so that he could be convinced with the long-term results that we have going back to 1970. I'll tell you where I went when I saw that. I thought, well, wait a minute. We don't have to just go back to 1970. We have done the work going back to 1928. Well, we didn't we didn't do all the research. Somebody else did the research and figured out how did large cap blend do, and large cap value, and small cap blend and small cap value. And the fact that you didn't have internationals there as a part of the mix doesn't necessarily distract from the fact that that run from 1928 on, those returns over 10, 15, and 20-year periods tend to be all over the place. I think one of you looked at the 20-year returns, maybe both of you did, and found out that in every 20-year period, small cap value had done better than the S&P 500. Doesn't mean that there won't be a 20-year period that the S&P 500 does better. There probably will be, but the bottom line is that evidence, to me, going all the way back to 1928, says more to me than going back to 1970. And of course, we have it going back to 1970, but it still begs the question, how do you test going back to 1970 if you can't find the mutual funds to test?
Because of the licensing terms that we have our data under, we can't disclose all of our return information. And so that's a limitation. But there are some public sources that he can test the core U.S. asset classes going back to 1970. He can do that at Portfolio Visualizer. And if he goes to the disclosure page at Portfolio Visualizer, he can see every individual fund that Tuomo uses to run those calculations. Actually, it goes back to 72, I think, at Portfolio Visualizer. So that's a simple, easy to use tool that lets him extend his analysis quite a ways. He can Google the DFA matrix books and probably find PDFs he can download where he can get the return sequences that are, core to a lot of what we do. And he can get that information going back to 1928 for the U.S. funds. He can go to the Kenneth French website and get the academic research that's behind those. I mean, so there's a lot of information out there, but he won't be able to find emerging markets or REITs because there's no information that goes back as far. REITs go back pretty far, but emerging markets not very far at all, and the international small value and the others peter out. Yeah. So, Daryl, do you have any other thoughts on that?
Yeah, I think there's a little bit of a dichotomy between what we show for the ultimate buy and hold portfolio and what we show for a lot of our other analysis or research, in that the ultimate buy and hold analysis uses actual tickers. They are actual funds, mutual funds in almost all cases. And so those do have a history, and they do have a start date, and it is not 1970. In fact, it's not 1970 in most of the cases. It's later than that. And so in order to backfill those early returns, we adjust the asset allocation to distribute it according to the thought process or the logic that is used to drive the ultimate asset allocation. So if we're missing a fund in international, well, one of the four major international asset class funds, if we're missing one of them, well, that one quarter is actually distributed among the other three in a way that keeps the total overall asset allocation in terms of large, small, blend, and value about right. So that's one thing. When you look at the longer term histories back to 28, those are indexes that have been created by different research institutions. Yep. And as Chris mentioned, they're primarily U.S. only. If you go back that far, so I guess that's kind of the. But
there, I think there's another level of concern that you have to kind of not give up on, but accept, and that is everything we're looking at is hypothetical. to the extent that even whatever the S&P 500 has actually done since 1976 will never, ever be replicated the same way again. Now, that doesn't make the return since then hypothetical, but I will tell you this, as I track Fidelity and Vanguard and others, I find some pretty big differences in their returns over periods of time because they have slightly different holdings in you can compare at Morningstar the top 10 holdings and how much they have in Tesla and Microsoft, and it's not all the same. And so at the end of the day, I think what we are left with is we can look at all of these numbers, but probably the numbers that are most meaningful are the numbers that seem to support stocks outperform bonds for the long term. They also seem to support that value for the long term does better than growth. But you're going to have many periods of growth that just make value look like bonds in the difference in returns. And that's going to be part of the process, is that we want to judge this stuff, like what happened from 2014 to 2021, as being a meaningful period of time. Well, it isn't. And that's the problem. The question, when put to the academics who are really the experts on all of these numbers going back and in terms of actually digging them out, they know how they did it. Those people will not commit to how big the premium will be for small over large or value over growth. They will simply say there should be some premium. And so there are periods the premium shrinks, there's periods the premiums get bigger. We saw this recently with small cap value, the difference in returns for those that track the Russell Small Cap Value Index or do it like the people at Advantis do it or DFA do it. There are some major differences. And the problem is that whatever made Advantis or DFA better over the last couple of years, I just noticed this year so far that the Advantis small cap value portfolio isn't doing, it's doing fine, by the way, no complaints. It's making money so far this year. I mean, it's a very short period of time, but I will tell you, the ones that it was outperforming last year are now outperforming them. Now what do I do? Is it time to make a change? Well, no, because the bet that we're making, if we're actually making a bet, is that over a very long period of time, and for many of us, that's not very long. And for other people, it's a very long period of time that this kind of a premium is going to be built in. And those who worry about whether we're taking inflation into consideration, those who worry about the political situation, those who worry about the performance of the last 5 or 10 years, I understand why they worry. It's easy to do that. I happened to watch Fareed Zakaria yesterday, and he had a guest on. And at the end of the interview, my wife and I looked at each other and said, I don't know if I want to be here for what's about to happen, because the guest was it was gloom and doom with a smile on his face, but it was still not a pretty picture. And that kind of response, not sure those are the thoughts of a market timer. And as Daryl just noted a few minutes ago, that's not what we're advocating that people do. And we do understand that people who see numbers, those numbers tell a story. And they often tell a different story to one person than they do to another. And one of the challenges the three of us have, we want to teach people as best we can the best way that we know to invest. The problem is, for many of you, we just don't think like you do. Our brains aren't responding the way that your brain is responding. And that doesn't make our brain better. It just makes it different. And this is the hard part about trying to help do-it-yourself investors. How do we get into your brain? What we're really asking is, will you get into ours and understand, can you actually agree with the conclusion that we've come to? Would you add anything to that, Chris or Daryl?
Yeah, I think one of the things that I always fall back on when somebody says, well, I'm in one of your portfolios and the S&P is kicking its butt right now. And so I say, okay, well, why did you get into that portfolio? And usually it's because, well, you want to do something better or different than the S&P. Okay, well, it's doing something better or different than the S&P right now. So why are you upset? And so, there's volatility on the upside, which everybody loves, and then there's volatility on the downside, which nobody's happy about. And so you're going to have both of those. I think it requires a longer term view. And I think one of the things that an investor, particularly a younger investor, has to become comfortable with is that long term means decades, not the next few months or the next few years. That's, if anything, that's what you need to have comfort in, is that it needs to be there. You need to set it and forget it to a certain extent for decades.
And I will say that the table that you put together, that is the most powerful table I think I've seen in this regard, is, I believe it is it's the fine-tuning table 14A, I think it is. It's the combination of the S&P 500 on the far left and the small cap value on the far right. And on that page, you show the difference every year between the small cap value and the S&P 500. And at the bottom of the page, you show how many years the S&P 500 beat the small cap value, and conversely, the small cap value beat the S&P 500, and by how much. And if anybody will internalize that table and understand that is the ride you're going to go on, not with the exact same numbers, but I can tell you with almost the exact same feeling, because it is what it has to be like. They aren't the same. And you just said it, Daryl. You said you're looking to get ahead and you're looking to be different. Right now, if the S&P 500 is kicking your butt, you're being different. You are succeeding in one of the two ways. It's just that you want to be different and be the best as much of the time as you possibly can. We got an email. I just thought it was terrific. This is about a fellow who has looked at the total market index, the U.S. total market index. He looked at the percentage of the asset classes in 2017 and the asset classes that are what percentages in each one in 2022. And Chris, you might want to comment on it, because did you not find that a fascinating comparison on how different that index is, how it's made up today versus how it represented itself in 2017?
Is this the question where you looked at VTSAX,
Yes,
the total
exactly.
market index?
Yeah.
And what he found was that at Morningstar, if you look at VTSAX and you look at the style boxes, it shows that it has a tilt towards growth, right?
It does now, 32% in large growth.
Yeah, and the interesting thing to me is that it just goes to show that, not everything on the internet is right. Because VTSAX, the investment methodology, is that it hasn't changed what it holds. It holds a market cap weighted collection of stocks that are very close to the total U.S. market. That's
true. But
thousands and thousands of stocks.
Yeah.
So it can't have a growth tilt. It can't have a small tilt. It can't have a value tilt. What can happen, though, is Morningstar can set their criteria for the boxes and not update them for a while. And so I believe what we're looking at there isn't an evolution in the tilts of the VTSAX towards growth. What we're seeing is that Morningstar's a little bit behind the times on updating the criteria for how they categorize things in their boxes, because VTSAX owns the total market, and the only way you have a tilt towards growth is if you own more growth than exists in the total market.
Well, but
yeah, it's the measure. It's the thing that you measure the tilt against.
Exactly.
But wait a minute. Is it not true that, let's say, at a point in time in the past, that the very large companies that were being priced higher, so they would have represented a bigger percentage, could have been a value companies rather than growth companies? So you could have the energy companies, for example, back in 2017, representing more than those that had very high PE ratios.
The definition of value is it's the lower, typically like third percentile of the stocks in terms of their price to some metric, price to book, price to earnings. So there's different you can define it different ways, but it's the lower 33% or lower 25%. It's however you define it. And so if the whole market gets more expensive, there's still a lower third and a top third. And VTSAX, in holding the total market, is going to have it's not going to be tilted. It's not going to be tilted towards growth or tilted towards value, or tilted towards large or tilted towards small. It's by definition, it's flat. And if you go to Portfolio Visualizer and you run a one of the factor regression models on VTSAX, what it shows is you get market exposure, but no value exposure, no growth exposure, no size exposure. So it's basically saying exactly that it, and as Daryl pointed out, that's because it's running a regression of VTSAX against VTSAX. You know, it's a circular argument in many respects. But I think that what he's seeing there is just some kind of a short-term vagary in the way Morningstar categorizes the boxes.
But help me through the suggestion that these boxes make, at least to me, and that is that in the past, for example, I think about your father and his dividend stocks, or was that your, and yes. So those dividend stocks at one time they were very, very popular, and they were very, very large companies. It didn't mean that they had to sell at high PE ratios in order for them to be amongst the biggest, because they were, as a company, very, very large compared to a lot of technology. And so there are periods, I think, and when we look at the history of the market, we are picking up not just what the market returned for 1985, but we are also picking up what was popular in 1985. And so however, this is the problem with trying to recreate the past, is that you could have a year that the market's up 20%, that a lot of that money came from technology, and other stuff did really poorly. You could have another year you're up 20%, the technology wasn't good at all, but other stuff was really, really good. And so it isn't just that we're trying to replicate the return, then that's difficult. We're also, whatever return we're looking at, it came from a series of events, political, worldwide, whatever, that caused them to price the market at whatever they did at that moment. And again, that's never going to happen the same way again.
That's true, but what you can't have is you can't have the market have more than what you've defined as the percentile for growth in growth. So if the growth part of the market, grows really fast, what happens is, because you've defined that only a third of the market is in growth, or whatever percentile you use, some of that growth gets pushed into blend, and some of the blend probably gets pushed into value, because it's defined that the total market is flat. That is the definition. So when he's saying, my VTSAX holding has shifted towards growth because he's looked at it on Morningstar, what he's actually seeing there is that Morningstar is a little behind the times on updating how they've defined the boundaries. Because when you own the total market, you have no tilt. Yeah.
Got it. Okay, onward here. We've had, over the last months, a number of people ask about AVEG, correct?
AVGE, yes.
AVGE.
Yes, AVGE.
And this is a one fund solution,
Yep.
according to a lot of people. I look at it and it reminds me a little bit of the total market index. It isn't the same, but it's a combination of some large and a little bit of small. And people are looking at this as a potential one fund solution.
Yeah.
And I want to know, if I want to have a balanced portfolio of large and I want meaningful small, am I going to get it in AVGE?
So I did do some analysis, and I looked at AVGE. AVGE, the price to book is about 1.66. If you look at the best in class ETF worldwide ultimate buy and hold, the price to book is 1.16. So, and you could use other metrics there like price to earnings. The bottom line is that it's not as value-y as an ultimate buy and hold portfolio. The market cap, the average market cap is about 25 billion in AVGE. The average market cap in the best-in-class worldwide ultimate buy and hold is 8.6 billion, so it's not as small. Expense percentage 0.23% versus 0.26, so I'd say they're both small. It's a 70% U.S., 30% international split, roughly, so a little bit less diversified internationally. So it is thematically aligned with this idea that you want to tilt towards small in value over the long term, and that's meaningful differentiation or diversification, but it's not tilted as much as the best in class worldwide ultimate buy and hold. Yeah, so just for kicks and giggles, I went to see what I could do with 3 funds using, this is a portfolio visualizer using their match factor exposure tool. And I chose the Avantis US small cap value, Avantis international small cap value, and then the 2065 Vanguard Target Retirement Fund, VLXVX. And I said I can use up to 3 funds, and I'm going to use the FAMA French factors because they cover the widest range of markets, 5-factor model. And here's the best-in-class portfolio I'm trying to match. And you put that information in and you hit create clone, and then it gives you a few different options. So this is the original portfolio, which is the best-in-class ultimate buy and hold. And then it gives you 2 choices. One is the factor exposure clone, and the other is the returns-based clone. They're actually very close. So let's look at the factor exposure clone. It's 25% in U.S. small cap value, 35% in international small cap value, and that's probably because the target date fund tilts to the U.S., and then you've got 40% in the target date fund. And if you come down here and you look, you can see the bottom one. This is the ultimate buy and hold So the blue one's the ultimate buy and hold, and then the two clones are the top ones, and they follow it pretty well. They've actually outperformed since 2019. But if you look at the factor exposure, which is kind of like, well, what's driving the returns within the account? We can look at this. The ultimate buy and hold is basically 92, 35, 29. That's 92% market, 35% size, 29% value. And if you look at the factor clone, it's 95, 35, 25. So pretty close, pretty darn close. So, if he's really just interested in trying to simplify to be simple, he could take a two fund for life approach. He could have done something similar with just a U.S. small cap value and given up on a little bit of the U.S. international.
Chris, what are the implications of a 50-50 AVUS and AVUV, half large cap blend, half small cap value?
Yeah, that's a good question. So let me share again. Yeah, so you could do even better. I mean, you can see the outperformance here. So Paul, you asked, what would happen if we tried to match the ultimate buy and hold portfolio with, instead of this AVGE fund that he's suggested, using the Avantis US total, not total market, but large cap blend, and the Avantis US small cap value, AVUS and AVUV.
Yes.
Yeah, and if we did that, we get even better. If we look at the factor exposures, we get better exposure to the market, while also getting high size and value exposures. And if you look at the historical performance, that two fund solution has outperformed the target portfolio, which is the ultimate buy and hold. And the ratio they came up with was actually 70%. This is a 70-30, 70% Avantis US, 30% US value.
It's a relatively low risk.
Yeah, I mean, it's got as a 70-30, that's a reasonable allocation, 70% to US blend and 30% to US small cap value. So there's lots of ways to skin the cat and get to a smaller portfolio that still has good exposure to small in value. Yep.
That's great.
Look at the Sortino ratios.
Yeah, the target portfolio, the Sortino ratio, that's the ultimate buy and hold best in class ETF, all equity, is 0.49, and the two fund was 0.86. Yep.
Well, that's great. I know we're going long here. I want to take a quickie here for somebody who asked whether or not I am still using short-term investment grade bond fund at Vanguard for my holding the money we put aside to be our annual income that we take the first week of the year and then we draw out 1 month at a time. And this person made the point that last year the short-term bond fund was down about 5%. I don't remember the exact number, but do I still use it? And the answer is yes. If I go back and look at the last 10 years and what that particular fund ended up paying, the premium that it paid over time was about 1% better a year than I would have gotten from a money market fund. But I'm looking very long term. If somebody needed every penny of that money that they took for distributions for the year, remembering that my wife and I take what is called a flexible or variable distribution. We're taking it from a pot of money that represents more than we actually need to live on. So if anybody suffered last year, it may have been the people we gave money to. I'm not sure, but it didn't change my commitment to using the short-term bond fund for that purpose, for the short-term money. I had also asked you guys about the best lesson what happened to you last year in the market or in your life that you learned from 2022. Anything worth sharing? Chris, what do you got?
Well, from the market, it's good to look away. It was a bumpy ride last year, and I did look away for a lot of the year. The biggest thing, though, we had a lot of opportunity to serve and help family, and by far and away, that's the biggest return we got on any kind of investment. We spent a lot of. It's fortunate to be in retirement and have the time to rally to the aid of. We have a daughter and son-in-law and their kids, our grandkids, who are relocating, and he was going through training where he was separated from the family for a period of time, and she was a single mom, and we spent a lot of time with them. And Susanna's mom has some health issues, and we spent a lot of time with them helping out, and it's just nice to be of use, right? It's nice to be of use. It's a great investment in other people, and it's a great investment in your own self-esteem. So by far and away, the biggest investment for us last year was being able to help our family and help people around us.
Well, that's wonderful. Daryl?
Well, as far as investing or financial or related things, I think the one thing that I found that sort of stunned isn't the right word, but probably disappointed me the most was that how this is the worst inflation we've ever seen. Really? Were you around in the 70s or 80s? The market has never been this bad. Really? It's the viewpoint that if you haven't seen it before, it hasn't happened. If you haven't seen it in your life, it hasn't happened. And that's I think that's leads to a lot of angst, particularly in people who financially have come of age in the last decade or so. Last 10, 12, maybe 15 years. It's not really been normal, or I shouldn't say that, I guess, but it's been a very, very profitable time, and that is not always normal. The normal thing is that things go up and down, and we've had a pretty good bull market. There have been some setbacks along the way, but it's not anything like some of the setbacks that have happened. And same thing with inflation. 8% or whatever it was in this last year's is pretty high, but I remember when my credit card charged me 18%, Yikes.
And I remember getting
mortgages were the same way.
Yes.
In the teens. And so,
I had a 5-year CD that paid 16% a year.
Yeah.
Yeah. I mean, it was amazing, unexpected. I think that the unexpected thing for me about last year was it's kind of, you expect the unexpected. We've been talking about how low risk bonds are, and they showed us a new level of risk that we haven't seen before, at least not in our lifetimes. That's one part of it. But the other part of bonds that was still the same was that short to intermediate term bonds, while they lost money, they lost a lot less than the stock market lost. And so to the extent that you had bonds in your portfolio to stabilize the portfolio, they didn't stabilize it like you thought they were going to stabilize it, but they stabilized it and did some of the work that you were expecting out of them. And I want to share, because I love the work that we're doing. I love the fact that we're able to help people through our website and the podcasts and the articles and all these things that we have this opportunity to do. The one story that sticks with me about last year is how, by chance, a 19-year-old student comes upon our work and follows up, asks a couple questions about his portfolio. I responded, and that led to an invite for me to speak at the at Rutgers. I think it's the Honor Council of engineering students. And I had the opportunity to speak to 154 engineering students, all because one 19-year-old young person by chance found our website, by chance sent me an email, by chance I had time to answer it. And that has put me on a whole new trajectory, trying to help more students who come through the math world than I was focused on before. And so that was a game changer for me. But I really appreciate the great work you did. We have some exciting stuff coming up. This is going to be great. Daryl's going to be working on the update for all the tables that we do every year. And so, I mean, that to me is always an exciting time of the year. But I'm going to be focusing with Chris on some extra work. When I say extra work, some conversation in podcasts, video work on the best in class. Go back, review that work, review the work that Chris did in building our custom target date fund that we haven't done much with in terms of exposure. And we're also going to talk in the coming weeks, after Chris gets done with reviewing the best in class recommendations. We're going to be talking about Fidelity and this new program they have for people who want to automate, much like M1, automate the process. So we'll be talking about M1. We'll be talking about Fidelity program that allows people to rebalance at almost no cost. It's have you looked at it, by the way, Chris, very carefully?
Only briefly. My initial reaction was I don't like the $60 per year fee, but in the grand scheme of things, that's not that much money.
That's what we're going to discuss. It's $4.99 a month, and so yes, that's becomes $60. On the other hand, I'll tell you, there are a lot of people who are concerned about, do I want to turn a whole bunch of money over to M1? What do I know about M1?
Sure.
And I think for people who are a little nervous about that, $60 a year. And by the way, it includes limit orders on the purchase. It allows you to buy or sell anytime during the market hours, which I don't think you can do that at M1. Well, I mean, we got so much to talk about.
That's correct. That's correct.
It's going to be really fun to dig into this and help you all find, maybe if you can find a better way to do what you're doing. That's why we're here. So thank you for watching. Tell your friends about us. Like us on YouTube. Do what you can over at iTunes to make a comment about our work if it's been helpful. Let's see if we can't find more people to come check in and follow the work that Daryl and Chris, myself, and Craig. And by the way, we've got a new associate going to join us here in a few weeks. So we're looking at expanding the work that we're doing for you. Thank you for taking the time to be with us. Thank you, gentlemen, very much.
Paul Merriman with Sound Investing. Sound Investing, soundinvesting.com, and paulmerriman.com are produced and exclusively owned by Paul Merriman, who is solely responsible for their content. For more information, free articles, mutual fund recommendations, and more, visit paulmerriman.com.
Well, last week we talked about Chris's video and podcast that was about the two funds for life. And for those of you who missed it, I hope you'll go to the Two Funds for Life page under Boot Camp and catch that video. And if you haven't seen his video as well as the video we did last week, they're both worth your while if you're interested in the Two Funds for Life strategy. But this week, we're going to focus on the best-in-class portfolio and the ETFs that Chris spends a lot of effort putting together for the folks who follow our work. And again, he has done a video. If you look under Boot Camp, well, in fact, if you look in the notes underneath this particular podcast or video, however you're experiencing this, you'll see a link there. But if you're interested, I hope you'll dig deep there. But this is kind of a Q&A session on the best-in-class selection that Chris does with ETFs. And Chris, by the way, thank you as always for doing all this hard work. It's a big effort, and I think it would be helpful for those who might be with us for the first time on this topic to spend a couple of minutes going through. I've got an article right here in my hand, Choosing Best-in-Class ETFs. This was actually from the October 2019 American Association of Individual Investors publication. And we'll have a link to that in the notes. And in a minute, I'll tell you why that was such an interesting date for this article to come out. But in there, Chris, you have the 6 basic steps that you go through to decide in each asset class, big, small, value, blend, U.S., international, REITs, emerging markets, which of the ETFs you think is positioned to have among the best return in the future. It's who knows what the future will bring over the next 5 or 10 years, but the idea here is, in fact, I think that that goal that you have is something you should share. In fact, why don't you start by sharing the goal that you have in picking these so folks understand really what you're looking for?
The goal is really just to do the best for our investors, to help position them for the highest expected return. And as you point out, nobody knows the future. We don't have a crystal ball. The ability to predict the future, even for the best in class academic prediction tool, which is probably looking at valuations, it can be wrong for a decade. I'm not trying to pick the funds that are going to make me look good in a year, or make our investors the most money in a year or a month or a day or even 5 years. I'm trying to pick the funds that are going to help them be buy and hold investors with the highest expected return in these asset classes that we recommend as part of our portfolios over more than a decade, over multiple decades. And so there will be a time when I'm wrong for a very long time. And I'm ready to accept that. And that's part of the reason I'm very upfront and open with my process, because I want people to understand that this isn't a lot of judgment on my part. It's not a lot of guessing on my part. It's a very objective numerical process, and they can check my work. You can go and do this on your own if you want. And you might even find a fund that doesn't fit the category, that has great attributes that fit the strategy that you choose, that you want to follow, because you've done additional work and research. That's possible. I have to find funds that fit these categories and kind of fit the labels and have the attributes that we're looking for. And the gist of the science behind it is founded in the work of Fama and French, these Nobel Prize winning academics, as well as many who've come after them, who basically looked back over the asset returns in the past and said, do we see any patterns? Were there certain kinds of equities? They've done this work for bonds as well, but were there certain kind of equities that delivered a higher return in the long run? Maybe not in the short run, maybe not in every year or every 5 years, but over the long run. And typically they had more volatility. Not surprising. You take more risk, you would expect a higher return. And what were the attributes of those equities that delivered that? And those attributes, the most famous ones, the ones that were first discovered, were, first of all, the market risk, the idea that equities outperform bonds. The second and third were size and value. And you can see that we've built our portfolios around tilting towards size and value. And then there are some other attributes as well, like quality. And that's one that a lot of people filter on. Momentum, that's another one that people filter on. So what we really want to do is find the funds that give us exposure to these attributes that have a history of delivering not just like 0.5% more, but typically, 1 to 5% more for the equities that were in that class. And so when you start to think about each one of these attributes or factors, as the academics call them, being worth 1 to 5%, if I can get another 10% exposure to one of those, that's worth a lot. Mm-hmm. And if I have two funds that both call themselves small cap value, and one gives me 10% exposure to small and 10% exposure to value, and another one that gives me 30% exposure to small and 30% exposure to value, you can see where maybe it would be worth paying a little bit more to get the one that has that additional exposure. And that's really the gist of what we're trying to do. Did you want me to go through the 6 steps now?
Yeah,
or
could you briefly go through them? I think that would be helpful, Chris.
Sure. This is covered in the article that we published in the October 2019 AAII journal. So it's been out there a while. And as Paul and I were talking about it this morning, we pointed out that this was before the DFA ETFs were available or the Avantis ETFs were available. So think of it as, the dark ages. We didn't have some of the best candidates in terms of these exposures to factors available in the ETF wrapper that we do today. And that's why they're not mentioned in the article. But the process is pretty much unchanged. I've used the same process for years, and it follows these 6 steps. And they rely on use of the Portfolio Visualizer tools. Portfolio Visualizer has a page for looking at all of the ETFs or mutual funds at once by region. If you want, you can look at US, international, emerging markets. And it shows you the historical exposure that these funds have had to these different attributes. And you can download that information if you want. So the first step is to go and find the funds that have meaningful exposure for each of these asset classes. What are the funds that are in the emerging markets area that have, first of all, exposure to market? Second of all, I want them to be funds that have a high, it's called R squared. But what that means is that there's no wizard behind the curtain who's second guessing and changing the portfolio of all the time. I want a portfolio that's stable and can be modeled using these principles. So you can look back and explain its returns with a high degree of confidence.
So, Chris, if I could just interject there. When you say stable, are you talking about stability in terms of the commitment to the asset class or to the individual companies within the asset class?
To the asset class,
okay.
Because companies may change over time. They may fall in and out of favor and be value at one point in time and then growth at another point in time. They may also grow in size. And so what we're looking for is a fund that doesn't, 1 month look like a growth fund and then another month look like a value fund, or vary in its geographic exposure. I want a fund that, has, I'm looking for something that does what it says on the tin, so to speak, right? I want something that tells me it's going to be small gap value, and it actually is, and it gives me the ingredients I'm looking for, and it does so consistently over time. And the R squared value, which is part of this analysis, tells you that. It tells you if the fund is vacillating hither and yon or if it is stable. And so that's a piece of the selection criteria. And then, once I have found these candidate funds, I can download the information that tells me how much exposure there was to each of these attributes. And then I can analyze. So that's step 2, is to download the information. And you can do this. You can export it in an Excel spreadsheet and play with it all you like. It's kind of fun for the geeky nerds in the audience, or the people who like numbers and Excel. But then the next step is to go and find the factor premiums and what they've been worth, and figure out, if I get 30% exposure to a factor that's worth 1%, well, that'd be about 1/3% per year expected return. But if I get 30% exposure to a factor that's been worth 5%, well, then that's worth 1.5% per year. So you need to get those factor statistics and multiply them times the exposures that each of these funds has to the attributes. And based on that, you can add that up, and you can subtract out an expense ratio, or you can use the alpha that they've calculated. I do it both ways just to cross-check my work. To get an expected return. And then you can look at the different funds and see how they stack up, which one has the highest expected return. Now, I go beyond that a little bit by also running a Morningstar X-ray and looking at other attributes of the fund. I look at, how liquid it is, what the bid-ask spread is, what its assets under management are, the price to earnings, price to book of the companies, the number of companies in the portfolio. So I look at a lot of different things, and I'll just take one of those as an example. Let's say I found a fund that had a very high expected return, but it had a 1.5% expense ratio. I would not recommend that fund. I would just say, you're paying too much, even if they have a brief or long history of outperformance. I wouldn't go there, because I don't believe it's worth it. I don't believe philosophically that it's worth paying 1.5% for what should be something that's managed systematically, and should come from other sources. And so it's there's a little bit of art in it, but the core piece of it, the beginning of it, and the thing that does tie breaking most of the time is this analytical, it's a math problem. Yeah.
So you do this basically once every 2 years.
Yes.
And adjusting the recommendations. What does it take to make a change? I know we're concerned about the tax implications of giving people a better, what we think is a better long-term investment. So they're forced to kind of consider the taxes and how much extra would I make, or how many years would it take to make up for the taxes that I might pay. But give us a little thought on wrestling with making a new recommendation.
Well, first of all, it takes some history. I need to have some data. It's not enough. So, for example, people have asked about Avantis's new fund, AVDS, that's only been around since August of last year. I can run a regression on the data that I've got, and I get no statistical significance in the numbers. I don't have enough data there yet. So a little bit of history helps. The second thing I need is some reasonable amount of assets under management and bid-ask spread. So a brand new fund that only has 50 million in assets under management and let's say, a 0.5% bid-ask spread, I'm going to be reluctant to recommend that because I don't want people to have to be too fancy in their trading to get a fair price, or find they have trouble trading it from a liquidity standpoint. So those are two of the things that I need. But let's say I have a brand new fund and it shows up, and by brand new I mean it's long enough. I've got the history, so maybe it's a year or two old, and I've analyzed it versus our existing recommendation, and it comes out 0.01% better. I'm not going to switch my recommendation because that's just not statistically meaningful. But if it came out 0.5% better, and I felt like it was reaching significant tradability and availability, and I trusted the company, then yeah, I would probably change my recommendation. So it does need to overcome a threshold. It's not just that it wins by 0.01% or something. And in fact, in the future, I would like, in the next iteration of the best-in-class ETFs, I'd like to figure out a way to show size of the difference, to show that some of these funds are multiple beasts of the same character. They're not that different. And in some categories, the differences are substantial. Yeah. And I haven't yet figured out how to do that, but I want to figure out a way to do it without making it too complicated.
And since they can be substantial and to the ends of the spectrum, the S&P 500, when you're in an S&P 500 ETF or mutual fund, the difference in return is likely only to be the expense ratio, or it will be a very minor difference. On the other hand, in your article, you focused on small cap value. And there, the returns can be huge year to year, and we get that question all the time: is it worth another 10 basis points expense ratio to be in the Avantis small cap value? And as I was getting prepared for this, I thought, well, it'd be kind of fun to compare. The top of the list in that article was VBR, the Vanguard small cap value ETF. And so I looked at the returns year by year for 1920, 21, 22, and 23 as the Avantis came out, just about the time this article came out. And the difference on average per year was 6.5%. And that included a bad year. I mean, it was not only better in the good years, it was better in the bad years. And I think, by the way, there was a reason for that in their focus on quality compared to the other ETF. But 6.5%. Now, that is not something we would expect over a long period of time. But when you're worried about 20 basis points or 10 basis points on the expense ratio, that is an interesting, pretty easy decision if you believe the numbers. But as you look at what you know about the small cap value ETF at Avantis, while you would not have expected 6.5% difference, when you look at how it is constructed, would it have surprised you, or would you have expected potentially a 1% difference per year?
It's an interesting question. Let me just get some data before I answer it. You were talking about VBR versus AVUV.
Yep.
Yeah. So if I go and I look at the factor exposures there, they both are. AVUV has a little bit more market exposure than the VBR, so that actually might be worth a 1/4% or 1/10%, something like that. But size.
What did you say now? That was market exposure?
Yeah, market exposure. So that could be due, for example, VBR is less than 1 and AVUV is a little more than 1. That could be due to either leverage or cash drag, just as examples, right? If you have a cash drag, that would lower your market exposure.
Got it.
If you have some leverage, you might be able to increase your market exposure. And then you look at the exposure to size, and you have 0.54 or 54% exposure to size in VBR versus 0.82 or 82% of AVUV. And value, it's 0.61 versus 0.44. But then you also have rich minus weak, where you're getting 0.09 versus 0.23. So
what rich versus weak?
Robust minus weak. Yeah, robust minus weak, which is a profitability factor or quality factor. Yeah. But then you also have this annual alpha of -2 for VBR and positive 2.3 for AVUV. Now, alpha can be due to expense ratio, but we would expect it to go the opposite direction here. So it begs the question, why would VBR have this negative 2% per year and AVUV have this positive 2% per year? I'm going to go out on a limb and say that part of it may be the fact that VBR is an index fund in the traditional sense, in that it follows a publicly published index. And that opens you to the possibility of people front running trades, of going out and getting in front of some rebalancing that needs to be done by the fund, and making it so the fund, if it's particularly large, ends up buying and selling at a disadvantage when they do the reconstitution. Yeah. This is one of the areas where Avantis, though not strictly an index fund, because it uses a private index that's not publicly published, they would have a systematic advantage because they don't have to tell anybody they're going to go trade a bunch of stuff. Yeah. They get to just know among themselves internally that systematically these stocks fell out of our screening criteria and these stocks have come into our screening criteria, and we're going to go trade. And nobody knows. Nobody sees, nobody can anticipate it. So this is one of those areas where I get upset when I hear people get overly religious about, thou shalt only use index funds and they must be labeled as such, because there's actually a disadvantage to that formal label, in that you can end up losing money because you're doing everything so publicly and openly that other people can take advantage of you. And I'm very confident, because of the high R² values, that both of these funds are being systematically managed. They're both like 98%, which means that these exposure to the factors can explain 98% of the performance historically. And so I feel like they're both being managed systematically. It's just one's doing it publicly in the open and the other one's not. So based on these changes, I wouldn't have expected a 6% difference without taking into account the alpha. And I write it off at least partly to good luck. I think it's been good luck that 6% is accrued to Avantis, and I hope it continues, but I wouldn't guarantee it. Yeah.
And I actually asked one of the research folks at Avantis about the kind of a market that Avantis small cap value would not be amongst a better performer.
Interesting.
And they had three kinds of markets, but they were periods. In one case, it was the period when everybody likes small. Doesn't matter what it is, they like small, and there are periods that happens, and also the periods when the smallest of the small become a big deal. It's a very speculative kind of typical kind of a rush to chase performance at the end of a bull market kind of an event. But there are periods that they do not expect to be amongst the best performers, but with the market giving value to the quality of the portfolios, giving value to the low PE ratio, that the odds are in their favor. Now, that's what everybody in the business has a reason why they do what they do and can defend it, which is one of the frustrating parts of advice that people get when it comes to investing. But I interrupted you in your 6 steps. Why don't you, I'm sorry, let's go back to whatever step you were on, like 4?
I know. I think we'd actually gotten through most of them. So I'll just recap.
Okay.
So yeah, the first one is select the candidate funds for each of the asset classes. The second is collect the basic fund attributes from ETF.com, Morningstar, and then the third was analyze the historical fund factor exposures using the data from portfoliovisualizer.com. And the fourth is estimate expected fund returns based on the historical premiums. We talked about that. And then the fifth is select the best in-class funds for each of the asset classes. And the sixth is go back and run a Morningstar X-ray of the total portfolios that result and see if the portfolio does better than the old portfolio, meaning that ideally I'd like them to be just as small and just as value tilted and still have a low expense ratio. But the Morningstar X-ray also tells me things like what's the yield of the total portfolio and what's the expense ratio of the total portfolio. Interestingly, since I wrote this article, we now have the portfolio configurator on the website, where once I update the recommendations, you can see those same kinds of data, at least for the date when I updated it. You can see what the yields were between different choices of fund families or different portfolios and what the expense ratios were between them. So it's not necessarily up to date when you use it, but it is as a comparison tool. I think it's useful because some people are just totally passionate about keeping their expenses low, and they can go in and see, well, if I go all Vanguard, I can keep my expenses low, but maybe my portfolio is a little bit bigger. Maybe it's a little less value-y. And you could even go in and compensate and say, instead of the ultimate buy and hold, for example, maybe I'm going to switch and do something that is all value to compensate for the fact that I've got lower expense ratio and less of a value tilt in the ultimate buy and hold using Vanguard. Well, if I go all value, I can bring some of that back, or maybe you tilt a little more towards small in value. Yeah.
When you use the word tilt, I know when I first came upon that term and as it relates to these portfolios, tilting, as I understand it, is simply putting more small cap value in a portfolio than would be represented by the total market.
By a cap weighted total market index. That's exactly right.
And so because you're tilting, you really need to understand the implications of what it does to your risk, I guess. I mean, that would be the main thing we'd want to know. We do expect to get some premium for having taken this additional risk. But is there any better way than to look at what it does to the worst periods to judge that risk for investors? I mean, that's what we try to do with that fine-tuning table that compares small cap value to the S&P 500 in 10% increments, where you can see as you change the tilting that it does something to the return and it does something to the risk, and that's what you're likely to be signing up for. Is there anything more that a person can do to figure out what this tilting really means?
I think there are two risks we take on when we tilt, when we invest disproportionately in a part of the market, any part of the market. One of those is this, as you point out, if we're investing in small cap value, we're taking on more volatility. The interesting thing there is that when you combine the S&P 500 and small cap value, you get more of a boost in return than you get a boost in volatility, because they aren't perfectly correlated. They don't always zig and zag at the same time. And so the fact that now they're not singing in unison, so to speak, right? There's a little dissonance there, that's smoothing the ride a little bit for the added return that you get. And yes, the finding tuning tables are a great place to see that, but there's a whole nother piece, and we do talk about this, and that's tracking error. As soon as you decide to be different, you're not going to get the same ride and experience you hear about on the radio or on the news or from your neighbor. And sometimes that's going to be good, and sometimes that's going to be bad.
Yeah.
And when it's bad, if you stay the course, eventually it will probably be good. That's why we recommend it. But if you bail when it's bad because you're different and you feel like you're missing out, then you lose all of the benefit of being different, and you would have been better off just being the same from the beginning. And I think that's where the wisdom of Buffett and Bogle's advice comes from, is this idea that 90+% of people will never take the time to learn why they should be different to the degree they need to do it with conviction. Yeah. And that's one of the reasons I expect and hope that our audience is engaged for the long term, because in some respects, we're really trying to go deep. We're trying to help them develop an understanding of a principle that is it's hopefully going to be their secret weapon. When you look at it, one of the reasons why the small in value attributes of the market or the small in value premiums haven't gone away, even though they should be arbitraged, is that institutional investors can't invest with the patience that private investors can, that individual investors can. This is your secret weapon. This is your superpower, right? You can go for 5 years with some tracking error being different from the market and yet not outperforming and stay the course. An institutional investment manager is probably going to get hammered if he does that. And so it's hard for them to exercise this same muscle, this same superpower. But if you can learn it and you can make it yours, and you can invest with that conviction for 5 years, 10 years, 15 years, 20 years, you have the ability to beat the pro, because you're your own manager. You're not at the whims of somebody else who's looking over your shoulder saying, wait a minute, you underperformed last year.
And that really does happen. It's interesting that generally within the institutional market, if you underperform in your category, I mean, they are looking at the same asset class, but if you underperform for 3 years, they're going to find somebody who had a good performance the last 3 years. The part that is so remarkable, and I'm sure must be known by people that are working on these institutional accounts, the trustees and such, that the performance the following 3 years is generally better than the new funds you brought on, because you saw them perform well the last 3 years while yours weren't performing well, but they did if you had just held on. Yeah, stay the course. By the way, I did an interesting little study here because there's another purpose for your work, and I forgot to ask. How many hours would you guess you put into the process of going through all of the ETFs that qualify in each one of the asset classes? When you do this next year again, how many hours will it take you?
I would guess to 1 to 2 full-time weeks, so 40 to 80 hours, something like that.
Okay.
Because although it's systematic and it doesn't seem like it should take that long, I look at it multiple ways. I double check my work. I go back over all of the communications I've received from people about potential new funds that should be in the consideration set. And then there's preparing the material to communicate the conclusions once you've drawn them, and then there's recording some podcasts to share it as well. So yeah, I would guess it's at least a couple of man weeks, and it's fun and it's interesting, but it often comes at Christmas time.
Oh.
So if I don't get it done till the end of January, you know why.
Yeah.
It's because I enjoyed my Christmas.
Well, we sure appreciate you doing it, Chris. So here's another use for your work. I recently had a conversation that was set up by a fellow who has a podcast, and he asked J.L. Collins and myself if we'd like to have a conversation and to meet. And so we met online, and we had a conversation, and David was the moderator, but it turned out David didn't have much to do because we had lots to talk about. What a fun guy he is, and fascinating what he's done to help people. But he is a great fan of the total market index, and goes so far as to say that you could do all of your equity saving with just one fund, and that would be the Vanguard Total Market Index. And that could be an ETF, that could be a mutual fund. They both look virtually the same. In fact, I think they are actually legally have the same portfolio. But here's a question that I would have to ask. I could totally agree with him on, I don't mean that I would do that myself, but I could see why he can make the recommendation. It looks like the market, there'll be no surprises, and maybe you're more likely to stay the course. And of course, we're trying to make the case for adding some other asset classes. But if you were not going to add other asset classes, one could at least take a look at what you recommend in that position on all of those different asset classes. The large cap blend, which is what the total market index is VTI, is the one that he would be having people buy. And yet, when I look at your recommendation, AVUS, these are very different holdings in terms of the factors. And for example, and by the way, AVUS is kind of a total market index built with the biases that the academic people who are behind Avantis, they look at how you'd want to position yourself for the long term in what you might consider a total market index. So the average size, well, let's start with how many companies in the portfolio. AVUS has 2,300 and VTI is 3,700. And I don't know if would be an expectation of much difference in the return, because both of those are hugely diversified. I think academics say you need to have 100 companies in an asset class to eliminate the risk of company loss, one company failing. But I looked at the size, and the average size company in VTI is 169 billion, and AVUS is 82 billion. So they are about half the size. That would give a little bit of an advantage, wouldn't it, Chris?
It would, yeah. And in fact, when you run the factor regressions on size, what you see is that, well, VTI, since it's the total market, is essentially zero exposure to any factor other than the market. And the AVUS gives you roughly 10% of the size exposure of the size factor.
And the size factor,
so the size factor on the model I use has been historically about 2%. So if you get 10% or 2%, that's worth 0.2%.
well, so then you look at exposure to value. VTI is 22% value, and the AVUS is 31% value. So I'm thinking there's a good hit there as well. I mean, a good advantage.
And again, we can look at the factor exposure, and AVUS has given you about 16% exposure versus 0.03, which is again essentially zero. Let's call it 0.13%. The value factor, that's been worth 2.9%, 2.88%.
So I looked at the last 4.5 years because that's when AVUS was available, and I compared it at Morningstar, and the compound rate of return for AVUS was 12.96%, and for VTI 12.17%.
Which is about what these say you would expect. Yeah, you'd get another 0.5%-ish. Yeah.
So my feeling, I'm always looking for 0.5%. So it says to me that maybe we need to do an article, J.L. Collins versus Merriman and Pedersen, and actually show that that's something that one as an investor. What would you say the probability is? How would you measure the probability? Is there an easy way to do it, or off the top of your head?
Well, yeah, I'd have to think about that and see if there's a way to say what the probability of those small tilts showing up in 1 year, 5 year, 10 years,
20 years from everything I can remember was the period that it always did better.
Historically, over the sample we have, but you wouldn't, and Larry Swedroe likes to point this out, you really would never expect it to go to 100%. You would never expect a risk factor to deliver its premium over 100% of the any time horizon, because then it's not a risk factor. Then it's a guaranteed factor.
Right.
So there should always be some risk of underperformance.
Or it's part of a sales pitch.
It's really just that we don't have a long enough history to see all of these long tails. Yeah. But you would expect that with every passing year, the odds of underperformance goes down because you're diversifying by taking on these different attributes. And the more you have exposure to, the more consistent the performance you would expect to get.
And also in my little study, I looked at the S&P 500, VOO, and I found it interesting. It compounded at 12.82. Now, that's quite an advantage over VTI. Over the last 96 years, it's been a 0.1% difference, according to the academic studies, the S&P 500 versus the total market index. So anyway, I think that's an interesting way to use your work. It doesn't have to be to build one of our portfolios. A person could use your work to give them some ideas on how they could build their own personal asset allocation. And
you've indirectly brought up here, as we went through these different examples, an important point, and that's that the farther you get away from the total market or the S&P 500, the more likely there's a difference between the returns that you could get with different fund constructions. And that's one of the reasons that small cap value has this higher expected boost in your portfolio performance, is that there's a lot of variation in small companies. There's thousands of small companies, and there's a lot of room for variety. When you're looking at the big companies and you've only got 500 or 600 to choose from, and everybody on the planet is analyzing them to death, you don't expect that there's going to be much dispersion or range of returns to be had. And so that's why there's not as much difference in the fund choices for S&P 500 or total market or up in that category. But there's quite a bit of difference in small cap value, and there's quite a bit of difference in international funds and in emerging markets funds. And if you really want to go to the extremes, the emerging markets, small in value. But there we run into a different problem, and that's just there aren't very many. There aren't very many to choose from. Yeah. And so small cap value, to me, really hits this sweet spot where there's a lot of choice in the number of funds and providers there. And a lot of variety in the returns to be had. So it's the rich spot. It's the place where I think the greatest opportunity is.
I think that we've probably given people enough information for one day. We do have more questions on best in class, but there is one that I think is really interesting. And that is, and it's a great question. When you think of small companies, the reason that we are interested in small companies emotionally is we see the possibility to the upside. Any one of them, if they could invent something that's really special, you could have not a 10 bagger, you could have 1,000 banger or 100 banger, and so that's the view of small. And yet, when these small cap value funds are building a portfolio, they are not intending to own Microsoft from the day it goes public and until today, because it is going to well, it may never be a small cap value, although I think at one point it came back down in 2000 to qualify to be a large cap value company. It had fallen so much. But the question is, how does a small cap value fund deal with the company getting bigger? And then after I had a conversation with the people at Advantis about this, and I wish you had been able to be there, you were out traveling the world, what they talk about is the company gets up to the mid cap, right there at the line where it's going to go from small cap to mid cap. And so they can't just sell it then, because if it falls back down the next day into small cap, then it's supposed to be in the small cap fund. So they have a formula they use. Everything is systematic there. They have a formula that when it goes through, it has to go through enough that it protects. It really is a move out of small cap to mid cap. But then they still have a systematic way, and I believe this is true at DFA as well, of using momentum and letting the company continue and watching it. And when it loses its momentum, and they show me some great examples of some well-known companies, by the way, of where they use this strategy. So they are not there with the small company forever. They did, by the way, participate in the GameStop, as so did DFA. And DFA claimed to sell at over 300. The formula at Advantis got them out at about 150. And so it still worked. But they, of course, in hindsight, you always know what you should have done in hindsight. But that is the thing about small blend, small value. you're not going to have the big run of a stock forever, like a Nvidia or Google or any of these stocks that are in the big seven. What is the term for the big seven?
I don't know right now.
You're the one I thought would know that one. Anyway, doesn't matter.
I mean, for a while there were FANG stocks, but that doesn't include
Yeah.
Nvidia. I don't think that was
Yeah.
Netflix for the end, but Nvidia probably belongs in there more than Netflix now. Yeah,
They certainly do now.
Did you have more on that, Paul? Because we did have a
No,
question related.
Do you have a comment on that too?
Well, we had a question that came in.
Oh, I've got it. I think it's number 4 here. Chris, I appreciate all the work you and the Merriman team have done over the years. I became a fan of the podcast a few years ago, and I've learned a lot. One question that I have that I can't quite get my head around concerns what happens when a value stock fund, for example, AVUV, becomes popular and attracts a lot of investors. I guess, is that the one you're talking about?
Yeah, doesn't the increased demand for the stocks the fund holds drive up their prices, resulting in those stocks no longer being considered value, and thus undermining the original investment thesis? And the same thing would be true about size, right? It's, now they're going to have market caps that are bigger. And you kind of touched on this in your discussion about momentum. Eventually, they'll leave the fund because they get too big. The way these funds define their selection set is as a percentile of the market. So if all of the stocks that are in a fund become overvalued, there'll be other ones that are undervalued, and there will be other stocks that are small. So there will always be a bottom 10 percentile, 20 percentile to the market. The other piece that goes along with this is, as successful as AVUV has been, I think they have 11 billion in assets under management now. It's still a tiny part of the market. Yeah. So it's not, I don't think they're running out of space, but it does happen. It does happen that funds, Vanguard runs into this issue at times. It does happen that you end up with a fund that is kind of too big for its category. And often that leads to the creation of a new fund that can occupy that space while that fund is no longer as small and no longer as value-y. But I don't think Avantis is there yet.
What is interesting to me is how low the turnover is at Avantis small cap value. I believe I want to say 8%, but whatever. It's a low number, and one of the Vanguard small cap value ETFs is 45%, which was shocking. I was actually shocked about both of them because I just figured that Avantis, with their strategy, and by the way, short-term trades do not have the same tax impact in an ETF that they do in a regular mutual fund. It's a whole different world.
Yeah, the turnover doesn't matter as much in an ETF wrapper. Yeah.
Right. So anyway, Chris, thanks for all that you've done. We'll come back when we get Daryl back. We're going to have him back in the coming weeks. We got a whole bunch of questions to answer about the other parts of boot camp that we've focused on. We hope people continue to send us questions. I know we don't get to everyone, but we'll try harder. And thank you for all of you who keep coming back and Chris, you're a great teacher, and
right back at you, Paul. It's fun. It's fun. We're having a good time.
Yeah, you got it. Take care, and everybody have a great week. Thank you. It gives me great pleasure to introduce a dear friend, a member of the board of directors of our foundation, a man who has been dedicated almost as long as I have to educating people about the process of investing. And this friend, and by the way, he's also the author of a terrific book. We're going to talk about that book today, Spending Your Way to Wealth. Notice that little, we'll get to that in a few minutes. But I want to introduce Paul Hayes. Paul, welcome to Sound Investing. Great to have you here.
Well, thanks for the invitation to be here. I'm glad to share some ideas and thoughts with you and your audience.
Terrific. Before I let you loose here, because you got a lot to share, I want to tell you how different the work that Paul and I do is. It's not that we don't understand what the other person is doing, but our focus is very different. And I'm going to share my focus so that Paul can then differentiate between what he has focused on in helping investors. And they're both, I think, very, very important. And in my case, I'm the numbers guy. I'm the guy that's trying to teach people about risk and return and asset class diversification and identifying the asset classes and how to put them together and how to take money out of the portfolio, how to put money in the portfolio. It all has to do, in a sense, with the physical aspect of investing and the decisions that revolve around those step-by-step things that you might do. I want to make sure you don't pay too much in taxes. I want to make sure you have low expenses. I want to make sure you have an index fund. There's a whole list of things that I want to see you doing if I can convince you that's the right thing to do, because I believe they will lead to higher rates of return. And by the way, I'm going to put a number on that. I'm going to say that if you don't properly control expenses, control diversification, control active versus passive management, control the taxation of your earnings, it could be costing you 4% a year in returns. And then if you hired and paid somebody 1% a year, it could be 5% a year in your returns. So these are big, important decisions. But Paul, outside of all this physical stuff, let's get in to that part that you focus on, really what I consider, I'm not going to call it woo-woo, I'm not going to. I'm just going to say that it's the kind of the emotional aspects of this process, which is not a part of what I teach.
Well, that's where my focus lies. Go back 50 years when I started as a financial advisor, and for the next 25 years as a financial advisor, I was always interested in the different returns that people got when they were making the same kinds of choices often. It seemed like more often than not, the investor return, the duration of time they held something, determined the investment return for them. But it wasn't really the investment return of the investment, because maybe they bought and sold so frequently or at the wrong time that they denied themselves the opportunity to maximize the return. And I was amazed at over 25 years that I seemed to find that maybe 5 or 6 or 10% of the people I dealt with really understood the basic difference that would make the difference in their return. And about 80% of the people, or 90%, always seemed to suffer from, I want to say, from being themselves, because we are humans and we fall victim to ourselves as we fall victim to the other things that enter into our decision making. So the book title, Spending Your Way to Wealth, focuses on the word spending, but that's not necessarily about money. Spending is something we do all the time, every day. It's our most frequent behavior. It's our most essential behavior. It's our life-saving behavior, because we spend energy as we spend money, and we spend time. We spend a lot of things other than just money. In fact, if you look at all the time spent on breathing, we spend 100% of our day spending. At night when we're asleep, our brain is working. It's causing our heart to beat. It's causing the blood to flow. So we're expending something all the time. So if it's our most common behavior, we need to take more time to analyze what our behavior is, why we behave the way we are, and who we are. And if you can somehow come to grips with the fact that we're human and we are prone to making sometimes very predictable mistakes, that's what I'm all about, is helping people understand who they are, challenge themselves to find out what are their biases, what makes them think the way they do, what makes them act the way they do, and that's why they get the results that they do. And if we can just become more aware of our human tendencies so that we can intervene as needed. And my book parallels the finding of probably the most essential and recognized psychologist in the world today, Daniel Kahneman. He spent a 30-year career explaining and probing into how people make financial decisions. And he came away with some very strong evidence to support that many of the decisions we just typically make are not necessarily wrong, but they aren't right to the fullest degree possible. He published, his work was the basis for his being awarded a Nobel Prize about 20 years ago now. And 10 years ago, he wrote a wonderful book that was the basis for his Nobel Prize called Thinking Fast and Slow. Most people have never read the book unless they're an economist. And if they're an economist, they know his name very well because he literally changed the minds and the way economists go about making financial decisions, changed the minds of economists throughout the world. And yet most of us, other than the economists, probably don't know who he is. So I am trying very hard to bring him to the forefront so that non-economists are as familiar with his findings and can benefit by understanding more about themselves. The back part of my book, there's a 15-page summary of Thinking Fast and Slow, that if all somebody read was that 15-page summary, they'd have a wonderful insight into themselves by somebody who got a Nobel Prize in understanding our behavior.
I think, Paul, that what you do that is so great. I mean, that little piece at the back of the book is golden. I mean, if people bought the book and even read that, that would be a huge step. But what you do that I find so important is you then take, and there are, as I recall, 48 different kinds of biases that we carry around in how we make our decisions. And then you apply those biases to show people how that becomes part of the investment process and how easy it is to get trapped or tricked into following your natural human instincts versus what with some intellectual focus would lead you to a very different decision. And I think that's a marvelous part about the book, but I didn't mean to interrupt as I always do. Please go right ahead.
Well, that's the essence of the book. And you say there's 40 some biases. I made a list of about 300 biases that I have. Oh. And when we really think about it, I mean, if you have an itch, you scratch it. You're biased to scratching an itch. We have biases we don't even think about. In fact, most of our biases are unconscious. They just happen. I'm biased to trying to be happy. I'm biased to being optimistic. I'm biased to being satisfied with whatever it is I'm trying to do. I have all kinds of biases. And the most helpful thing I ever did was sitting down and just analyzing what they are and why I have them. Are they something that's genetic? Was I born with them? Was it something that was environmental? Did I discover it along the way and become biased? We all have these biases. It's perfectly normal, and we need to have them. Kahneman in his book talks about two sides of the brain, or he doesn't talk about sides, two systems within the brain, system 1 and system 2. And the beauty of his work is he simplifies things to the point where we can all understand it if we just take the time to try. System 1 is the reason, and it's the instinctive and the impulsive part of our brain that lets us answer a question immediately without thinking. What's 2 and 2? 4. What's 37 times 28? Oh, geez, I might have to write that down to do the math. I can do it, but It takes a little deliberation. It's time consuming, it's energy consuming, it's tiring. So we're sort of we're loath to spend if we don't have to. Time, money, energy. We're loath to conserve everything so that we don't have to spend it. Because when we spend it, we get tired. You take a long exam and you come out exhausted. You work hard all day and you come away exhausted because that expenditure of energy and time does demand satisfaction. So understanding that aspect of the brain, system 1 and 2. Go ahead, Paul.
Can I ask you a question? Because I've never thought about this before, but the people, let's call them Wall Street, just for a way to identify them as a group of people who want us to buy something they have for sale. Do they have a different set of biases? I suspect they do. That is part of the sales pitch. And then we have a completely different set of biases to respond to that sales pitch. Is that the way it works? Everybody's trying to manipulate, going the easy way to get what they want?
Well, we all have a self-interest. It's perfectly normal and it's perfectly natural. And a business has a self-interest of staying in business. An individual who's a Buddhist monk, I don't mean to pick up a religion, but they may have a bias to just feeling good about humanity. They have no need for money. Everything's taken care of. So we can have different kinds of biases. Wall Street isn't all bad because they have a bias to stay in business. I left Wall Street completely, severed all ties with any kind of a Wall Street firm or any firm that sold or was involved in securities because I didn't want to have that perceived conflict of interest. I wanted to focus on an individual. And I collaborated for 25 years with a psychologist at the University of Washington, and we focused on performance. He was an enhancement performance psychologist. He worked with sports teams to help sports teams do better. Why would a manager of a ball game hire a psychologist to come in and talk to his players? Well, if you're standing at home plate in Yankee Stadium, you want to relax, you want to focus, you want to have the control over yourself. So thinking on the part of an athlete is a big part of winning. And he was delighted to take the time to really explore how people make financial decisions. How can we enhance our behavior? Well, you start by understanding the things that influence our behavior. And that's where we get back into biases. You know, why are we talking to each other today? We both have a bias towards helping people make good, sound investment decisions. We're not paid to help them do that. In fact, neither one of us are compensated. We have a financial education foundation each, and that's our whole focus. We just would like to see people prosper to a greater degree than most of them tend to default to. So just taking a little bit of time, take 10 minutes before you go to sleep at night, or 5 minutes before you go to sleep, and 5 minutes in the morning, or when you wake up in the middle of the night, and just think about who we are. Why do I have this notion that when I leave a room, I ought to turn a light out? That's a bias. No, a bias of turning on a light. Well, my dad used to run around the house when I was 5 and turn off the light when you leave the room. I think we're working for the electric company. Well, I'm biased because my dad, I guess, biased me, or he biased me to realizing the benefit of turning off a light. In my book, I talk about a woman who works at home and leaves lights on in the room when she leaves. And in the course of a 25-year career, 40-year career, I think in the example I used, she spent $70,000 on wasted electricity by not turning on a light. But if that same $70,000 had gone into an S&P index fund, here we're talking about a no-load mutual fund that invests in the 500 basic large companies in this country, she'd have $340,000. And that number, I think I may be a little high there, but it's enormous what a little bit of money amounts to over time. And that's where you're so helpful in pointing that out to people. And the magnitude is
So Paul, hit us with the number one, let's say the number one bias that keeps people from achieving their financial goals. Is there one that stands out?
Yeah, there's several that are probably almost equal to one another in terms of their prevalence and in terms of their essential impact they have on decisions. One is our fear of regret. You know, anything we do has a consequence. And if we think about the consequence and we think it's something that could be bad, then we don't do it because we don't want to look back and regret having done something. And we get much more dissatisfaction, much more emotional impact from losing money than we do from gaining a similar amount of money. Isn't that interesting? If we lose money, we lose $100 or we lose $1,000, it has a tremendous impact on us, much more than if we win $100 or make $1,000. And that regret is so prevalent, that fear of loss is so prevalent, it keeps us from doing something as essential as investing. And spending on investments is, another form of spending. We also have this notion that somehow we're smarter than we really are. You know, I think I'm intelligent, but if I ask 100 people in an audience to close their eyes and raise their hand if they think they're a better driver than everybody else in the room, about 70 or 75% of the hands go up. Statistically, it's not possible. You know, you can't have 70% of the people better than average because, you know, it can't be. But that idea that we just are smart. You know, we had a successful career or we're having a successful career. So I must be capable of doing just about anything, especially if it's investing, because all the time I see on TV, all these people are supposed experts and they're being reminded about the things they did last week or last month or last year that caused their performance to be either really good or really bad. And we have a great tendency to want to follow a herd. You know, that's a bias that we have. Stay with the crowd. You know, you're never really wrong if you're with the crowd all the time, unless the crowd is always wrong, in which case you are wrong. So just recognizing those biases and teaching ourselves to overcome those biases by shifting things from system one to system two. Think about it a little bit longer. Why do I think that? Why do I like blue better than green? Well, I don't know. I do. So if I'm aware of it, you know, maybe if somebody wraps their product in green, I'll be more inclined to buy it. Well, it doesn't make the product any better. They're just playing to my bias.
Yes, yes.
Well, this tendency to always think that we're smarter than others is an overwhelming bias because it makes us think we can do things that we probably can't do as well as we would like to. The tendency to follow a crowd, kind of a herd mentality. That's part of our basic nature. If we stay with the herd, you know, we probably are going to be okay. The herd will protect us, and the herd probably won't all be wrong. But sometimes the herd is wrong, and sometimes that herd mentality really works against us, especially in bubbles in the financial market or in periods of drought, where everybody is sort of down in the dumps and in the gloom, and or everybody is thinking everything is wonderful, all a Pollyannish attitude. Financial markets have a behavior of their own. It represents a crowd behavior. One day the crowd is optimistic, the next day they're pessimistic. And one year they're up, one year they're down. People think that they lose money if they have money invested in stocks in a portfolio or any kind of a financial asset. If the price or the value of those assets go down from day to day, which they will do, you haven't lost money necessarily, but we think of it as losing money. In fact, the commentators on the radio or TV will say, well, we lost money today. The markets were down. No, you didn't lose money any more than if somebody knocked on your door while we're talking now and said they'd like to buy your house for $100,000, legitimate offer. They might have had cash in hand. That doesn't make it a good offer. It doesn't mean that we should sell it. And we certainly don't need to mark down our financial statements because of some silly offer that somebody made. And that's the nature of financial markets, is the behavior. And the behavior of the markets is what caused the behavior of investors to often suffer.
Yeah, and Paul, I do think that this fear of law, in fact, all of these things you're talking about, I see it. Not only do I see it with individuals, I see it with sexes. I mean, I see, for example, I know from studies that women make better long-term investors than men do. The weakness with women has been that they don't invest enough, but they are better at buying and holding than men are, according to the studies that have been done. And so is whether, you know, let's say they are the nesters, maybe they are the people who aren't as overconfident. Maybe men as a group are more overconfident than women. But you know, these biases can be very different from person to person, as you indicated, based on how you were raised. Your dad yelling at you or talking sternly at you about turning off the light, and my dad maybe giving me a little more than a light tap on my backside to encourage me not to do what I just did again. You know, all of those things have an impact on us. And a lot of people are truly, you said it, are afraid of losing money. They will never go in the stock market because they believe the money's going to be taken away from them. How do you help somebody in your book How do you help somebody get over that terrific, difficult bias?
Well, two ways. One, you show them the advantage of not having the bias that they have, and you show them the cost associated or the loss that's potentially derived from that bias. You can also recognize that, we're all biased. Men are biased differently than women. Society biases us to act a certain way or expects us to act a certain way. The man is perceived to be macho. He's perceived to be a higher risk taker. So they tend to kind of position themselves that way. The woman is probably two or three generations removed from where they were the housewife, and they worked on the farm maybe, and they didn't make the same kind of decisions. So I think society imposes a perceived bias on people, and if we perceive that that's a bias that we have, the only way to correct it is just take it away. Why do we think a loss is loss? A football coach that tells his team to go in and win the game doesn't tell them to go in and never lose a yard. He says, go in and win the game, knowing the only way to win the game is to risk losing yards. And so if you can get rid of the connection between loss and winning, or between loss, money, and losing value, we have to retrain ourselves. And retraining ourselves isn't easy. We are pretty rigid people. We tend to stick to our notion. When we look at biases, one of the biases that we have is confirmation bias. We look for people and we look for things that will confirm what we already believe. And we'll go out of our way to avoid listening to somebody talk about something that is contrary to our belief. We'll pick up a newspaper and read a contrary opinion often because we just don't want to. We don't like it. We've got to learn to do that. Scientists, when they just have a hypothesis, they will formulate the hypothesis and then they will go out to try to prove the hypothesis. They do that by finding evidence to support the hypothesis, and they find people that oppose the hypothesis and find out why they oppose it. And if you can dispense with the opposition by showing that the opposition was wrong, and you can find enough evidence to support your hypothesis, you've got facts. And that's what people need to do. They need to become psychologists in a sense. I say that literally. I mean, we need to take time to think. So rarely.
So let me ask then. I think one of the toughest jobs we have as an investor is deciding the source or the person or a group that we can trust to give us the right information that's in our best interest. How do we deal with that? That must be a bias we have, that we don't trust people, or that sometimes we trust too easily. But what guidance would you give us in the world of trust?
Well, I don't like to use the word skeptic because it has negative connotations, but we need to be skeptical at times. We need to be not trust. We just need to take the time to ask ourselves, is this really an expert I'm listening to? Why do I think he's an expert? Is it because he's standing in front of a microphone or in front of a camera? Or is it because it has some kind of real claim on wisdom and the knowledge that is the basis for wisdom? That tendency to challenge our thinking is a basic belief that Kahneman had, and that is when you hear something that's intuitive, we know that 2 and 2 is 4. But if we stop long enough, we might want to shift it over. Why is it 4? First thing comes to mind when you hear the word up is down. Well, why is that? Well, we're biased to thinking in opposing terms. Up, down, win, lose, good, bad. If buy, worst thing that comes to mind when people hear the word buy is sell. It's not a good linkage at all. It might be the worst possible thing to think about if you're investing. If you buy something as an investment and the next thing you're thinking about is the word sell, and that thinking process drives a behavior and you then turn around and sell, you've allowed that. You need to be skeptical and just challenge what it is you believe.
Well, I think those are all great thoughts. Now, I want to make sure that we've hit the most important highlights of the book. we haven't told people that the book is free. I mean, I think that's important. So there's absolutely nothing that could stop you from ordering this book if you thought it would be helpful to your financial future. But what are the things in that book? You've got that list of approximately 48 biases from Kahneman. You've got things in there to help people overcome those biases. Any tools, anything that the book teaches you that can help you make decisions?
Yeah, be a little inventive, a little creative. Come up with some words that maybe you haven't heard before that you can use to influence your thinking going forward. In the book, I use the term spill. You know, you've never heard anybody talk about spilling money before, probably. Well, if we thought about it in those light, we'd probably try to avoid spilling money because spilling is messy, it's expensive to clean up, time consuming to clean up, and yet we spill money every day. Every time we spend, part of that expenditure goes towards spillage. So if we can just recognize that fact and say, okay, going forward, I am going to make a conscious effort to not spill money. Spilling is money that's spent that's not needed to be spent. You know, if you go to the convenience store to buy all your groceries, you probably pay more for the groceries there than if you go to the grocery store. That's convenience. We like convenience, but we also like not to spend more than we need to. So if going to the convenience store to buy all your groceries is a source of spilling money, then reallocate that money rather than spill it, reallocate it over into things that'll have future value, future financial value, or maybe just financial, non-financial value. We spend time with our family on vacations, you know, we're allocating our time. And the memories we have from spending time with a family are precious. You know, it's not as though we can't have rewards other than financial. We need those rewards. We need to feel satisfied with what we're doing. We need to feel good about ourselves. But take the time to explore the meaning of words. You've probably, or most people, have never seen the word wealth written out, like in the title of the book. Why is that? Well, most people, when you ask them what the plural of word wealth is, they say, well, I think it is already plural. I don't think there is a plural. Well, sure there is. Because you can have a wealth of integrity. You could have a wealth of knowledge. You could have a wealth of joy. You could have a wealth of decency. You could have a wealth of great memories. Those are all wealths. So wealth is an abundance of something of value. Wealth is an abundance of things of value. So if there are things of value, we should strive to achieve them. So the striving for wealths, plural, take away the financial aspect of it. If you don't like to be thought of in terms of just trying to obtain money, just go for the wealths that are important. Go for a greater wealth of knowledge. Take the time to learn something new, a greater wealth of friendships, get to know some new people. Take the time to know yourself better. Have a wealth of knowledge about yourself. So finding ways to kind of keep yourself on the path and find out where you are today. You know, where are you financially today? If you're looking at your future and your future retirement is, say, 20, 30, 40 years from now, things are going to be very different then. Just go back and look 25 years ago. What was a house worth, the average house? What's it worth today? Well, if the increment in 25 years was such and such, what would it be if it was that same increment in the next 25 years? That house would be $6 million, maybe. It's hard to believe. Our minds are very limited in terms of what they can kind of comprehend and even consider.
Calculators help, don't they? Calculators.
Oh,
I think
yeah.
you have a calculator or two in the book.
Well, yeah. Having the ability to look at what a cost of a latte, $5 for a latte, you know, that's only $5. I've got $6 in my pocket, so I'll still have $1 left over when I spill that latte. Well, don't spill it all. Buy a coffee with cream in it and something you enjoy. You need time out. You need to relax, re-energize yourself. Take some of that money that might have been spilled otherwise and allocate it into that investment account that's going to be worth more in the future. You're going to need a lot more in the future than you probably stop to realize. I bought a car in 1978 because I literally needed a new car. And so I went down to, and I'm pretty thrifty. So, and I've been around engines a lot, and I like diesel engines because they're cheaper to operate. The fuel is less expensive. They last longer. So I went down and I went to the dealer and I asked him if any used diesel cars. And he said, yeah, we took one in yesterday. And he took me out back. He showed me this really good looking car. It's only 3 years old, not a scratch on it. And had a diesel engine in it, and it had been owned by a minister who drove it around his local community every day, and that was the extent of the use. And he took it to the dealer every year to have it serviced. And I got home and I had this nice 3-year-old car, and I looked at it and I climbed in the back seat because I'd never been in the back seat of it before. And in the back pocket of the driver's seat was a brochure for a brand new one. This dealer was smart. He figured eventually I'd get around to seeing this thing. So I pulled it out and I looked at it and I thought, I didn't realize they changed the body style. This new body style is really much nicer than the car I'm sitting in. And I thumbed through the brochure and I said, oh man, you can get this car with leather. I love leather. So I took the car back the next day to the dealer. And I said, hey, if we could just reverse that transaction yesterday, how much more would it cost me to buy a new one? He said, 10,000 about. And I was in a position to be able to say, okay. So I gave him $10,000 and I drove away in a brand new car. Oh man, did I ever feel good? This was prestige at its finest. My ego, my self-esteem was enhanced. I just wanted people to see me in that. Well, that was 40 years ago, 45 years ago, actually. If instead of giving that $10,000 to the dealer, put in his pocket, or maybe in his investment account, I had put it into my investment account, an S&P index fund, that $10,000 today would be worth $748,000. That's the loss that I incurred as a result of allowing my emotion to carry the day. And, fortunately, I learned from it. I haven't gone out and bought any new cars since. I'll buy something 3 or 4 years old because I don't want to spill the money that would be depreciated away. So start thinking differently. Start challenging. Look back at what you've done in the past. And don't look back with regret if you would have done things differently. Look back and learn. Look back and say, oh, man, if I'd have just taken advantage of some of those things that I thought were just, going to be the doom and gloom of the world. The market crashed. Oh my gosh, it's 1984. Market just went to 40% lower than it had been. Oh, why would I ever think of buying then? Well, now look back at it. How many times has the market crashed between then and now? How many opportunities have you had to step in at a time when it seems unpopular to do what tends to be very, very popular over extended times? So be different. That's what this book is about. If you could read one book, somebody said, this would be the book they would read twice, first and last, because it's very different. It's about who you are. And the chapters that precede that summary of thinking fast and slow, those are just nothing more than applications of those principles that Kahneman talked about. They're tools. They'll help you get over being yourself and go on to being somebody that you can be, and you can be, and just it's a little bit of effort.
So Paul, let's make sure that our viewers and listeners will know where to get this book. One place they'll be able to get it is in the notes in this conversation. There'll be a link to that. It also, if people want to pay for it, is it available at Amazon, or did you take it down from Amazon?
Well, I wanted the information out in the public domain. I would like to have some of the comments that people have made that every person in high school should be required to read this book. And so trying to sell a book, it makes it sound like the author's trying to make money. And I'm not trying to make money on this. I don't need it. I live very comfortably. But I would love to see the concepts of spending your way to wealth broadened to where more people benefit from it. So I'm giving the book away, giving it away. Anybody that wants it, I consider anybody is capable of being an educator, a parent, a grandparent, a teacher, an administrator in a school, a state official. We're all educators. I would like to see this book in the hands of a lot of people who might not read much of it. They don't need to read much of it. They just need to read a little bit of it at a time to gain new insights and think, wow, that's pretty remarkable. I need to be more like that. Not big changes, just not a change in mind, just change in direction. I'm going to allocate more money into things that are going to be worth more in the future because I've taken the time to know how much I'm going to need. I'm not just going to let a wag or a guess tell me what I'm going to need. I'm going to sit down and really give it some serious thought. And you can do that in less than 15, 20 minutes if you just try. Just do the multiplication. The hamburger that costs $5 a pound today in 50 years is going to cost, well, it's going to cost 4 times that.
Yeah.
$16 a pound. But if that money that went into the hamburger, if half of it went into the S&P index fund, you'd have well over $1 million.
Yeah.
So
it is hard for people to believe the impact of compounding over time. $100 in the S&P 500 96 years ago is worth just a little under $1 million. In the small cap value, it's just a little under, I think, $15 million. And so the problem is finding people who have 96 years to live. But you know something, many of us have those people in our lives. And so here's the challenge. I know how to show people how to put money away for their children and their grandchildren, for a newborn child, and how to do that for the next 100 years. The problem is having the child or the grandchild have their head on straight about this process. And unfortunately, so many of these young people are tapped out by the emotions of fear of missing out, or you only live once, FOMO and YOLO. Do you think this book in any way addresses the FOMO and YOLO that we're trying to figure out how to, impress on our kids to overcome those short-term emotions? You think it's there in the book?
Well, it's the main thrust of the book is to get people to think in those terms. You go to www.investorship.com. That's a word that people haven't heard before, but it's a word that describes the mental faculties of people who are really good financial decision makers. Warren Buffett has investorship qualities. He thinks differently. He does things differently, and he does things better from a financial point of view, and he lives a much fuller life because of what he does. Our minds are wonderful things if we'll use them, but we tend to not use them as much as we should. If I asked somebody, if you took a penny and doubled it every day for 31 days, what would you have? And they'd be a penny, 2 pennies, 4 pennies, so on. And I asked people in a large crowd to shout out a number. And, the numbers that come out anywhere from, $90,000 to maybe 600,000-700,000. Yeah, that's about the range. And most people are around under 100,000. The answer to that question, doubling a penny every day for 31 days, you'd have $21 million. People can't comprehend that. In fact, if I tell somebody that, the tendency is to not believe it.
Right.
If I'm a financial advisor and I told somebody that, they'd think this guy doesn't know what he's talking about. And they go find somebody that said something that sounded more reasonable. Just take that ledger page, 1 through 31, and take 1, 2, 4. We've anchored ourselves. This is another bias we have. We anchored ourselves to that 1 cent, 2 cent, 4 cent. We anchored ourselves to a low thinking number. We didn't allow ourselves to think, oh man, that could be an awful lot. So again, just thinking differently, getting the book. If all you did was buy the book and put it under your pillow, and all you did was look at the cover every day, and you saw that spilling, and the cover has got 6 characters on it, 2 grandparents, 2 parents, and 2 kids, and all of them have money flowing out of their purse and out of their wallet and out of their, they're spilling money.
They're spilling, yeah.
And the grandfather's looking back rather chagrined and wishing, I wish those kids didn't do all that, because I know what's going to be the consequence. But just get the book and open it up and read 1 page. Read something that's so different that you start thinking, I better read some more.
And Paul, I want to make it clear, because a minute ago you said, and you go buy the book. I know it's available free on our website, on your website. Is it for people who'd like to hold the book? Is it available at Amazon at this point?
Yes.
Okay.
Yeah,
so
Amazon, any bookstore can order it for you. But
okay.
I would suggest you do 2 things. One, you download the book so you've got it on your iPad or your iPhone that you can look at when you're traveling or when you just get the time to spend a few minutes. But then have the book at home on your bookshelf and have it around where the kids can pick it up and look at it. Buy a couple of copies and give it to a friend. Some people I know have bought multiple copies of hundreds. The first batch of books I sold went to a financial advisor who wanted to give it to their clients and bought large quantities of it to give away. So, my interest is having people read it, whether they buy it or whether they get the electronic version of it. I think the electronic version is wonderful. All you have to do is click on a QR code and it'll download automatically, or take a picture of the QR code, and it's so easy to get for nothing. You can do it before you leave the room you're sitting in right now.
Right. Well, Paul, you are magnificent. I have appreciated your energy, your commitment to helping others for as long as I've known you. And people don't know that you actually had an investor ship. You had a boat, beautiful boat that you taught classes in called Investor Ship. I loved it. And I think the work you do is great. And this is a great way, I think, for people to be spending their retirement. I don't know that our wives would necessarily agree with that comment, but I know that you and I are having a good time helping others. Thank you very much. Any parting words, anything, a famous saying that you hope people will never forget?
I would hope everybody avails themselves of a diversified portfolio of wealths.
Okay, that's great. I'll be working on that. Thank you, Paul.
Good to talk to you, Paul.
All
Thanks
right.
for having me.
You
Bye-bye.
bet.
I'd like you ask you about buy and hold, the ultimate buy and hold portfolio. I'm developing here a software of mine which is just backtesting different portfolios, not only passive, also active, but there are like now over 40, let's say, passive portfolios. And what I like about your portfolio is that you can see a massive diversification in it. Maybe it's a bit overwhelming to someone who's really a novice investor, but what I like, it's really heavily, massively diversified. So if you could just tell us the philosophy behind the ultimate buy and hold portfolio. And also, by the way, just one more remark. What I liked is the steps you were showing, how you are building that portfolio, adding more and more pieces into it, and how it was influencing, how it was, had the impact on the performance. So I think that path is also very, very good to understand the whole process behind it.
And that article, by the way, that we update every year, Jack, about the ultimate buy and hold strategy, we originally wrote that in the 90s. And we've been updating it every year. And basically it takes about 10 minutes to update because somebody has to run the numbers to see the implications of that series of decisions. First of all, the word ultimate. I am not pretending that ultimate equals return. I have no idea where the best place to put all of your money. If I actually had to bet serious money on it, I would say small cap value. Put everything in small cap value. Or maybe I might say put everything in emerging markets small cap value. I mean, I could pick one asset class that's very risky and is likely to be rewarded for having taken that risk. But because I'm a defensive guy, I wanted to build a portfolio that included all of the asset classes that the academics said were likely to produce a premium for the risk that you took. And certainly, how many people have we heard that believe that it's hard to beat the S&P 500? And the academics show that the S&P 500 made about 5% more a year historically over bonds. So That's huge. That is huge. Every 0.5% should add $1 million to the value of your portfolio over a lifetime if you invest in a conservative way. You don't have to be aggressive. But I like the S&P 500. But then I see that large cap value is another asset class all by itself. You see, the S&P 500 is mostly growth. It's cap weighted, so those very big companies there represent most of the upside and downside movement on a day-by-day basis. It's not the little companies in the S&P 500. So what do I know? That let's call that more of a growth, but then there's this group of stocks that are out of favor. And the academics have taken the time to show why that is a different asset class. And it's amazing how different it can be one day at a time. The market yesterday, it was a bad day in the market, but not for large cap value. Large cap value made money yesterday. But large cap growth lost a bunch of money yesterday. So I say, okay, let's have some large cap value in the portfolio, but not a lot. Let's just have 90% in the S&P 500, 10% in large cap value. Does it make a difference? Well, I don't remember the exact number, but it's about 0.2% more return because I add 10% in large cap value. But then there's small cap blend, another asset class that actually makes more than the S&P 500 because it's more risky. And when you add that to the portfolio, it makes another approximately 0.2%. But what about the volatility? What's happening to the risk you're taking? Are you taking high risk when you add a little bit of this and a little bit of that? Turns out you don't, as a matter of fact. The volatility is about the same. And you keep doing this. Small cap value, REITs, international large cap blend, international large cap value, international small cap blend and small cap value, and emerging markets. You put 10% in each one. Remember, I said the smart thing to do based on the past was put everything in small cap value. But no, I don't want to do that. I think that's too risky. And so the portfolio is built to own all of them. And this is where John Bogle said, Paul, you're nuts. They aren't going to do it. And John Bogle is right. So what do? It turns out you get virtually the same return with 4 funds instead of 10. Those 4 funds in the US, large cap blend, large cap value, small cap blend, small cap value. You want to add internationals? Can do that with 4 funds too. US large cap blend, international large cap value. International small cap blend, US small cap value. About the same return again. Now you need to know, what ETF should I own to have those 10 or 4 investments? And we give them to you. Chris Pedersen has taken the time, an engineer by trade. I just interviewed him yesterday. His grandfather taught him to say when he was 2 years old, I am a financial wizard. That's what he taught him to say. And doggone it if he didn't become one. But he has taken the time to go through all of the ETFs to pick the ones, whether you're looking at 4 funds globally or the US or the 10 funds, so that you can build your own portfolio. And we don't make 1 penny.
You're also a big fan of the small cap value, and I saw some article there. I don't know if you had a chance to look at it, earlyretirement.now.com, and there's a counter argument that the small cap value, indeed they are good, but when we are looking in the old history, then maybe the data is not of very good quality. Or also maybe that that was working in the past, but it's not going to work now. I mean, to be honest, for me, I don't have a strong opinion on that. I think that we have to be just very patient, and the history showed that definitely what Professor Fama and Professor French were teaching us, that there is something in it. But how would you respond to that article that there is maybe it was maybe a party which is over?
Well, I know that well. That article was written after I had an interview with the folks at Choose FI. And when I say I was saddened by it, I was only saddened by it because I really didn't have a chance to respond to it. And by the way, I am sure the folks that Choose FI would have allowed me to if I had asked, but I thought if they thought it was important enough, they would ask me to respond. But here is the response. Daryl Balls, he's our director of analytics, another engineer, retired engineer from systems analyst from Boeing and manager. And he does some marvelous work. But one of the things he built was a telltale chart for small cap value versus the S&P 500. And what you will quickly see, if you kind of look just at the bottom line, is over the last 90 some years, the small cap value has produced about 14 times higher return than the S&P 500,
Yeah.
which should not be a shock because small cap value is more risky. But what people are not ready for is that you have to be willing to live through periods of 10 to 20 years of, I'll call it underperformance. And the reason I call it underperformance is because for that 10 or 20 years, you basically end up producing the same return as the S&P 500. You did it and you didn't get a premium. But then the premium comes and has tended to come in very relatively short spurts of time. And this, unfortunately, is the problem that we have with any great investment asset class. I look, for example, at the S&P 500. Why aren't there studies coming out telling us that the expected rate of return of the S&P 500 in the future is going to be much less than the past? Because since the year 2000, in fact, from 2000 to a couple of years ago, the compound rate of return was about 5 or 5.5%. And like you mentioned, Jack, the previous 25 years, it was 17% compound rate of return. You know, what's wrong with this picture? Is there a change in the expected rate of return of the S&P 500, and that where we should be investing is in cryptocurrency? I mean, these are all decisions that investors have to make. And so when I say that I put my stock in terms of confidence in the academics, they don't hide the fact that there'll be long periods of underperformance. That's just baked in the cake. And there is not any asset class that has a long period of outperformance without going through these long periods of underperformance. And my challenge in trying to be an educator and help people make a lifetime decision for long after I'm gone is to convince them that there are a small group of asset classes that are likely to serve you well. And if you're lucky enough in the early years of investing in those asset classes, that the market is in decline, that people are losing money, and you are buying up these asset classes at discounted prices, I'm sorry I'm not there to break open the champagne with you, but by golly, if I could, I would, because that's what you should want, rather than being scared out of it and concluding this is the wrong thing to do.
All right. So would you agree with that saying that no pain, no gain, that in fact the small cap value, in order to capture that premium, we have to go through the periods which, as you say, underperform in the way that we are not even losing money, but we are maybe on the level of the S&P 500, or we are not receiving that premium. So there will be such periods, and if there would not be such periods, then there will be no premium for that risk.
But and Jack, there's one thing more. Small cap value is fine, but most people don't understand that small cap value runs a range from very large small cap value companies that aren't very deeply discounted value companies to very small cap value companies with very deeply discounted value companies. It's like multiple asset classes within one asset class, and it matters. I look at what Chris Pedersen, in his best in asset class recommendations at the first of this year, his choice for small cap value is a fund that has been developed by a company called Avantis. And Avantis so far this year is up about 48%, while other small cap value funds are up 25 to 30. It's not magic. It isn't like they did anything special. They happen to build their portfolios on average in a smaller cap value company with more deeply discounted value, with a focus on quality of earnings. So it is an asset class in essence by itself. And so I want people, the reason I would like people to know about our work is it's not about me, it's about the work that Chris Pedersen has done to look at each one of these ETFs. They all have a reason for why they are built the way they are.
And by the way, I think that that people who are working in that company, who set up that company, Avantis, they are coming from Dimensional, if I'm not wrong.
Yes.
Where Professor French and Fama are also involved.
And that is, again, this is all going back to the academic community.
Yeah. So I have a question regarding the ultimate buy and hold, because there are people also who are gold bugs or are strongly believing in gold, or maybe even broadly in commodities. But I know that you are not fan of both. I mean, gold and commodities as a group even. Would you be able to just explain a bit why you're not a big fan of commodities and gold in particular?
Well, part of this, I guess, I would credit to Warren Buffett, and part I would credit to Dennis Tilley. Dennis Tilley is the gentleman who runs that hedge fund I talked about, and he gave me a lesson on commodities and how they're priced and what kind of return one should expect. Gold first. Gold. There are myths about investing. I've got over 200 of them that I've accumulated over the years. Will be eventually part of a book of 1,000 things you should know about investing. But the myth is that gold performs well when the market declines, and the truth is that really isn't where historically you want to be when the market's in collapse. The best place to be historically is in long-term treasuries. Now, I'm cherry picking that because I know that when the market collapses, there is a rush to something that is very dependable, has a history of being dependable. Gold has a history of being very volatile. It hasn't got a history of being dependable. As a matter of fact, it's many times more risky than long-term treasury bonds. And yet the return over the last 50 plus years is very similar. So if I am going to own bonds or treasury bonds as a way of hedging against the catastrophic, that is what I would look to rather than gold. Now, that doesn't mean there aren't times when gold acts the way that people in the gold industry say it acts. There will be times it does. I have the good fortune of having friends in the gold industry that I've known for many, many decades. I have never been with my friends in the gold industry that don't have the ability to sit down and in 5 minutes convince me gold is the place to be. It's like asking an insurance salesperson, do I need insurance? The answer is yes. This is the thing to do. And so I just want to be realistic. Now, the commodities, what Dennis Tilley convinced me and showed me, remember, I am but a salesperson collecting information from really intelligent people and then passing it on. But basically, the expected rate of return is treasury bills less expenses. Sometimes it will be better. Sometimes it will be worse. I mean, if you looked at the last, I don't know, 20 years, commodities have lost substantial amounts of money. I don't have that right in front of me. But again, if I'm looking for something to act as an asset class that will to create stability during a declining market, I'm much more comfortable with long-term bonds. Having said that, I don't sit on long-term treasuries. I sit on short to intermediate and tips. The reason being is that I don't really look to these assets as a protection against the catastrophic so much as just to bring the volatility down. And the thing about long-term treasuries is when we have a big rise in interest rates, those long-term treasuries are going to be hit hard. Whereas the short to intermediate historically have very small losses during periods of rising interest rates. So it's always this interesting decision. In the 12, that book of We're Talking Millions, if you look at what I've done, I've taken you to a fork in the road, stocks versus bonds. What are the implications? How about mutual funds versus individual stocks? Why would I go one way or another? Index funds versus active management. Roth IRA versus regular IRA. There are forks in the road, and what I try to do to make it possible to think through these maybe hundreds of decisions that we make is I take them one at a time, and I look at the implication of each fork in the road. And then I think, if I've got to do 200 of them, okay, I'll do 200 of them, but they'll really be based on each one being an individual, carefully, unemotional decision that seems right from everything I know about the past without a conflict of interest.
And by the way, regarding commodities, before our interview, I checked the S&P Goldman Sachs Commodity Index, and in the last 50 years, the maximum drawdown was almost 90%. So because you compared this to bonds, so that's, I mean, the volatility and maximum drawdown was just terrible.
Now, Jack, I got to ask a question. You got me all excited here for a second. Are you saying your database has that information in there?
Yes, correct.
Wow. I know you're here to interview me, but can I just ask you, because I know that some of our listeners are going to be interested. Just give us, please, a handful of the databases that you have in there that go back a long time for people who like tracking that stuff.
So for major indexes, the data is going back even to the beginning of the 20th century. For things like, for example, commodities, it's like around 50 years. But most of the passive portfolios, if you build them in that software, you can backtest them for up to 50 or even 100 years, or even more than 100 years, which
Do
is,
you
I think,
reinvest the dividends?
Yes, of course. Yes. So of course it's including dividends. So it's a total return. So I think that looking into such a long history is giving us a lot of information about the markets, and it's a great way to learn about the markets and about our expectations to set them on the right level. And you mentioned, for example, now the bonds that you are more in the short term or intermediate.
Yeah.
And in fact, yes, for like 40 years, we had a period in which bonds in real terms were giving us the negative returns, and that was 40 years period from 1940 till like 1981. So there's nothing new, I would say, and just looking in such a long history, we can learn about it. And by the way, regarding this commodity index again, I think that it's so much popular among investors. It's because it's so volatile, and sometimes we can see in the news that it just is giving 100% return in the last 2 years, but this is just 2 years. But if you look on the really long term, in the 50 years time, you see that bonds are giving the same return with a much lower risk. So
I can also ask Jack, are your figures both real and nominal? You show both before and after inflation?
I have also nominal, so I mean nominal, and then I can also adjust them to inflation. So you can see how they look in the real terms after inflation adjustment.
And one more question: do you have monthly data or is it annual data?
So I have monthly data, especially the data which is going back decades. But for the last 20 years, I have also daily data. But the data which is going really very far, it's a monthly data.
So for people who are watching this, who are interested in looking and maybe even testing this kind of information, is your subscription? The thing I noticed, it's Windows based. Is it also available somehow for Mac?
Unfortunately not. I mean, you can run it on Mac, but you have to use, like, for example, Parallels Desktop, which is kind of running Windows on top of Mac. So I think that this is indeed a bit of problematic for those who are on Mac. Although I'm personally also a Mac user and I can run it on Windows. So it's for people who are really willing to have access to that. Even if they are on Mac, it should not be a obstacle which is not solvable. So I think there are ways to go around it.
So then I have to ask, what is the shortest period of time? What does it cost for a year to have access to all this?
So currently I have 2 plans, for 1 year and for 2 years, and the price for 1 year subscription, it's $179. So basically then you get, for the whole year, you have the application with all that historical data, plus you have access also to over 70 exchanges around the world with the current data, and also with the history going back to 30 years, daily data, here. So basically, from wherever you are located in the world, you can build a portfolio. And also, what is, I think, interesting for people who are not maybe living in the United States is that you can build a portfolio, and then you can see how it was performing in other currency. Let's say, like in Europe, you can see how it's performing in euro.
Wow.
If you are in, let's say, in Canada, in Canadian dollar. If you are in Japan, in Japanese yen, for example, so that you can see how that portfolio was, because there are differences, of course.
Yes.
If you buy even if you have a global exposure to the stock market, there is more than 50% of United States, but there is still like over 40% of other different currencies. So that portfolio will perform differently in different currencies. So you can check that as well. So I think to me, I think it's good for both purposes: the educational, and then also if you want to do the practical exercise and and just do your homework. If you are do-it-yourself investor and you want to do your homework properly, not only by reading the theory, but also just doing a real exercise, I think it's a great way to do so, because you have in one place everything you need. And obviously someone can say it's just only history, but that's what I wanted to ask you. How do you see that? That quite often I see people are criticizing that well, it's great tool, but it's just only telling us what happened, but what will happen. What I'm answering to these people is that, oh, well, I mean, I'm sorry, I don't have a data from the future yet, but I wish to have. But I don't think that investing is about, predicting the future, because no one knows the future. But the history is really telling us a lot. And I'm just wondering how you see that thing about backtesting, because it's very easy to criticize it, because people are saying that now this time is really different, and they are telling this, I believe, always. Probably when you were starting in the 60s, people were also saying that this time is different.
Always. That always is what they say, Jack. And my view is this, that as an investor myself, I want to know what are the range of returns that I should expect. Now, the problem is I am 78 years old, and I'm trying to make some sort of a judgment about the return that I'm going to get for the next 10 or 12 years, let's say, if I'm lucky to live that long. And there's nobody that can tell you, but I can tell you this. When I look at every 40-year period, and Daryl has got this information together for us, every 40-year period with the S&P 500, the average return was about 11%. Now, that's much higher than we normally think, except that when you look at all the 40-year periods, you quickly, when you start in 1928, you quickly get beyond the early 30s, and they no longer are part of the 40 years, and all of a sudden the return looks better. But I'm okay using the 10% as the expected long-term return, but I also know there's a chance it could be better. But I also know that the worst 40 years was 8.9%, and the best was 12.5% for the S&P 500. Now I want to know, what do the worst losses look like? Well, I know from history that there's a calendar year that I would have lost 43% on the S&P 500. There was another year I would have been up 54%. I can know all this stuff. And is there a value to it? Well, let me just give you one example where I can say, I told you so. And that is 2000 to 2009. The S&P 500 compounded at a negative approximately 1% a year. It had two bear markets, substantial bear markets, that took 50% of the value of the market before it recovered. And the compound rate of return from 1930 to 1939 was, or 29 to 38, I guess it is, was actually a little better. In other words, they'd already, if they believed, I've been showing them these periods looking backwards and saying, that's coming, folks. I can't guarantee you that's coming, but it's coming. And people are, well, that's not the same. You know, we have the SEC now, and we have the Investment Company Act of 1940, and all these reasons, and more people are involved in investing, not just a few people. Turns out, even with all those things going on, the loss was substantially the same as it was back in that period during the Depression. And that, to me, is helpful, because then I can also take that period from 2000 to 2009 and 1929 to 1938 and say, what if I had $1,000? What was it worth at the end of that period? What if I only had $100 a year to put in over that 10-year period? What did that look like? There are such huge lessons because, as you know, when you put $100 a year and you dollar cost average into that terrible market, you come out with a big win, not a big loss. So I do believe those old numbers have a lot of value, but I also know this. It's kind of like I recently did an article that had, and a podcast in December of 2019. I did a podcast that's had almost 500,000 opens. And the title is The Number One Reason to Buy Index Funds. And basically what I say on the podcast is that if you buy index funds, you don't have to talk to a salesperson ever. And that can pay huge rewards over a lifetime. People just don't know how big those rewards could be because if they buy the index fund and they never talk to a salesperson, they never know what might have happened had they talked to a salesperson or loan money to their uncle. But the same thing is true of looking backwards versus people who claim to see the future. I don't trust people who claim to see the future. I don't mean that they aren't trying their best to put a whole bunch of variables together and tell us what's going to come out of that. There's big money to be made selling that kind of information to folks. I understand that. But is it possible you would come to a conclusion that is totally unmoved by what really happens? Because what really happens is the random thing we didn't expect, like a pandemic. And then the pandemic turns out to be good for the economy rather than bad. I mean, go figure all these things that happen and then ask, am I better understanding the past and the nature of market movements, or do I look to some guru who can see into the future? I think they're con men and women. By that, I only mean they con themselves. They don't con me because they don't get to me. They are conning themselves. But I also understand that the nature of the human being is we make up stories about everything that happens in our lives. And it turns out that very few of the stories we make up are even true. So that's kind of how I feel about the past versus some sort of an evaluation of the future. I trust the past. And by the way, I trust the fact that the academics looked at it, not that they waited for me to get to it, because I was not qualified to get to it.
For example, to me, very surprising was when I looked at the results of the market during the Second World War, because you mentioned the COVID-19. When I looked at the data from 1939 till the end of 1945, we could expect that it was a nightmare for the markets. And in fact, yes, there were countries like Germany and Japan where the markets, there was like over 90% drawdown. But in total, the global markets, if you would look on monthly basis how they performed, it was really, you wouldn't, and I would just not show you the years, yep. You wouldn't tell that it's during the Second World War. As Winston Churchill was saying, it's business as usual. I mean, you wouldn't say that it was during the Second World War.
And it makes sense, does it? I mean, this is one of the challenges. We want to make sense out of something that doesn't care about what we believe. And the one thing that I've been teaching for 50 years, there is no risk in the past. We always know what we should have done. And it makes it look like, well, if we'd only done that one thing, we would have done well. In my case, I have a friend who basically has or had almost all of her money in Microsoft. There's a reason why she ended up with it. It wasn't exactly a pleasant story, but she ended up with it. And that made her super rich. Coca-Cola did that for people in Atlanta. But just because my friend got rich on Microsoft or Coca-Cola people, it doesn't mean that investing in Washington Mutual in the Pacific Northwest, which is went out of business, is a way to get rich. So that looking back, we got to be careful, because you can look back in a good way and you can look back in a bad way. And the bad way is the way that misleads you to come to conclusions that are more myth-based than reality-based.
All right.
By the way, Jack, because I know you're going to cut me off here in a minute, I really want to ask another question about your service.
Sure.
It seems to me, when I looked at it, you also include some market timing systems within
Correct.
the software that they get.
Correct. Currently, I have two systems there. One, I like very much the momentum anomaly, which is a kind of a trend following. Mm-hmm. But here, one of the system is based on ETFs. So basically, you can switch between stock or bonds as a when the markets are going down. And this system is based on one of the guests I had on my show, Gary Antonassi, who's a great researcher on momentum anomaly. And another one, it's I would say more aggressive, where you are basically, rather than, for example, buy momentum ETF, there is a system which is just making a ranking of stocks with the highest momentum, and then you rotate it like quarterly or monthly. It's very flexible, so it depends how you want to do it. And there is also risk parity, so it's pretty advanced system. But the whole thing is that it's all algorithmic. It's it's just you don't put any discretion in it, and you just follow it. You can backtest it, and then you have to stick to it. But I fully agree that we should avoid torturing the data as well. So I'm a big fan of mechanical approach, but also simple approach, because people, I think they have the feeling that if there is more moving parts, the strategy is probably better, which there is a higher risk of,
I agree.
curve fitting, for example. Yeah. But yes, you're right. It's not only the software. It's not only about the passive approach. There are also active strategies, and the more are on the way. So I'm still developing that. So there will be more on it. And to be honest, I personally, as I said, I do appreciate the buy and hold, although maybe it will change over time when I will be older and older, but now I still have majority of my personal capital under the active strategies, but they are 100% systematic. So I'm not a good discretionary investor, if you would ask me. I'm a terrible advisor.
So I get a lot of questions out of folks in Europe. It's not huge, but enough that I feel like I should be figuring out some way to respond. They are people who want to take, for example, our 4 ETF strategy, and they want to be able to somehow do it in Europe. Is there anything about what you have in your program that would help people do that in Europe?
Yes, it can actually help everyone wherever they are located, because you can use, so first of all, you can use the historical data before the era of ETFs. So then you can cover that period in the data which is built into the application. And then on top of it, you can fetch the data for specific ETFs. And as I said earlier, I have access, and it's part of the subscription, access to over 70 exchanges around the world, where you get access to the daily data for these stocks or ETFs or mutual funds or whatever. So basically you can build it, and you can even convert it into your local currency, so that you can see if you are living, let's say, in Turkey, and there is the Turkish lira is really now having a very, very volatile time. Then you can see how just investing globally can save you from being in such a volatile market as Turkey currently. So I think that even if you are in Europe or if you are in the United States, obviously in the United States, the problem, for example, in Europe is that most of the European investors, they don't have access to American ETFs by law, by regulations. So they are forced to basically use the ETFs which are listed on the stock exchanges in Europe, like in London, Amsterdam, and so on. But this is just a specific for European investors. But if someone is, on the other hand, living in the United States, then there is also no problem with that software. You can just use the ETFs you have in the United States. But the data before the era of ETFs it's I would say universal. So no matter, yeah. So I think it's pretty powerful.
Sounds like you're building a really neat business. I'm going to ask you a really personal question, and I know you can cut it out if you want. I started my company with $15,000 and a whole bunch of sweat equity, and I have to ask, what did you start your company with?
Actually, the major investment was my time.
Yeah,
that was my major investment. Okay, I'm still working as a software engineer in some commercial projects, so I just had to reduce the number of hours working there because I wouldn't have enough time on my project.
yeah.
But I can tell you that this project was mainly done by my personal effort. Now I have someone extra working with me, helping me with that.
Great.
But it's really, I would say, low cost project.
Yeah. That's great.
But I see it like a way to go. I mean, rather than investing a big bunch of money, I'm starting just putting just mainly my effort into it. And once I will see it's taking traction, then I can invest more into it. I'm quite also I would say defensive here. Maybe I should be more aggressive in terms of running a business, but that's how I see it. So yes, I didn't put a lot of investment into that in terms of money, mostly my work.
And now, are you a married man or a single man?
I'm a married man, so with the 2 kids already. So,
oh my gosh,
yeah.
You gotta
But
be careful, because I just tell you now, you've asked me a lot of questions about my past, and I can tell you there's some risk in being so passionate about your work that other people want some of that passion for them. I hope you're better about that than I am, because it really is a trap for people who are so involved in their work. I wish.
But
you well.
I'm happy to have a very wise and smart wife, because she understands me, and I think that it's really we are just a great couple. So I think that it works perfectly. But I think that she understands that I'm very passionate also. So she understands that I work maybe more than an average person, but I love what I'm doing. So
Great.
It works fine for us.
That's great. Well, I do wish you well. Do you have any more questions for me before I go down and see my wife?
Yes, sorry. Yeah, I know I was keeping you. I'm not going to keep you here for ages. Yeah, we are talking like almost 2 hours. So sorry for that. So let me just ask you the last question, or maybe just 2 questions. Last question. Today, when I was running in the park, I was listening to your podcast about cryptocurrencies, and quite often I get. And just a disclaimer: I'm not investing my personal money into cryptocurrencies. Although I'm still pretty young, I just overlooked that opportunity. I don't know, but I'm still very old-fashioned in terms of investing. That's my personal view. Although I'm not discouraging at all fully that you cannot put any money into it, but I wanted to know your approach into that. For example, quite often I get a question from other people: what if I would put 5% or 3% into a cryptocurrency? So I'm not going to put everything into it. Although, as I heard today on your podcast, there was a person saying that she doesn't want to invest on the stock market because it's too risky, and she put everything into the Bitcoin.
Well, the only money she ever put at risk was into Bitcoin. She didn't put everything. If I said everything, I overstated.
But at the same time, saying that stock market is risky. So how do you see that personally? 3-5% in the portfolio. Do you see it as a reasonable or not?
Well, that's just whether it's Bitcoin or individual stocks, the question is, people say, well, can't I have some play money? And my answer has always been, because I don't have any money invested that is play money, not a penny. It's just there to do the best it can for our family and the charitable causes that we care about. So I don't look to investing as a way to prove anything, or to buy more, to live a higher lifestyle because I hit a home run. I say that if you know you're not going to need that money later in life, if you know that, and the problem is we don't often know that, people who have lots of money. In fact, I think about people who are buying art and paying millions of dollars for, in essence, what is digital art, and so what am I to do with that? You know something? I don't care. I mean, they can have all the games they want. They can have the biggest yachts. They can fly to the moon if they want. It had nothing to do with my life. But I have to ask the question, for people who are going into cryptocurrencies, is there in fact a likely value there? I had a great interview yesterday with Chris Pedersen, who retired from NVIDIA. I think I'm saying that right. And he was fortunate to have worked at NVIDIA, because that obviously is been a really good investment, et cetera, and is involved in the blockchain part of this whole story. But he agrees that you can't say there's a value. You can say that there's a price people will pay, and that, in fact, the academics will say about the price of a stock that the value of the stock takes into consideration all of the known information. And I guess at some level, you could say the same thing about cryptocurrency. But just because a stock sells for 1,000 times earnings, you're not likely to get Warren Buffett to put any of his money into that company, because he would not likely see the value that he's looking for. So can you go to Las Vegas and gamble? Can you go online and gamble on football games? I've talked to a lot of young people who have put money into cryptocurrency. And I ask them enough questions to know they don't have any idea what they're invested in. And yet, what do I hear? I hear from the experts, don't invest in things you don't understand. All right, let's say that that's a good piece of advice. What do I do then when somebody asks me to explain cryptocurrency? Now, as you know, Jack, I punted on that, and I read from articles that I found that I felt represented something that gave some meaning to the whole cryptocurrency. But I walked away not believing that there's any value there. Having said that, coins used to be, shells used to be money. They were money. They were just as good as $1, a shell off the beach. What's that about? Well, it's about a different time, evidently. And I know, for example, that if you own some Confederate bonds, it's hard to cash them in and get the money back for those Confederate bonds because they're gone. And what are there? 100 plus cryptocurrencies now, right? I've seen some number. It's a lot. And will all of them survive? I doubt it. But not all the people that started companies to make cars survived. So it's hard. And so my belief is that I'm going to continue to give advice where I can somehow identify a value, and to encourage people who have invested in those mutual funds or ETFs to continue to hold them during the ups and downs, even though there will be points that it will be easy to say, seems overvalued to me. And there'll be points where it'll feel like, oh my God, I know it's going to go lower. That those responses, emotional responses, even though intellectually they make sense, I have been hoping that people will be able to override them, because the history is they don't do well trying to market time their emotions. But I worry for the young people who are going to likely blow a lot of money with the cryptocurrencies at some point. Um, I'll just share one other thing. People, we know what Bernie Madoff did was he created a Ponzi scheme. Lots of people know they're in a Ponzi scheme. This is a fascinating part of this. They know they're in a Ponzi scheme, but it is their intent to get out of the Ponzi scheme while the getting is good. And I suspect that many of the people who are in what may end up to look like a Ponzi scheme in the end, I don't know. I honestly don't know. That they will just be late to get out because it's hard to pull the plug, particularly when you become a millionaire. In fact, some guy put in $8,000. I don't know if this is real or imaginary, and now it's worth over $5 billion in one of the cryptocurrencies. I faced that very same problem personally. It wasn't with 18,000. It was with 15,000. It wasn't $5 billion, but it was enough to sell my company and have enough to live for the rest of our life. And others could go on. I could pass the baton of risk to them, and they could hopefully do well with it as we did well with it. But it's the same thing. At what point do you say enough and you pass the baton when you have been lucky? How many people who win a lottery blow it? Supposedly, most of them. I don't know how they do it or why they do it, but they do it according to the experts. And I think, boy, when you have that one chance in life, it'd be nice to be able to capture that value, not only for you, but for the people who survive you and the charities and folks, the causes that you believe in.
Yeah, thank you for that. All right, so really the last question, and I know it's like 2 hours now, but really the last one, and I think it should be the easiest one. As you are the author of many books and numerous articles, what do you propose to start with for a beginner investor? Because when I came to your website, there's so many, materials, so maybe someone can feel overwhelmed. So if you could just give a path to the beginner investor from what to start?
Well, there are three books in theory that are for the beginner investor on the site that are free. The one that I would probably recommend is We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement. Understand that each of those 12 ways is $1 million decision. Now, does that mean that if you do those 12, you could have 12 million plus? Absolutely. Does that mean you have to put up millions of dollars to get there? No. But it will give you the basics. And in the second half of that book, I talk about 2 funds for life in a very simple way. Now, Chris Pedersen has just published a book. All the profits go to our foundation. It is entitled 2 Funds for Life, and it's a 280-page book that goes into so much detail. I just think it is an absolutely wonderful book, but it's for people who want to take the time to dig and understand, because it's a lifetime discipline and worth understanding. We also have a book that's free entitled 101 investment decisions guaranteed to change your financial future, as well as another book for first-time investors. Those last two books are going to be updated in the coming 4 or 5 months. They were written when we started the foundation, and we have not updated them, but they are about to get an overhaul. But those 3 books ought to give you a lot of what you need. But the book of 12, boy, when you think that there are 12 things that could lead each to $1 million, that's worth reading and hopefully taking it seriously. And of course, as you know, Jack, we have, I think, 700 articles and podcasts, lots of videos. And for the people who are old timers and trying to figure out how to make the last part of their life work financially, I made a video for 10 people. In the old days, I would have walked in, this is pre-COVID, I would have walked into the Bainbridge Island Senior Center and I would have made my presentation to 10 people about my favorite 12 Vanguard funds for retirees. But instead, because I couldn't do that, we did it as a Zoom presentation. And then just for the fun of it, we put it on the internet. And we have had over 100,000 views of that Zoom presentation. So we're doing work for old people as well as young people. I've got to be there to help my friends that are the same age I am, and boy, I'm rooting for them. So I hope that I'm being of some help to your young followers, Jack, and I suspect you got some middle-aged followers as well. I am excited about sharing this interview with our podcast listeners. We may have to break it up into 2 parts, but only because, also because I want them to know about what you're doing. We have a lot of people who write to me wanting to know more about market timing, and I gently put them off. But you've done just a ton of stuff that I think will be of value. And I also think you're going to hear from some of our folks who are serious buy and holders who want to dig into more of the history, not just of the areas that we cover, but you're doing some other stuff that we don't touch on that I think they'll find of interest. So I wish you well with your program. We'll have a link when we write up the podcast to your site. And I wish you all the best with what you're doing. And again, thank you for having me on as a guest. I do appreciate it.
Thank you, Paul, very much for your time and for being so patient with me for over 2 hours. And big apologize to your wife. And by the way, I will send her the part of the video before we were recording it so that she can hear about your English as well.
You're a man of your word.
And by the way, I encourage everyone who's listening to us to visit my website. So in the show notes, I will put all the links to Paul's materials, to his books, to his website, paulmerriman.com. That's your website. So I will put all the information there and all the materials you mentioned. So I think it's a great reference and it's a great source of valuable. And I think also the problem in the investment area is that there are people who are also, some charlatans and stuff like that. Yeah. And here you are really the best quality knowledge, and I think it's a great value. So thank you so much, Paul, for your time. It's really highly appreciated. And have a good day. Thank you.
Okay, bye-bye.
Take care. Bye-bye. Hi, Paul. How are you?
Jack, I am fine, and thank you so much for inviting me to join you and the people who are following your work. I really do appreciate it.
Thank you so much for accepting my invitation. It's a great honor to me. Could you please introduce yourself, especially in the context of your investment career? I know that you're very well known in the industry. You're a legend, actually. But if you could just, for those who are really new to the markets, if you could just tell a few words about yourself, who you are, and about your investment career.
Well, it is interesting that you comment that I'm a legend because the reality is I'm a teacher. And I have spent my whole career since the 60s, 1960s, basically teaching people what I was learning about investing. And I will tell you, Jack, that what I teach today is very different from what I taught in the 60s. But I was around the industry in the 60s as a stockbroker. And it didn't take very long for me to figure out that there were some huge conflicts of interest. And so I left the industry and went out and did a number of other things from about the age of 23, 24 until I was, I guess, about 40. And then I basically, I mean, we talk about the FIRE movement and how people want to retire early. I didn't think of it that way, but I actually had accumulated enough at that point that I could at least theoretically retire. And so I retired and I started all over and I built a business offering not only teaching and teaching people how to do everything on their own, but if you didn't want to do it after you learned what you should do, I was happy to do it for you. And I really have to laugh because when I sold my ownership in my company in 2012, I think we had 1.5 billion plus under management. But when we started in 1983, we had nothing under management. And I had no idea I was going to build an investment advisory firm. So my minimum investment that I would help somebody, you had to have at least $2,000. And I charged you 1%, which meant that I was willing to work for you for a year for $20. So it was not a business model built to make anybody any money. But over time, people came to work with me. And as they did, we had to run it more like a business. But we never, ever gave up on the dedication to teaching people how to do it on their own. And then when I retired in 2012, I was unemployed for a few moments, maybe hours, and I had started this foundation, Merriman Financial Education Foundation, where we again teach people how to do this all on your own. But there are two things that are different. Number one is I don't make a penny. That's part of the deal. I'm not allowed to make any money here. And we're not teaching so that people can become a client. We're teaching so people really either are going to be a better client for somebody else or really learn how to be a do-it-yourself investor.
Thank you, Paul, for all the work you're doing for us for so many years. I really appreciate it. And by the way, on your website, there's so many articles and so many materials. I just don't know how you do it and how many hours you sleep per day, but it's just wonderful. But I'd like to use your great experience, which you gained over the years, because you basically have like over 50 years of investment experience, or you were on the markets also like for more than 50 years. Do you think, and by the way, I have so many questions today, so I apologize in advance. Do you think that the markets as such changed during that time? Is there maybe on the other side and anything that doesn't change? How do you see that?
Well, the market has changed a ton. The bottom line is that today, investing is so much more efficient than it was when I started in the mid 60s. And it's built so it's in the favor of the investor. That is a change because in the 60s you had an 8.5% load on almost every mutual fund, including bond funds, if you can believe it. In fact, when money market funds first came out, they tried to put a commission on those money market funds, but of course the public said, no way, we go to the banks and they don't charge us a commission to put our money away. Why should we pay you? And they quickly adjusted. That's one thing about Wall Street. If something's not working, they quickly adjust. And so today we have the index funds. We didn't have those when I started. Today we have commissionless trades. We have trades that the only real cost is a spread. And today the spread is not regulated as it was back in the 60s. And commissions are not regulated like they were in the 60s. And by the way, early in the 70s as well. So it is a whole new world for investors. The problem is that the emotions, I think, of investors today are very similar to the emotions and those challenges when I came into the industry over 50 years ago.
Okay, so we'll get back to these challenges, emotional challenges, because this is a big topic. But then I assume that obviously when you started in the 60s, you couldn't start as a passive investor because there was no such idea broadly known at that time yet. So you had to start as an active investor for sure. And then how your career was evolving, how you were evolving as an investor, how your philosophy, how your approach to the market was evolving over the time.
Well, I want to go back to the early thing you said there about active management versus passive. There were a lot of passive investors.
Okay.
In fact, today we would probably see them as do-it-yourself investors, because what they believed was you take the time to find 10 or 15 or 20 stocks and you invest in those stocks. You take the actual physical certificate, you put it in a lockbox, and the idea was you leave it there until you retire, and then you start taking out shares and liquidating them to pay for your retirement. And I have friends that are still doing that. They've been doing it all their life, and it is as close to a buy and hold as an investor that I know, because it is even less volatile than what an index fund would do. And so, yes, it did. But Wall Street didn't want that. Wall Street wanted activity, and that's where they make their money. So it is a tug of war for Wall Street, because they want my friends to sell out and go do something with that money and give us a chance to make a commission or something. But my career, after I left the brokerage business, I was in it less than 3 years as a salesperson, and I did not do anything in terms of investing for the public, except that I did some venture capital work and helped some small companies get started, and then eventually. And by the way, one of the things that happened to me, I love the randomness of life, Jack. When I was going to school in New York, and I went to a school while I was working for Harris Upham, which eventually becomes part of Smith Barney. So I was working for a New York firm. But while I was there going to the New York Institute of Finance, which is a fancy name for a sales training program, I met a fellow, his name was Sam, and Sam was a fellow who was in his mid 60s. I was a 22-year-old kid, and he was in his 60s. He had been a believer in market timing with point and figure strategies for decades. And he had retired from running a drug company in the Chicago area to become a stockbroker at age 65. So he was in New York. And a married guy. I was in New York and a married guy. Sam sat down and taught me point and figure. So I had my first serious introduction to what we would call market timing early on. And I was always attracted to that because my nature is to be defensive. I look at everything that we do in educating people to be better as an investor as a defensive step, whether it's lowering expenses or lowering turnover or lowering taxes or lowering investment management fees. Every one of those steps is one of defense to keep more money, hopefully, we never know, but hopefully in your pocket. And market timing I did not see it as a way to make more money. I saw it as a way to protect against losing money. And if you look at that period from the mid 60s through about, I don't know, 1982 or 83, people who invested in the market, many of them didn't make any money because they got caught by one market decline after another. And you had all the people who sold out at the bottom of those declines. And there were tons of people that had not been successful. And yet, those people who really bought and held, they did okay if they bought and held the right asset classes. So there were lessons there, and then there were lessons about market timing. So I come into the money management business in 1983, just after we've been through this very long period where people didn't use defensive strategies. And if they had used defensive strategies, they would have done okay. They wouldn't have gotten rich, but they would have made reasonable rates of return. And then I started business. And at that point, what I was doing was market timing. I was telling people when to move. In fact, we had a service. You would like this, Jack. We would call you. You would pay us an annual fee, and we would call you and say, we're moving, and here's what we're doing. And people would do that. And many of those people found out they couldn't do it. And so they hired us to do it for them. And then about 10 years later, we had a lot of clients that we were doing that for who had other money that was more traditional buy and hold kind of money. And they were asking us for help with that as well. And so we added that to our practice. So we showed people how to market time. We showed people how to buy and hold. In fact, I used to do a 6-hour workshop, 3 hours on buy and hold in the morning, 3 hours in the afternoon on market timing. And people would walk out of there and say, what does he believe in? It was confusing to people. And in fact, I believed in both. But as I spent more time in the trenches with clients and with students, I realized there is a huge difference between the ability to make buy and hold work for a lifetime and to make timing work for a lifetime.
That's fascinating what you are talking about in the respect of active and passive investment, and I will go back deeper into that in a while. But quite often you are saying in your podcast also that you are a big fan of using academic scientific knowledge. And you mentioned that, for example, Wall Street was not that interested about passive investing because obviously the commissions are lower paid to them. But someone may ask, on the other hand, why not use the knowledge of Wall Street because they are practitioners in the end? So why you are such a big fan of academic, scientific approach? Quite often you, for example, refer to Professor Fama, Professor French papers in your podcasts.
Well, I guess what we have to ask ourselves is, what does the evidence show? What is the evidence that says that Wall Street works on our behalf? First and foremost, like a fiduciary, somebody who always does what's in your best interest. That isn't true. And there are all sorts of ways that I can make that judgment about Wall Street. I've got a free book at my website entitled Get Smart or Get Screwed, How to Select the Best and Get the Most Out of Your Financial Advisor. And in that book, I have 80 reasons why I don't trust commission-based salespeople. I don't mean they're not nice people. I don't mean they don't make good dads and friends and whatever that, but they come with a conflict of interest that I think, as we think about what are the challenges of individual investors with the investing process, you might also ask, does a broker have some of the very same challenges? Because it even mixes in then their compensation, not only making decisions of what to buy and sell, but then how they make a living. And I just intuitively see enough fines being paid I mean, always these big brokerage firms will not admit guilt, of course, but they're paying these multi-million, sometimes multi-billion dollar fines. Where do they get the money to pay those fines? Out of our pockets. So just intuitively, I don't want to count on them to take care of my money for the rest of my life, nor do I want that to be the decision-making process for others. But what I do trust about the academic community is a couple levels of trust that are built in. One is their job is to do real research that is in the best interest of, in a sense, of the investor at the end of the day. And then when they do that research and they bring it to their peers, they are then open to criticism from their peers. And the peers love to pick them apart if they can, because there's a kind of competition going on there. Because the people who have come up with the best research, if you want to look at it that way, those are the people who have become the most famous and maybe even found a way to cash in on it. But the bottom line is, intuitively, that process of what they go through to determine what's in your best interest, I think that's more trustworthy. And by the way, they will readily admit they can't tell you the future. Fama and French can't tell you the future. They can tell you what the premium for small cap value has been in the past, but they can't tell you what the premium will be in the future. But I tell you what they will tell you is they believe wholeheartedly there will be a premium for small and a premium for value. It isn't magic, just like there should be a premium for equities over fixed income, but not always for very long periods of time, whether you're looking at bonds versus stocks or large versus small. And they help us understand that. They don't hide the bad news. They reveal the bad news, because that bad news is what an investor's going to have to go through to get from point A to the end of their life. And we need to prepare them. The academic community, I think, does the best job of preparing them for the reality of successful investing.
Investing is an important aspect of our lives, that's for sure. But what else, in your opinion, should we do to feel satisfied and have a happy life? Because, for example, when I look at you, it's so amazing that you are so active and you are having such a big passion in educating people. And really, I just enjoy talking to you. Is this maybe a recipe for a happy life, just being active and having a mission? And I was reading, and by the way, I will return to that later on, to your discussion to Jack Bogle you had a few years ago. And after that, when you were commenting that meeting, you wrote on your blog that, and I just will quote it, "I have always thought I would continue my work until I'm 85, but seeing Bogle and how much he obviously loves what he is doing, I'm now committing to continuing until at least age 90. So is it just a recipe for a happy life, just being so much, dedicated and have such a big passion and just educate people and do what you love?
Well, something, to be fair, I'm retired. And as a retiree, I have lots of other friends who are retired. And I get together with them often. And some of those people look at their success in retirement as being built on 3 legs. Leg number 1 is family. Leg number 2 is friends. Leg number 3 is golf. Okay?
All right.
Now other people have, I find, those same 2 first legs, but that third leg is something else. And I don't know if the reason I spend all the time I do on a financial education is because I love it or because I can't play golf. But I will tell you that there is a great feeling when you're doing something to help others. My mother was a nurse, and she spent her career helping others. She used to go in on weekends with her doctor, and they would they'd let people, this goes back before Medicare, they'd let people in the back door to come in and get their help with their health at no cost. She just had a commitment to helping others that it was a great lesson for me. And she also, by the way, never failed to remind me, be nice to everybody you meet in your life. And she said, you never know how they're going to change your life. And by the way, that has absolutely been true. But the passion for teaching, it's what I know, Jack. I don't know anything else as much as I do this. And the reality is, you said it earlier, money is a part of everybody's life.
Exactly.
And the fact is, if people can get that right, they are going to solve one of the major problems in marriages. And that is problems around money decisions. And they're going to be able to retire with dignity. And they're going to be able to leave more to others. And I don't mean they have to have a job that pays them $1 million a year so they can invest 100,000. I mean just the people who can find ways to put away $5,000, $6,000, $7,000 a year eventually as they grow their income. Everybody can do this as long as they don't do too many things wrong. And I don't want them to make the mistakes that most all of us have made. I don't know what your mistakes have been, Jack, but I can tell you I did a whole bunch of things early on that I wish I could take back. And I'm trying to help young people. I have this weekend, I have a high school group on the East Coast that I'm going to be doing on Saturday and teaching them. And then next week, I'm doing a university group of kids. And I want to help them, and we have ways to help them, but then we also want to help the people who are retired, because they too can take steps to take better care of their money.
I wanted to talk now about the behavioral challenges and aspects of investing, because this is what everyone will face it once we invest any money. So how do you, for example, control your emotions when it comes to investing? Or what would you recommend also to others in terms of managing our emotions? Because this is a big part of the whole process.
Yeah, it's a tough one. It's a tough one for me. I made a brilliant decision years ago. I mean, I cannot tell you how happy I am that I made this decision. I made the decision that as I looked at my own personal response to the market and to my investments, that I was probably smarter to have somebody else do it rather than do it myself. I am happy to teach all day, others to do it on their own, but I know myself. And because I am defensive, my mind is defensive at all times. When the market starts going down, if I don't have somebody there taking care of it, I probably would overreact like so many people do. So yeah, there's a price to have somebody take care of it. And it's a price, by the way, that over a lifetime can be worth millions and millions of dollars. I mean, there is a payoff for learning how to do this yourself that is just huge. On the other hand, if we make those bad decisions, panic when the market is down, not want to invest when the market is down, forget about panicking and getting out. Some people just stop investing when the market is down, the very time that they could be buying more shares in terms of the price they pay. That will, from everything we know about the past, you'll get a reward for that later. And the cheaper the shares you buy in the first place, the bigger the reward later. But it's a difficult hurdle to get over for a lot of people. I don't know if you look at the numbers, Jack, but at least in the US, something like 25%, and I've even seen numbers up to as much as 40% of millennials will not put any money in the stock market. They do not want to take the risk. They look at investing as just one big crapshoot. It's a gamble, or it's just a massive speculation. And then they can just be crazy and conclude, by the way, the same people can be crazy and conclude that cryptocurrency is a safer place to put their money than the S&P 500. I mean, these kinds of interesting thoughts that people have, I shouldn't call them crazy, but people come to conclusions about investing that there's no evidence that they are right, but it's what their heart or their gut or their brain is telling them. And by the way, the academic community has figured this all out, and they have a whole list of biases that people have that stand in the way of their investment success. And at the end of the day, if we can figure out how to manage each one of those biases, which is what I'm trying to help people do, they are likely to be successful. But if they don't know those biases, how will they identify whether that might be the reason they don't achieve what they want to achieve? Self-awareness in this business is absolutely huge. And so I know me, but I'm 78, so I've had time to know me. And young people don't have much time behind them to know themselves and to understand the investment process. But the sooner they get it, the more likely they are, and I'm talking about the market as well as themselves, the sooner they are to be a success.
So how do you think an investor should adjust strategy so that it's really matching his or her, let's say, psychological construction? Because I think it's a big part of the whole process, because people quite often, the beginners, they have funny expectations about what they can have on the market. And these expectations may be leading to the wrong decisions. So how, for a novel investor, to have realistic expectations, how to approach that problem?
Well, let me talk about the 7 things that we do on our website, because they are aimed at helping people get through those decisions and understand them. We do not give tax advice. We do not talk about Roth IRAs and 401ks in terms of all the legal aspects of it. We are not financial planners. We are not estate planners. We have focused in on the area of understanding and learning what equity asset classes you should have in your portfolio, because for 99.9% of folks out there, that is the gas. That is what's going to give them the growth to have the money that they're going to want later on. The second thing is, once you understand what those equity asset classes are, and not individual securities, I have no idea how to do that, but rather broad, big companies, small companies, growth companies, value companies. There are ways the academics have broken these out that it's really easy to understand the past. Then we want to know how much of each one of those should you have. Then we want to know how much should you have in fixed income to go along with the gas, the bonds. That's the brake. The bonds are not trying to make you rich. And as a matter of fact, they're keeping you from making yourself rich if you have all in bonds and no stocks. So what's that balance of equities and fixed income as an investor? We have built tables. They're called the fine-tuning your asset allocation tables. They show all S&P 500, 100% in S&P 500 from 1970 to 2020. At the other side of the table, on the left-hand side, is all bonds, breaks at all times. In between, in 10% increments, we show a combination of more bonds and less stocks, so that you can look at 10% in equities, 90% in bonds, 20% in equities, 30, 40, you've got the idea. And at the bottom of that page, you will learn, okay, had you done that with the S&P 500 since 1970, here's how much you would have made with each one of those combinations. But then below there is the other part of the formula. Not only how much you make, but how much did you have to lose? I have stood in front of thousands and thousands of people, tens of thousands of people, and I have said, I don't mean in one room, by the way, I have said, if you follow my advice, I guarantee you will lose money. Absolutely guarantee it. And then the people will laugh nervously. What do you mean you guarantee I'll lose money? And I said, well, because part of the process of investing and taking the risk of bonds or stocks, sometimes you lose. With bonds, it's teeny tiny amounts of losses. With stocks, it's huge. It can be, if you look back far enough, it can be 80 or 90% of the value of the securities. As a matter of fact, if you have all your money in General Motors and it goes broke, or in Washington Mutual or in Eastern Airlines or a whole bunch of other companies, you lose everything, which is why we don't want you in individual companies. But that table helps you understand what you're going to have to go through. So I could ask somebody, how much are you willing to lose? And they say, well, I'm willing to lose 20%. And I'll say, okay, it looks to me like you should be maybe 50% in stocks and 50% in bonds because you're likely to lose that much. And in fact, if you do that, I can almost guarantee you lose that much. And they'll say, guaranteed? Yeah, I don't want to lose that much. That's the tug of war people need to go through. But they also need to find out what amount of exposure to risk do they need to reach where they want to go. Well, that's going to depend on how much they put away. And all those kinds of moving parts. We do our best to show people historical information, in some cases going all the way back to 1928, so that they will see that either how much you make, how much you lose, how long you don't do what you expected. You talked about expectations, Jack. People's expectations are, if you go into stocks, you're going to make a lot of money real fast. Yes. And sometimes it can take you 20 years to break even. I mean, that's the two sides of that stock portfolio commitment. And so I'm trying to educate people to have the reality. And in some cases, it causes people to be less aggressive than they might have otherwise. And what I don't know is if I've just hurt them or I've helped them. Because maybe if they had taken that greater, more risky path, they would have stayed the course. They wouldn't have cashed in like so many people do. Or maybe it will be the reason they don't cash in because they figured that out and they accepted that risk on day one. I'm going to be dead and buried before these people find out if what I recommended was really the best thing for them. But I'm trying, and that's all we can do. And that's the same path you're on in your work.
And do you think that an average person can run their own investment, or should rather find someone, delegate that to services like, for example, robo-advisory, or someone like even you, as you said, you are an expert in investing, but you prefer to have someone who pulls the strings? I mean, so it's following the strategy you set, but do you think that an average person also should try to follow that path?
Well, I want to make one thing very clear in my portfolio where somebody's taking care of it. It's very complex. It is half in buy and hold with 10 different asset classes in equity, and then the right amount of fixed income and rebalancing and taking money out to pay for our retirement because I don't have a pension. This is the money that we live on. And then the other half is using an active strategy called market timing. And again, that's something that I would never be able or willing to keep up on a regular basis. So I want to be careful that mine is very complex, but it's what I want. On the other hand, there are very simple strategies that you can do on your own. In the book that we recently wrote last December, published called We're Talking Millions, 12 Ways to Supercharge Your Retirement, we talk about a bunch of important decisions that you make. But number 12, $1 million decision all on its own is to use what they call a target date fund. Now, when you buy a target date fund, what happens is you, in essence, have a robo-advisor. You have a robo-advisor who knows that you want to retire in 2065. That's great, because that robo-advisor, they understand the kind of risk you should be taking. Now, they're probably going to be a little more conservative than I would like, but certainly they would be right on spot with what a John Bogle would like. And so they would have mostly in stocks. And then as they get older and older and older, at some point they add more bonds and more bonds and more bonds, so that when you get to retirement in 2065, according to these professionals, and they manage trillions of dollars. I mean, it's not like these are people just getting started in the business. They know what they're doing. Now, by the way, they don't know the future either. So they know what they're doing to do what they think is the basic right thing for you. And I'll want to differentiate at some point here, if we get a chance to, Jack, between what John Bogle wants for people and what I want for people, because it's different. But those target date funds allow you to let somebody else do it. And you know what you have to pay? About 1/10 of 1% a year to as much as 15/100ths of 1% a year. When I was getting started out and you had to buy a load fund and 8.5% was lost immediately, and then the expense ratios were about 1%. So for the rest of one's life, there'd be taken out 1% every year out of your hide. And you started with 8.5% less than you should have in the beginning. Today, you buy the target date fund. They do the right things, right in quotes, because any two advisors could easily argue what's the right thing. But yes, you can do it on your own. And what I in our book about those 12 ways, one of the things we talk about is taking that target date fund, adding a little smidgen, a percentage. Put 9% of your money in the target date fund. Put 1% of your money in another fund, a small cap value fund, and it could increase over your lifetime anywhere from 25 to 100%. What you will have to spend and what you'll have to leave to others. So, and that would mean you'd have to do one thing every year. You'd have to divide your money. You put 9% in one and 1% in the other. So now you're investing in two funds instead of one. I think you could do that. Yes.
So let's talk a bit about active versus passive approach, because I see some people are, like, I would say, dogmatic. They are telling, for example, that only passive approach is the only way we should go. And personally, I appreciate the idea of buy and hold and being passive, but is it really a big sin to use market timing strategy? I know you are doing that, so obviously this is not a big sin because you are an expert, but do you think that in general market timing is working and you would recommend that for even an average investor, or you think that the passive approach is better?
Well, first of all, I wanted to take a stand here so that people understand market timing is something almost everybody in the industry does. When somebody says, I think you should be getting out of those long-term bonds and moving into a short-term bond because interest rates are going to go up and the long-term bonds are going to go down, market timing. I think you should probably, the small cap value has been doing well lately. Maybe it's time to move some money out of that large cap blend fund and put part of it over here in this small cap value. Market timing. People say, look, take some money off the table because you're going to have a chance to buy some of these stocks cheaper. Market timing. Every one of those pieces of recommendation, those are all market timing of decisions. Now, the fact that one like myself would say, well, my kind of market timing is that I watch the trend. And by the way, somebody's doing it for me, but they are watching the trend. And when the trend changes sufficiently to call it a chance, opportunity to protect against further loss, you move out of the fund and you move to a money market fund, waiting to get back in later when the trend changes to the upside. Now, when you tell the market timing story, it's very easy to say, well, yeah, that makes sense. Why not? If you can do that, why not do it? Well, here's the reason so many people struggle with it. I'm going to tell you that professionals struggle with it too, because it's not unusual for professionals to second guess their own systems. The system will give a buy and a sell, and you, whether you're an amateur or you're a professional, you think, yeah, I can see it saying I should be getting out, but did you see that release of unemployment yesterday? It was fantastic, and there's all that money about to go into the economy. No, I don't. I want to override that for right now. I can always take care of it later if things get any worse. The minute you are second guessing a system, you are no longer an automated system-based market timer. You are just like everybody else, guessing what's going to happen next. And in the process of using these mechanical systems, boy, you know this as well as I do, Jack, you're going to have many times you'll have losses, multiple losses in a row with a system. You will sometimes get out of an investment at a price lower than you got in. Whoa, I don't like that. And then you'll get back in at a price higher than you got out. Whoa, doesn't that mean I have fewer shares than I had? Yes. And there'll be times that you have a major market decline, and that system, while it may protect you from part of that decline, you still end up with a loss. And you somehow thought that magically somebody had a system that you would never have a loss in a bear market. You know, the expectations are just as wacky for people who look at market timing and come to judgments as to what it will be like as buy and holders. The difference is this: the buy and holder never has to do anything. And there's a chance that that will work. But with market timing, every day you get up, and theoretically, even when you're using systems that don't trade very often, you at least have the responsibility to consider, what does the system say to do, and then to do it. So
Okay.
I'm just saying, Jack, that my concern is most people won't be able to do that. And I really respect the kind of work that you're doing and trying to help give people the data that they need and the ability to test systems. But they have to have the ability to actually do what the systems say to do one day at a time.
Thank you, Paul. I'm personally a quant, and to me, market timing means following a mechanical strategy. Because
Yes.
to me, discretionary approach wouldn't work because I'm too emotional. I would just do stupid things. So even sticking to the strategy is not a simple thing, but this is the only way for me. And by the way, do you think that once we are talking about this, do you believe that there are good discretionary investors, market timers, who are taking decisions just based on their discretion, based maybe on their experience, rather than on some rule-based system?
Well, first of all, I will tell you that people who do it professionally have some of the same problems. I think I mentioned this earlier. They second guess. If a system stops working as expected and has several losing trades in a row, people get nervous. And in the process of getting nervous, they think, well, maybe I should find a better system. Let me guarantee you, and you know this oh so well, that if a system hasn't been operating well lately that you can go in and find a system that handled that market better than the one that you actually used. And while this seems kind of a questionable thing to do, it is exactly what money managers do who pick active managers to manage for pensions. What they do is, if somebody doesn't perform well over 3 years, they say, well, we got to do something about that. And I've done an analysis, and here's a firm that did better. And I want you to get out of the bad firm and get into the good firm. What they don't tell you is studies show that when you get out of the bad firm and get into the good firm, you don't do 1 penny better on average. And so it's just a way of looking busy and acting as if you are earning your money. But they know better in almost every case. Here is one of the things that I did that was a major change in the money market, in the market timing business. Back in the 80s, early on, I started using other market timers. I hired other timers to use their systems. And the idea was that I would use many systems rather than one. Now, I wouldn't do majority rules, and if 3 out of the 4 are in, then that's the time to be in. And then when one of those sell, you get out. I divided the money into 25% increments and had 4 separate market timing systems, all systems that had worked in the past. This is not so different from having large cap and small cap and value and growth. It's the same kind of diversification. And as we did that, we then were, to the best of my knowledge, the first market timing organization to not only have multiple market timers, but to bring in international and small cap and large cap. So we were market timing a broadly diversified portfolio. By the way, my old firm still does that. And they do it for me, I'm happy to say. But the bottom line is that you, with market timing, can use multiple systems. But my recommendation is to let them each stand on their own, because they're based on a different set of historical kinds of outcomes that somebody believes that those system trigger buy and sell signals are going to help you. And that is something that we did that I think a lot of people copied after we did that. But it makes sense to me, particularly when I look at my buy and hold portfolio, does the same thing, has small cap value and large cap value, but not market time.
And by the way, you mentioned in one of our emails exchange that one of the strategy, market timing strategy, has a great track record. I'm not sure if I remember correctly, around 14% or something for the last 3 decades, around 3 decades. What type of strategy it is? Is it a trend following, or if you can tell us a bit about that strategy?
Oh, sure. Oh, no, I think it's, I was there to start it in 1995, and then a person joined our firm, an engineer in 1999 or 2000, but he took that hedge fund over and has just had a wonderful track record. And here's what it does. I don't believe that market timing is going to get you a better rate of return. I believe that market timing, in fact, I believe that it's guaranteed that if you spend part of your time in a money market fund and part of your time in the market, that you're going to have lower volatility than if you're always in the market. That part is guaranteed. What isn't guaranteed is what the return will be by doing that. And in many cases, the return is lower. And in some cases, the return is higher. I got a lot of TV time. In fact, I was on a show you maybe never saw, Jack. It's called Wall Street Week with Louis Rukeyser. And I was a special guest one week. And it was because all of our money was out of the market during the crash of 1987. That's the good news. The bad news is I did not call the crash. They wanted people to believe I called the crash. But the market timing systems I was tracking all were out of the market about a month before the crash happened. I didn't call the crash. The crash happened while we were out of the market. But it got me in front of a whole lot of people who wanted to know more about market timing. I hope that good luck happens to you someday. It does make a difference. But gosh, I got thinking about that. And go back to your question one more time. You remember what you asked me, Jack, when I went off on the Wall Street week?
So basically, regarding that strategy with a great track record, is it a trend following? Because I believe that you are a trend follower, or you liked, I think, that type of strategies, at least from what I read on your blog posts or on your podcasts.
I'm sorry. Yes, what I was about to say is my sales pitch for timing was not about making more money. It was about taking less risk and hopefully getting a decent return for exposure to equity holdings. What the Leverage Global Opportunity Fund does, it combines market timing, defensive, with leverage.
Okay.
And so, and there was good evidence, by the way, because in 1987, we were being tracked by a fellow named Mark Hulbert, the Hulbert Financial Digest. And we had accounts or strategies that they were tracking that were up over 50% in 1987. And that's because there was leverage in those accounts. And then we got out and then the market collapsed. So we looked like geniuses. Nobody is ever a genius. You know, the market makes you money. You don't make money, the market does. And we had the good fortune, like a lot of money managers do from time to time in their life, that makes them look better than they really are. But here's what I do know. When you combine market timing, traditional trend following, and sector rotation for a part of the portfolio, momentum kinds of work, and we have many different strategies. It sometimes we'll have 100 funds in the portfolio, and we don't use a lot of leverage, but enough leverage that it does make a difference. And it's just had a wonderful track record. And a lot of people don't know this, but most hedge funds don't live past 10 years. Most of them are out of business within 10 years. So to have been around since 1995 is a pretty doggone good track record. And by the way, the money made, the downside risk, you'll appreciate this, the downside volatility is about the same as the S&P 500. But the return over time is about, I'm talking about compounding, is over twice the S&P 500 since 1995.
That's impressive. That's impressive. So now I hear about Bogleheads, and I also quite often hear about Merriman heads now. I wanted to, if you could tell us a bit more about your conversation with Jack Bogle you had years ago. How is Jack Bogle's philosophy different from yours, if at all? Maybe it's about diversification. How do you see that? And if you could just tell us a bit about that conversation you had with Jack Bogle.
Well, when you ask me this question, I'm telling the truth. I get goosebumps because it was literally, it was a really special time. I was programmed. I had an appointment for an hour in his office, and so I got there, and he gave me 90 minutes. He was, by some, I've heard that he can be gruff, particularly if he thinks that you're not straight or there's something about you not to be trusted. But he was really nice to me. There is one huge difference between John Bogle and Paul Merriman, but let me tell you what I think is the same. He really, his focus was on helping the masses. Uh, as we know, Vanguard has some $7 trillion plus under management. A lot of that is for very, very large institutions. But the big institutions didn't seem to be on his mind. His mind was on the smaller investor. And what he wanted out of the recommendations that he was making was that people would have enough. And I believe that what he was professing to be the best path, the glide path that the target date funds have, are based on taking a moderate amount of risk and conservatively changing that balance of fixed income and equity so that if you do that over a lifetime, and we've looked at this carefully, you have a legitimate shot over the, let's say, from age 20 to 65, an 8% compound rate of return. Now, that is a very fine rate of return. And by the way, you're going to make more money in the early years. You're going to make less money in the latter years. And probably if you do that for 40 or 45 years, you'll be okay letting them go on and do it for the rest of your life because they'll do it for the rest of your life. In other words, you need to make one decision. That's it. I mean, that's pretty amazing to think. Most people over their lifetime, they change their portfolios 3, 4, 5, maybe even 10 times before they finally find something they feel like is a long-term strategy. Well, the basic difference, and by the way, John was very critical of my work, not because I believe in having 10 different asset classes. He agreed with all that Fama and French research. There was nothing wrong with that. His point was it was too complex and that people are not going to follow a strategy if it's too complex, which is why we developed the two funds for life strategy. But where John Bogle and I differ is I'm not trying to build enough. I am trying to help people build more than enough. And I want to give you an example. Most people don't have enough. Let's start there. Most people do not retire with enough. There are a lot of people that all they have is Social Security to live on. And if that's enough, I'm feeling badly for them because that's a tough way to spend 30 or 40 years after retirement. But what I do believe is if we can save enough plus, see, John would like them to get, I mean, from the conversation, this is what I'm gathering. You get to retirement and you're able to take out 4% a year and adjust it upwards each year for inflation, and that you'll have enough to last the rest of your life. You may not have much left over. In fact, you could be, broke at the end of a long life, but it should give you enough. There's a whole other level of how much you could have at retirement. It could be 125%. It could be 150%. It could be 200% of what you need. I kept working for money longer than I needed to, but part of what I wanted, I wanted to have way more than enough so that it wouldn't be a 4% extraction rate. It'd be a 5% extraction rate. And instead of having to adjust to the distribution based on inflation, don't even worry about inflation. We're already taking out more money than we need anyway. So if instead of $1 million, taking out 40, if you've got $1.5 million, you can take out 5%. You can take out 75, even though you only need 40.
Yeah.
And I want to help people get to the $1.5 million. And by the way, a whole lot more than $1.5 million, because by the time that people get to retirement 30, 40 years from now, I'm just sure, based on the past, that inflation is going to cause you to want to have not $1 million or $1.5 million, but 5 to 7 million. I'm not kidding. 5 to 7 instead of $1 million.
I have a great respect to John Bogle's achievements, but also I think that he was quite lucky that he started his index funds in the middle of 70s when there was like 25 years or something. There was a like 17% annual compounded return on S&P 500. If he would start, let's say, in 2000, when there was a dot-com crash, probably the whole story would look different. Would you agree with that? That
Totally.
on top of
Fact,
the great work he did, he was also quite lucky.
I brought that up when we met, by the way. Yeah, and I was serious because I've had many things happen that we have to grab the luck that we have a chance to take advantage of and do what we can with it. He understood that totally. He also understood how close he came to not having anything in terms of the greatness that he achieved, because he had started the 500 fund after having been terminated by a company, and he was looking for a way to make his mark. He was not the first person to come up with the idea of an index fund. As a matter of fact, Malkiel, in his original first edition of his Random Walk Down Wall Street in 1973, discussed exactly what the S&P 500 fund ended up being. I mean, it was word for word what it ended up being. And on top of that, they come out with the S&P 500 fund in 1976. They expect to raise 150 million. They raise $11 million. It was not, there was very little interest. And as far as I know, it may have been John Bogle and most of his friends who took that position at that point. And he had to argue with the trustees to allow it to continue to operate, to give him a chance. What if they hadn't given him a chance? I mean, and that kind of luck, it happens all of our lives. And it's one of the things when I teach college kids, I'd like to talk about the randomness. And there they are thinking they know what their future is going to be. They don't have any idea. I never thought I was going to end up owning a company that distributed jewelry making equipment and supplies. I mean, where did that come from? I didn't know I was going to end up running a company that manufactured high-speed paper handling equipment. How did that happen? I thought I was going to be a stockbroker. And I found out soon after having, for 2 years, I went in and applied for that job before I even graduated from college. Because I was hoping I'd go to work for the firm when I got out of college. No way, we don't want you. We don't want any kids. Go out and sell Fuller brushes and come back and see us when you're 25 or 27. And then when I went in the last time, they actually agreed to hire me just when I was retiring. But you know something, I might have had to go out and sell Fuller brushes for a while before they would hire me.
The role of the market is the valuation of assets. So what's your opinion if everyone or most of us would start invest passively? I mean, there would be only buy and holders. Do you think that the market would not perform or would perform poorly in terms of valuating the assets, or the market maybe would just stop working as expected because everyone would just only buy the whole index and do nothing?
Well, there's a lot of theory around this because it is a consideration, and more I think today that over 50% of the money in 401ks are going into target date funds, where most of that money, whether it's at BlackRock or Vanguard or Fidelity, is likely in index funds. So that is certainly happening. But we have to remember that it is a relatively few shares every day that dictate the price at the end of the day. And so it is my belief that there will always be the folks who are going to be moving around, whether it's not necessarily day trading, but making those kinds of decisions when to be in or when to be out. So those that's how our investments are evaluated. What is a little confusing is if enough money was going into index funds, that regardless of what's going on in the economy, that the market would keep going up and up and up, and so that is confusing. But my sense is, and in fact, John Bogle talked about this a little bit. He said that they had a real problem at Vanguard during the late 90s. People were putting all their money, or a lot of their money, into growth. And when growth started fulfilling their dreams, they sold and they went to value. By the way, they went from the growth, when the growth had declined a lot, to the value after the value had gone up a lot. And so I don't know that we will ever change that aspect of investors and how they feel about losing money. We know that people don't like to lose money, but we also know the power of FOMO, fear of missing out. We also know the power of you only live once, and people wanting to spend money rather than save it. These emotional drives are huge. And of course, what I'm trying to help is one individual make good decisions. I want to follow the lead of Warren Buffett. I want to make sure you do the right things. There's only a few of them. And I want to make sure you don't do the wrong things. There are a million of them. And so I really want to focus on the right things. And then, and this is a big Buffett quote, don't say what's left over after spending. Spend what's left over after saving. If we can just get those two quotes down, we are on the way to helping young people build some really serious portfolios. Well, welcome to another get-together of Chris, Daryl, and Paul. That's Chris Pedersen, Daryl Balls, and Paul Merriman, here to help you by answering your questions that came out of one of the finest presentations I have ever seen on the internet. And that was a presentation for AAII, the American Association of Individual Investors. And Chris Pedersen made that presentation. Chris, by chance, do you have the title page for your presentation? Because I want people to see that, because I'm hoping that you will, if you didn't see it, go see it, because truly it's one of the best I've seen. Simple and effective, balanced portfolios for lifetime investing success. And the fact is, most of us have got balanced portfolios, and that may apply more than the all equity portfolio that I made in the previous AAII presentation. But out of Chris's presentation came a whole bunch of questions. And so we're going to dedicate one of our podcasts here, and it will also be a YouTube piece to the things that people wanted to know. So Chris and Daryl, thank you so much for joining me again. I'm going to read these questions. And by the way, I would wish that you could have been there when the three of us discussed these, because just having sat through that give and take that we went through about these questions, they're all important, would be an education unto itself. So here's the first question. What withdrawal strategies do you recommend? And then he goes on to say, should I take equally from each fund or draw from the one that has grown the most? So let me take the first part of this, guys, and talk about the withdrawal strategies we recommend. If you haven't been to our website, paulmerriman.com, and there's a section entitled Best Advice. It's one of the links at the top of the page. You go to best advice, and there's a drop down, and one of the things you'll come to is the distribution 2020 link. That will take you to over 60 tables representing the assumption that you invested starting in 1970, 50 years worth of data, taking out either on a fixed basis or a variable basis, taking out 3%, 4%, 5 or 6, using an all S&P 500 along with fixed income, or an all value, or a worldwide this or that, and 70-30 and 50-50, all of these different combinations, so that you can compare the implications of how much you take out, whether you force yourself to raise the amount each year by inflation, or you take a percentage of whatever's left at the end of each year. These are all different philosophies or approaches that you could study. And that then is for you to try to figure out what amongst those tables represents your likely financial future. Not an easy task, but that's what we're trying to do to help investors. But then there's the question here, should I take equally from each fund or draw from the one that has grown the most? Daryl, do you want to take that on?
Sure. I would not think you should take from necessarily from the one that has grown the most. I would use distributions from your portfolio to rebalance the whole portfolio. So you would look at what your asset allocation should be, or your sub-asset allocation should be, and it takes from the rich and gives to the poor. But you sort of have to figure out what's my balance after I take out what I need, and then redistribute that across your asset allocation to figure out how much you need to take from each separate little piece. There was another part to this question about how do RMDs change things, and at the top level, I don't think they change things. They change the implementation a little bit about how you go about it in terms of the details, because now you've got to look at your portfolio as a whole between both your tax advantaged accounts or your tax deferred accounts and your taxable accounts. And so you need to figure out how much you need to take out. What does that make your whole portfolio balance be? How does your asset allocation spread across that new balance? And then you take from the pieces that are above that balance. And if you need to, you can move some into the other balances in your taxable account.
Now, Daryl, that sounds like a lot of work or a lot of moving parts. What does that take you each year for that decision yourself?
I have not started RMDs yet, so I don't know. To be honest, I'm not quite that old yet. Well, they moved the line, right? They moved the line, so that gives me a little bit more.
Yeah.
But I don't think it's going to be that difficult. But then I'm a numbers person, so if it's an individual who's not a numbers person, you could just keep it balanced at the top level. If you have more in stocks than you want, take it all from the stocks. If your bonds are more than you want, take it all from the bonds, or just stick between that. And in the grand scheme of things, I think some of the work that Chris has done shows that if you don't rebalance your equity portfolio at all, it doesn't really make much difference. So which particular sub-asset classes you take it from probably isn't as important as keeping your stocks and bonds balance.
That would be the simplest. Okay, thank you. Number 2, would the 2 funds for life approach of 1.5 times your age work the same with a U.S. total market fund and a U.S. small cap value fund? Well, let me explain just a little bit. Chris did in his presentation talk about the 2 funds for life, but the person here, I think, is talking about not using a target date fund and a second fund, but instead building a portfolio of an equity fund, eliminating fixed income completely from the portfolio, and a second fund, maybe only doing that up until their point they're maybe 40 or 45 or 50, and then start adding the fixed income to the portfolio. So Chris, what would the difference be, the approach, using an equity fund and a second fund like small cap value?
You know, in the early years, you're going to have the advantage that you don't carry a lot of bonds. You're not going to be looking at the 10% bonds that a Vanguard portfolio would have. So that's going to give you a little bit higher return, a little bit less diversification, a little bit deeper drawdown. For a young person, that's probably a good set of trade-offs, especially if they can stick with it and they've got dollar cost averaging working for them to reduce the drawdowns anyway. As they get older, I think it becomes more problematic because you really have given up a fundamental part of the two funds for life. You no longer have a glide path that is adjusting risk for age, even though you might transition from a more volatile asset class and small cap value into a total market fund. That difference just isn't very great compared to transitioning into a fund that has substantial investment in fixed income. So I'm not saying it would produce a bad result. It might produce an okay result, but the person taking that approach really isn't taking a two funds for life approach. They're taking an all equity approach and just saying they're going to vary. In fact, they're going to reduce their diversification as they get older because they're going to go from an approach that has diversification across the market risk factor, the size risk factor, and the value risk factor to being all market eventually. And so I don't like it as a strategy for somebody between the age of 40 and 65. I would prefer if somebody was looking for an all equity strategy to go the full course, that they invest in something that's a more diversified portfolio. And then they've got training wheels on in the early years because they've got the dollar cost averaging helping them out. And as they grow into becoming accustomed to the full drawdowns that they might experience in bad market times, they're building the calluses to handle it when they get closer to retirement. And if they've oversaved at that point, it may be fine to stick with it. But you probably have to oversave by a factor of 2 to live with an all equity strategy through retirement, because you always have that risk out there that you're going to have half the money tomorrow that you had today. And if you can live on half the money comfortably and you can endure the risk, maybe that works for you, right? But yeah, it's a different strategy.
Chris, what's the latest that you think somebody wants to be more aggressive but still is committed to putting the fixed income on the table later? Would you let them go till age 50 before they start adding the fixed income? Because that gives them 15 years, theoretically, maybe 20, to have the right amount of fixed income when they retire.
We created the Merriman Aggressive glide path for people who want to be very aggressive. And I modeled it many, many different times, trying to figure out whether we were being too aggressive or whether we were coming up with something that tested positively through all 600 of the histories we could test it through. I think that's as aggressive for somebody who wants to ramp their risk down nearing retirement. That's as aggressive as I would recommend. So they could go take a look at that. And it starts in the 40s to introduce a small amount of fixed income and then increase it to, I think we end up at a 50-50 fixed income and equities around age 65. So I would, if you think about it from the standpoint of somebody who's going to work as long as they can, 65 is not that far from age 40, 45. You're down to 20 years. And it gets progressively, your human capital declines non-linearly, right? It accelerates because you got two things. You have fewer years to work and fewer years for compounding to help you out. And the longer you wait, the deeper a hole you've dug if something bad happens. Yeah, okay. I would, unless you know you're going to oversave and you can have twice what you need, I'd start reducing risk in those 40s.
Okay, good news. Okay, number 3, what percent of people can sustain a system when hitting a 50% drawdown? And this is one of the things you talked about, Chris, in your presentation, was the drawdowns that people have to be willing to accept with different amounts of equity. And I just got to insert one thing here. I can't believe how many people in my career in the industry were scared to death of a 50% drawdown, or the idea of being there for a severe bear market, let alone a 22.5% one-day loss as we had on October 19th, 1987. So they're scared to death of losing 50%. And yet you'll look at their portfolio, and what's it filled with? Mutual funds with high expenses, mutual funds with active management, mutual funds with tax inefficiencies. I can't say guarantee, but likely to lead not just to a 50% lower return over their lifetime, but a permanent loss of 50%, as opposed to the 50% we're talking about in a bear market has rarely ever been permanent. Of course, we've got to remember Japan. It has stuck around a long time in the basement. So that kind of 50% drawdown is just part of the process. But who wants to take a bite at this about people being able to sustain a 50% drawdown? Who might that be? Daryl, do you know that person?
Well, I probably know a couple of them, but I think the question as to what percent of people can handle it is I don't know the answer to that. I would postulate that more people think they can handle it than probably can handle it. And the reason I say that is because I'm not sure that everyone sits down and actually has a really heart-to-heart talk with themselves about their ability, willingness, and need to take risk. That's the Larry Swedroe mantra, and I think it's actually a pretty good one. There's a good description of it on the Bogleheads wiki site if you want to go look at it. But your ability to take risk factors in things like your time horizon, the liquidity of your or the need for your liquidity for what to meet your expenses, how stable your income is, and also to your personality to a certain extent on how flexible you are to adapt if there's no plan B. Willingness is really characterized by how much you need to eat well and how much you need to sleep well. So you kind of need to trade off those two in terms of return versus withdrawal rates, let's say. And the need to take risk is sort of defined by what kind of rate of return do you need to meet whatever you think your ending goal is. So it's important to go through and assess what your risk posture is or your risk profile is. As far as the people who can sustain a drawdown like that, I think it's people who, in large part, who have sustained drawdowns before, maybe not 50%, but maybe a bear market or two. And so they've got, as Chris mentioned earlier, they've got the calluses to deal with it. So I think that's important. I don't know how else to set yourself up for that. One analytical way to look at it is Chris has a table in his presentation that he made to AAII that talks about drawdowns when you're and puts them in the context of when you're making contributions, particularly early on. A 50% drawdown early on is not nearly as bad as a 50% drawdown at the end of your portfolio, and that's part of the reason why you move from equities to bonds, I think. And so that's an interesting thing to look at. The mere fact that this question was asked leads me to wonder whether or not the person that asked the question is one of the people that can sustain that kind of a hit. So
Yeah,
it's kind of, if you have to ask the question, the answer is no, kind of thing.
These questions came to us as, they were typed into a browser window, and you could read this, and I think it was probably intended this way with a little bit of a snarkiness, what percent of people can sustain a system when hitting a 50% withdrawdown? It was, you could read it with disbelief, and I agree with you, Daryl, that I think this person was just looking at the chart saying I couldn't, right? That was the way I read it. Yeah.
Well, I think a lot of people will conclude they're willing to lose it if they think there's a ton of money to be made. When I saw this question, it reminded me of the article that Morningstar wrote years ago about CGM Focus, a mutual fund that had a phenomenal track record for a decade. As a matter of fact, for the 10 years ending, I think sometime in 2009, its compound rate of return was 17.8%. So people were chasing that fund like mad, but they tracked the cash flow in and out of that fund, and the return for the shareholders who bought it was a negative 16.8% a year for that 10-year period. And so these were people who thought they could accept the volatility in order to get the huge return. But guess what? It turned out they were bailing out at market bottoms and being very attractive to it when it was up and making a lot of money. And that, of course, is one of the biggest challenges for investors, is to stay out of that process.
One other thing, Paul,
sure,
about this is that, and I remember this from when you gave your seminars, these many years ago. And that's one thing to think about when you talk about percentages of drawdowns. When you say to somebody, would you be willing to lose 50% of your portfolio for a while, even if you knew it was going to come back? And they'll say, oh yeah, I would be able to do that. I think I can handle that. And then you say, okay, well, assume you have a $2 million portfolio. Would you be okay with losing $1 million? And they would say, no.
Yeah.
Okay. So
yeah,
sometimes it's important to look not at the percentage necessarily, but in terms of the dollars that you're talking about when you're assessing your willingness to take the risk.
Yes.
$1 million buys a lot of meals at Denny's, if you're retired. So.
All right, thanks. Okay, number 4, why does the Trev H perform just as well as the 4-fund combo? When last month, Paul said the 4-fund combo outperformed Trev H. Uh-oh, I've been caught in a lie. No, it's not a lie at all. Chris, do you want to explain why I said one thing and you said another?
Well, we should probably start, for listeners on the podcast, reminding them what the difference between the two is. The 4-fund combo is the 4 corners of the stock market in the US. So the 4-fund combo is large blend, large value, small blend, small value, all in the US. And the Trev H substitutes 2 of those for international funds. So it still has the large blend in the US, but it's got large value international. And it's still got small value in the US, but small blend international. And so obviously the Trev H is worldwide diversified, where the 4-fund combo is all US. And when Daryl and you did the paper last month, you only used the history going back to, I believe it was 1990, right, Daryl?
Correct.
Yeah, and that's because that's where we have real return data going back, that's firm and hard and easy to get at. And when I say easy, I mean, with hours and hours of Daryl's diligent time. It's not trivial to analyze it. But we've also been working on extending some of those asset classes farther back in time. And when I did my paper this month, I used something that relied on additional asset class history to extend it back to 1970. And some of that required some clever substitution and relying on some new resources that were available external to the ones we normally have used. And you can just look at the return history. If you go back to 1970, public sources will tell you the international market benefited from that period of time from then to 1990. And so by going farther back in time, the internationals did better, and the difference between the two becomes almost insignificant. And so it's basically just different return histories, different periods of time. Will either of them be the perfect predictor of the future? No. We don't have any perfect predictors of the future. Is a longer history generally better? I think so. I like the longer history. So I think that's the difference. Fundamentally, just different period of time.
So let's talk Turkey about this all U.S. versus the 50-50 U.S. international. And I personally, my wife and I, we are in the equity part of our buy and hold portfolio, half U.S., half international. And that's there for a reason. But the difference in long-term return, we see that it's the very little, and with 1 year more's performance could change that to be equal again. So there's not much difference in performance. So it is about risk management, that with the US and the international, we've added more asset classes, we've got currency diversification. But how big a deal is all of that? I mean, is there a way to put a number to it, or a percentage to it, or anything that would say it's a huge advantage if you just take this one last step and add the internationals?
I don't think there's a way to say it's a huge return advantage. I think maybe another way to ask the question, and you can tell me if I'm wrong, Paul, but we look back and evaluate the value of the premiums from small and value. They don't always deliver, but we can go through the ups and downs of small and value versus the market overall back to 1928. Mm-hmm. And what we see is that it's sometimes behind and sometimes ahead, but over the long haul, it's very much ahead. And even when it falls behind, a lot of times it doesn't fall so far behind to make up for the other times it got ahead. Mm-hmm. And so it's kind of a squiggly line that is slowly separating from the stock market over time. And because these ups and downs have repeated many, many times and generally been to the advantage of somebody who invests in things that are smaller and cheaper, we say that looks like a good long-term trend. When we look back at US versus international, it's a very different picture. There's decades where the US did well, decades where it was best, decades where it wasn't. In the US versus international, it did better than international on average over 100 years. But there's not that same kind of pattern where they fall behind and get ahead. And then, there's this constant kind of separation of the two. I think it's less obvious that any of the countries, US or otherwise, is going to be the right bet for the next 50 years or 100 years or 20 years. I'd be interested. Daryl, do you have a different view of that, or?
I do not.
Okay.
I've looked at the telltale chart of international versus US, and yeah, there are times when one races ahead of the other, and there are times when the other one catches up with the one that was ahead, or depending on how you want to look at it. And it doesn't get very far away from one. Okay, as you go across, they go above and below, but they're moving about this same mean. So if you think about the mean in terms of reversion to the mean, when you're talking about US and international, it's pretty close to a straight horizontal line that's about one over long periods of time, like you were saying. Not quite the same with small cap value versus the market, total market. But is international going to improve returns? It's not been a good decade or so, maybe more, for international. Are they going to improve in the future? Probably, but I'm not going to guarantee it. Will the Trev H outperform the 4 fund in the future? Maybe, but no guarantees. Again, it depends, I think, on your diversification philosophy in terms of whether you want to include things like that to help provide additional diversification across your portfolio. The one thing I would caution people against is that if you say, I'm not investing in international because it's done so poorly over the last 10 years,
Right.
That's
Wrong.
to me, that's almost a form of performance chasing. You have to really think about what you're doing and have some fundamental reasons for doing what you're doing, rather than just the fact that it's had lousy returns recently. That's the old future return, or past returns are no guarantee of future returns.
So the difference, the difference in there then is we look at stocks over bonds, expect a premium. We look at small over large, expect a premium. We look at value over growth, at least historically, expect a premium. We don't really expect a premium from adding internationals.
Or from being exclusively US.
Right. Correct. Correct.
Yes.
But my point is, it's not about adding more return.
No.
It is really about having more diversification, almost like REITs. REITs when we do the ultimate buy and hold strategy, REITs add 0.1% to the portfolio where they come into the portfolio. So that's not a game changer. It's a little extra money at the end, but not a game changer. But it doesn't go up and down at the same time as the other US equity markets do. And that's the reason we have it there, which would, I guess, it would be a similar reason that one might have the internationals. Now, Chris, you look like you're looking for a table right now, are you?
Nope.
Oh, okay, I can go on. All right, thanks. Here we are, number 5. What about mid-cap funds? In other words, where are the mid-cap funds? Well, this is one we've talked about a number of times, but basically mid-cap funds are just fine if you want to have them in your portfolio. But the reason they were excluded way back when we developed this strategy, the ultimate buy and hold strategy, was that we were rebalancing as part of the process. And so in the book, Live It Up Without Outliving Your Money, book that we wrote in 2005, I think, my favorite part of that book is a series of bar charts that show different periods of time. This came out of the work of dimensional funds. And what DFA would do was they would show you the returns over a particular period of time for the 10 deciles of size of companies on the New York Stock Exchange. Well, no, actually in the US market, not just the New York Stock Exchange. And so you could see over these periods of time, how did the smallest companies do? And then the next 10%, and then the 30, 40, all the way up to the very largest companies in deciles. And from 65 to 68, the S&P 500 was up about 60%. The mid caps around 100%. Small caps up over 300%. So during that period of time, you could see that, boy, if I could have just been in small caps, I would have made a lot more money. But we're recommending that there's rebalancing going on. So you're taking, as Daryl said earlier, from the rich and you're giving to the poor. But what happened from 1969 to 74? The S&P 500 was down 20%. The mid caps were down 50%. The small caps were down 70%. So you went from a period of time where the small caps ruled the roost to a period of time they ruined the roost. And so this is the back and forth of this market that is appealing in terms of rebalancing, is that you're in fact taking from the asset classes that are pouring or giving extra returns. Just take you through one more period. from 75 to 83. The S&P 500 was up about 250%. The mid cap about 800%. The small cap about over 1,200%. So first it was the best, then it was the worst, and then it was the best again. Well, you can feel that rebalancing, taking from something that's done spectacularly, putting the excess money into the thing that's struggling, and then it comes back. You don't get the same rebalancing impact from using mid cap as you do from being out at the edges. That was why the strategy was to be at the edges. Now, having said that, Chris, when you put together a portfolio and there's big cap and small cap and in the portfolio, are you picking up some mid cap in that portfolio?
We did in the best in class. We have one fund that is, because there wasn't a large, deeply discounted value fund available. So we have a mid cap fund that sits in that space for us.
Mm-hmm.
And some people, from a purist standpoint, you'd say, well, your portfolio calls for a large cap value fund. You don't have a large value. But when you combine it with all of the other funds that make up the best in class recommendations for the ultimate buy and hold, it produced a spread across all the different Morningstar style boxes, or a distribution from large to small and value to growth that was very similar to what DFA's portfolio has. And so we thought, that's, it may not have the right words around it. It's a little bit of a compromise, but for people investing in the whole portfolio, it's a good thing. But I agree with the rationale. Ideally, if you have the things on the corners, then when you rebalance, you're not wasting time by selling things that overlap to buy things that overlap, right? It's better if they're more out towards the edges. Yeah.
Okay, great. Thank you. Okay. How can I determine which factors each of my stocks and bonds fall into? Chris, this is your baby.
Yeah, this one is a little bit tricky. If you want to know for any individual stock or bond, you kind of need to look at what's the market cap of the company, what's its price to book, and then go compare it to, say, a small cap value fund's average market cap or price to book. And you can get there that way. But I think for most people, they're going to have more than one stock or more than one bond. And for them, the Morningstar X-ray tool is really powerful. You can go in and you can type in your portfolio, you can enter each of your holdings, and then you can run the X-ray tool, and it will tell you how your portfolio distributes or sits on the Morningstar style boxes. And you can look at that then and compare it, if you want, to the best in class funds that we've put up and the portfolio spread that we got there. So that's for people who hold individual stocks or individual bonds. Maybe they've had them for a long time and they didn't want to sell them because of tax reasons. I think that's an excellent tool for figuring it out. It takes a little bit of time, not a huge amount of time, but it's a way for you to find out, whether you are already, whether you already have a tilt towards value or size or not. And if you already do, then maybe you can augment that with a smaller number of funds to balance it out and get the look that you want. If it's all in tax deferred accounts, you can just sell it and buy what you want. It doesn't matter, yeah. Right? So.
This just came into my mind, and we've not talked about this, but wouldn't it be wonderful? In fact, maybe people would even email info@paulmerriman.com and vote for, if they wish to have it done. Wouldn't it be cool to have a YouTube piece where you explained, or maybe Daryl does this as well, how to use Morningstar to get the kind of information that helps us understand how these mutual funds are built? Could that be a project for the year 2024?
I think that would be fun. We also need to do the how to use M1 pies, which
Oh, yes,
that one's
yes,
pretty simple, but I think it's a good one. Yeah, they're both kind of sitting on the other side of updating the best in class ETF
yes.
recommendations right now for me.
That,
But yeah, they're good
that's
things.
great. It's going to be a great year. Okay. Number 7, as someone that follows a very Boglehead oriented approach, simplicity, mostly VTSAX, what would your suggestion be for introducing some of these factor value oriented uh, asset classes, approaching adding them to the portfolio without blowing my entire portfolio up? Boy, I that was terrible. But you got it. What do you do if you want to test the waters and use some factor investing?
Well, one of the things you could do is if you're still in the phase of your retire or your investing life and you're still contributing, is you could contribute to the small or the value factor with your new contributions. That way you're not selling anything from your existing holdings to do that. And you'll still move slowly or gradually into that new tilt for your portfolio. If you're not contributing, then one of the things you could do, depending on this will depend a little bit on the structure of your portfolio, but you could take your dividends and capital gains distributions or the results of your tax loss harvesting activities that may generate some cash, and you could put those in the separate value fund or whatever factor you want to tilt towards. Depending on the size of your portfolio, those could take a while to generate a reasonable tilt, but you won't be blowing up your portfolio. So I think that's one way to do it.
That's I like that, Daryl. I guess a question for Chris, because Chris, you analyzed the risk and return of adding these factors. How much difference was there in terms of, since the concern is blowing up the portfolio, if you've got 10% in value, small cap value, what change in the drawdown, the maximum drawdown that we've seen, came with that compared to the more traditional portfolio?
Not very much. You know, you're talking, if you have an all equity portfolio, the expected worst case drawdowns around 51%. An all small cap value portfolio, worst case might be 60. I don't think it's quite that high, but it's, you know, in that ballpark. So there's a 10 percentage point difference between the two. And if you've only got 10% in it, you're only going to see 1% of it, right? So I really like Daryl's suggestion of slowly dipping your toe in the water and getting some experience with it. The other thing is, we know from the presentation you and Daryl made with the telltale charts last month that you might wait 20 years for your ship to come in, for the premium to arrive, right? Well, if you have taken a small part of your portfolio and set it aside and said, I know this is a long-term bet for a better return, it's probably not going to bother you 5 years in or 10 years in that it is just muddling along. And so you're more likely to stick with it. I think that's a great way to do it.
That's a good point. Number 8, and I'll tell you, Daryl hauled out some tables on this one, and I know he's going to haul them out here for you. And both Chris and I enjoyed them a lot. And the question is, what mix of assets are suggested for a retiree with a goal of asset preservation, which keeps up with inflation? So, Daryl, I'd love for you to share with them what you shared with us. I think they'll enjoy that information.
Okay, I'll try to be pithy. I guess the first thing is that if you're not taking any withdrawals, then just sticking everything in a tips allocation would do it. Okay, it's not gonna grow, but it'll stay there. So so that's one way to do it. If you are taking withdrawals, then it gets a little bit more complex, because this retiree has a different goal or different objective than a lot of retirees, maybe even most retirees. Most retirees, their goal is to not run out of money. And so what they are concerned about is, and if they have to take money from their portfolio, they're more concerned about something called a safe withdrawal rate or a sustainable withdrawal rate. How much can I take out? And in the traditional way this is looked at, adjust for inflation every year to maintain the value of what I take out. How much can that be year after year after year? That's not really what this individual is asking about. What they want to do is they want to not reduce the value of their portfolio. So they are looking at something that in financial literature, and again, this is maybe where the financial words are not quite the same as the real English words, but in the financial literature, this is called a perpetual withdrawal rate. And what that means is that if you have a certain time horizon, say 30 years, your perpetual withdrawal rate is one that will give you at the end of that 30 years the same value you had at the start of that 30 years. It's not perpetual in the sense of eons or centuries, but it's perpetual in what you define your time horizon to be. So I have a little something here that I will try to get through and be pithy about it. So can you guys see this?
Yeah, we got you.
Okay. So this is a little short tutorial. I hope it will be very short on perpetual withdrawal rates versus sustainable withdrawal rates and how those vary with your asset class selection, your asset allocation, that is bonds versus equity, and your time horizon. So I used a tool called Portfolio Charts, and you can see the link down here at the bottom. It's portfoliocharts.com. It's under portfolio and withdrawal rates. And this is a great site to do this kind of work. He's got a tool on there where you can set up your portfolio in terms of your equity allocation over here and your time horizon up here. And what he does is he has data from 1970 through 2019. What he does is he runs your retirement withdrawal scenario through every possible scenario that he can have, that you can have during those 30 years. And he looks at what your sustainable withdrawal rate would have been. In other words, what would have taken to not run out of money, and what your perpetual withdrawal rate is. What kind of withdrawal rate would have supported having the same amount at the end that you had at the beginning. So in this particular case, with a 3-fund portfolio, and this will be a little bit hard for the people on the podcast to see, but for the 3-fund portfolio, if you have 40% total stock market, 20% world market, and 40% intermediate term bond for a 30-year horizon, your safe or sustainable withdrawal rate is 4.5%. Your perpetual withdrawal rate, and 4.5% will quote unquote guarantee you don't run out of money. There are no guarantees, but over this particular time horizon, you would not have run out of money. There was one case probably where you had 0, but the others were more than that. The perpetual withdrawal rate is 3.4%. That's less because you don't want to have 0, you want to have what you started with. So for a 3-fund portfolio, those are the rates. 4.5 for safe withdrawal rate, 3.4 for perpetual withdrawal rate. If you go and you look at, say, the US 4-fund now, where 15% large blend, 15% large value, 15% small blend, 15% small cap value, and 40% intermediate term bonds, again, over the same 30-year period, now your safe withdrawal rate is 5.3%, or was 5.3%. Your perpetual withdrawal rate is 4.4%. So that's your sub-asset allocation, or your asset class selection difference, if you will. So if you look at several portfolios here, there's the 3-fund and the US 4-fund with their 3.4 and 4.4 perpetual withdrawal rates. Look at the ultimate buy and hold. It had a 3.9% perpetual withdrawal rate. The International 4-fund, or the TREV-H as we've been calling it, has a 4.1% withdrawal rate, perpetual withdrawal rate. So you can see how with your different asset class selection, for a 60-40 equity bond ratio over 30 years, you can see how your withdrawal rates change from sustainable withdrawal rates to perpetual withdrawal rates. Again, the thing to remember is that this only covers 1970 through 2019. And so for your sort of standard portfolio that people think of when they're thinking about safe and perpetual withdrawal rates is a total market and bond portfolio. So if you look at the three fund portfolio here, its safe withdrawal rate is about 4.5%. That's about 1% higher than typical number that's quoted of 4%. And part of that's because, well, it is because it doesn't include the time period that sets that 4% number typically, which is in the mid to late 60s. So if you're going to use this tool to look at numbers, I would maybe derate some of these numbers by about 0.5%, just to be on the conservative side. So suppose this isn't what you want to do in terms of asset allocation, in terms of 60, 40, or 30 years horizon. So what happens if you vary those things? Well, if you move to a less equity position, say a 40-60 portfolio, your withdrawal rates will decrease. And for the people who are listening on the podcast, it's probably best to try to see if you can find some time to go look at the YouTube here. But you'll see as you go across these four portfolios and these two different withdrawal rates, they're all less. So decreasing equity allocation typically drives your withdrawal rates lower. If you increase your equity allocation, then it has the opposite effect. Things get a little riskier at some point as you increase that. But if you decrease your time horizon, the sustainable withdrawal rate increases because it has to support fewer years. But your perpetual withdrawal rate actually decreases because your goal is to have the same number of dollars you started out with. And so if you have a huge crunch right at the end, a drop right at the end, you need to have built up something to be able to deal with that drop and not fall below where you started to begin with. So your perpetual withdrawal rate will decrease as your time horizon decreases. If your time horizon increases, your perpetual withdrawal rate goes up because you've got a lot of time to potentially recover and build up a reserve to handle that dip at the end. But your software, your sustainable withdrawal rate goes down because it has to support withdrawals over a longer period of time. So if you go to a 40-year time horizon, these are the kind of numbers you see. So I don't know what this particular individual's time horizon was, what his or her risk tolerance was, how they felt about simple portfolios versus more diversified portfolios or more complex portfolios. Don't know any of that. But using this tool at portfoliocharts.com will allow you to go off and try to assess your own portfolio, what your sub-asset allocation is, what your equity bond allocation is, what your time horizon is, and you can get a feel for what kind of withdrawal rates you might be able to sustain on both a sustainable basis and a quote unquote perpetual basis. Perpetual being defined as the time period you are interested in.
Great. Thanks,
that's
Daryl.
All I
Did
have.
you want to add, Chris?
Yeah, I really like the tool that Daryl pointed to at portfoliocharts.com. And I would encourage anybody who's interested in this question on their own to go there and spend some time. Going back to the original question, what mix of assets are suggested for a retiree with the goal of asset preservation, which keeps up with inflation? I would say a short answer is diversified. Very diversified, and that would be diversified across fixed income. So have some in bonds so that you get some term risk exposure, some in stocks so you get market exposure, some in small and value so you get diversified risk factor exposure. And in the bonds, I agree with what Daryl said, that tips is a good way to help, especially in retirement, if you have some portion in tips to protect against inflation. But I love the tool. I think the tool is a great thing because somebody asking a question like that is going to want to take either my answer or Daryl's and go play with it probably. So there you go, a place to play.
And for people who don't want to get too serious with playing, but want to see what just a small change can have on a portfolio, what it will pay out. If you take the fine tuning table that we show with the S&P 500, for example, along with different percentages of bonds in 10% increments, even if you can accept 20% in equities, it will go a long way to helping that portfolio build some additional return that you need to deal with inflation. It doesn't take a lot. And so that's another easy thing to do. Number 9, in the Vanguard example, why is there a disproportionately lower increase in return as you go up in stock percentage? Chris, do you know what this question was about?
I do. And it actually ties to what you just said about the fine tuning tables. If you go from an all fixed income portfolio to one that has a little bit of stock in it, you get a pretty significant bump in the expected return. And that bump comes early. It comes in the 20% to 40% range. You get a big jump in expected return. As you go from that 40% equity position up to 80%, it's not as big a change. And the reason is that there's not much horsepower in the engine of fixed income, if you will. So, if you got a car that's just motivated entirely by fixed engine or by fixed income, it's not going to go very fast. If you have one that's motivated entirely by stocks, it has the potential to grow quickly, but it also might spend a long time stopped at the stoplight or even go in reverse for a while, right? So that big jump comes early because equities have so much higher expected return, and they have this negative correlation with fixed income. That return comes at different points in time. So you get a lot of bang for the buck in that early part of the curve, less bang for the buck in terms of total return later on. And it's just the nature of the beast. It's the way those two things add together when you back test. The surprise that came out of the presentation I made, I think, is that as you also add in some small and some value, you can improve the return per risk, the return per unit of risk. And that was really core to the message that we delivered on Wednesday night. And for people who want to have a deeper understanding of that, they should probably go back and watch the presentation.
Okay, great. Thank you. Number 10. Is it viable to have the buy and hold strategy in a taxable account as well as in your tax deferred account? Or put another way, how much will taxes from rebalancing hurt my returns in a taxable account? All right, Dale, you want to take a whack?
I can do that. Yes, it's valuable, or it's valuable. Yes, it may be valuable, but it is certainly viable. And the way to do that, I think, is to look at both accounts as one portfolio, and then to remember that you don't have to have the same assets or asset classes in both accounts. So the way this is a little bit like what my wife and I do. We look at our whole portfolio, or our whole across all our accounts as one portfolio, and we have one account, one account that's the 401k, where we have all our bonds in the 401k, and we have the larger equity allocations in the 401k. And the reason we do that is because the primary rebalancing objective is to maintain in my opinion, is to maintain your risk profile in terms of bonds and equity, fixed income and equity. And if you have your bonds in your tax deferred account and you have your larger equity allocations in your tax deferred account, it's easy to move between those two and get that balance, that equity allocation back in line. You've got big levers in that account to move those things around. And you can do almost all your rebalancing in your tax deferred account, and then there are no tax consequences. And in fact, you could almost make the argument that you could let your taxable account ride, depending on what the difference in sizes in the two accounts are. Your smaller allocations and your more tax efficient allocations could be in your taxable account, and you can use the distributions, the capital gains distributions or the dividends from those equity holdings in your taxable account. You're going to pay taxes on those anyway, so you could use those to move around and do minor rebalancing in your taxable account. That's one way to do it. Chris, do you have any ideas on that? You look.
Well, if somebody has only if they have all of their savings in a taxable account, then it's a different question. I really like what you said about a mix, and I think people should have a mix. I like that idea. But if somebody does have everything in a taxable account, first of all, do it infrequently so that you get long-term capital gains instead of short-term gains. That'll help. If you live in a high tax state, and I think the person who asked this question did, then that makes it gives you a disincentive for rebalancing. And in California, the maximum tax rate's 13%. That on top of 20%, you're up to a third, right? So your gains that you're trying to shift around, if you're giving up a third of it every time you shift it around, I'd say do it less frequently. It's probably, if you really want the highest return for the long term, you would just keep pushing it out and not rebalance and just bear the risk. That you could do that, but it'll probably push you into a spot that's very risky, and unless you've got the appetite for that, then the rebalancing is going to make a lot more of a difference. So I think I love your idea of having a mix, and I think the vast majority of people they'll have some in a taxable account and some in a tax deferred account, and be able to minimize the amount that they trade in the taxable account. And that's ideal. That's great. If you are stuck in an all taxable account, then you've really got to do a gut check about, how important is the risk reduction versus the tax liability.
Yeah, that gets back to where we talked earlier about what's your risk profile? Yep. Need, ability, and I forgot the other one.
Gentlemen, thanks. You've done it again. And there's a lot of detail here. We know that for people listening to the podcast, that you're probably going to want to go over and check out the graphs and things that Chris and Daryl have put together, and we'll have links to that work for you. You two guys offering your time has brought a whole new dimension, I think, to what the foundation is able to do to educate people who want to be do-it-yourself investors. And I really appreciate it. And I know from the emails that I get that the people who are listening, a number of them are really appreciative of what you guys are adding. Thank you both very much.
Well, thank you, Paul.
You're welcome. Thanks. You certainly are. And we're getting closer and closer to the new book. And so it looks like early part of December, we'll be celebrating all the hard work that Rich Buck has put in, along with a little work from me.
Christmas present.
A Christmas present, a Hanukkah present, or whatever a present. Yeah. So what was that, Daryl?
There you go.
There you go. All right. Okay, you guys, you take care. And thanks to all of you for joining us. And we'll be back next week trying to do it again. Good luck. Stay well.
You too.